the chip makers.
Really withstand some of the uncertainty that's ongoing, even as they prepare for the ongoing restrictions. That's not good enough, as we learned from H20 over at NVIDIA.
In just a moment, Danny Berger will break down some of the movers in the pre-market. Live from New York City, you're watching Bloomberg TV. Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
The chip makers in focus this morning. Equity futures negative across the board. On the S&P 500 down by 0.75%. On the NASDAQ we're down by 1.4%, with your movers going into the opening bell about 2 hours away. Here's Danny Berger. Hey, Danny.
Hey, John, and here's that company that's causing the rupture
Abbott's
in
earnings
chip
finally
makers.
coming through. Adjusted EPS $1.09. That's a beat on estimates of $1.07. Net sales $10.36 billion. A miss on estimates of $10.4 billion. They have reaffirmed their fiscal year guidance.
controls to sell to China are now being targeted by the Trump administration and are now themselves facing restrictions. So a big blow from them, bringing the entirety of the sector down with them. Meanwhile, you also have United on the upside this morning, up 7 1/3%. Maybe this is the new playbook for companies that are uncertain to their future. They keep their outlook for the year, earnings as high as $13.50 a share, but they say in the scenario where there's a recession, it will roughly have to about $7. You can see the positive share reaction. That contrasts with Delta, Frontier last week, who completely upended, got rid of their outlook for the year, and those shares fell. But this morning, it's a positive story for the airlines. It is lifting the rest of the sector with it, given that it's given the market a floor. Rounding things out with the Reuters report this morning on Tesla, sources there telling the outlet that Tesla will stop importing products and parts from China for their Cybercab and for their semi-electric truck. Those shares falling 1.9%. It hurts their efforts to really mass produce these things. It will be on pause for an indefinite amount of time. Again, sources there saying that they could handle the 34% tariff on China, but at the current levels, they just can't absorb the costs. John.
Danny, thank you. Tesla down by about 1.9%. On our radar this morning, China signals it may be willing to come to the table on trade. Sources telling us here at Bloomberg that Beijing is looking for certain conditions from the Trump administration, including a more consistent position on trade.
And also a little bit more respect they're talking about. They want to rein in
Abbott
some of the
sees
comments,
2025
like,
organic sales growth in the range of 7.5 to 8.5%.
Interesting, though. They want, Jonathan, what you said Wall Street wants, what Jamie Dimon wants, a point person to do these negotiations. Scott Bessent, the Treasury Secretary, said to me they will start from the top. Before you get a meeting between Donald Trump and Xi Jinping, there's going to need a point person to try to bridge the gaps in terms of a trade deal, especially when it's more than just trade. It's things like TikTok that might come into the discussion and the negotiation.
If the Japanese negotiations are a template for what's to come, it's going to be President Trump with Scott Bessent and Howard Lutnick all in the room at the same time. If you need a note taker, I will take notes. I will just sit there quietly. I would like to watch. I am curious how that's going to go.
I think it's going to be very interesting, given that there's
Abbott
one man
sees
that this market would like to see
2025
more
adjusted
of,
operating
and another
margin
man that this
to be
market might be
23.5 to 24% of
The
sales.
market wants to see more Scott Bessent. They are very happy that now he clearly is in the driving seat when it comes to trade negotiations. I asked him, he had told me after Liberation Day, Jonathan, that he was not part of the negotiations. He clarified to me this week that he didn't mean he wasn't part of the negotiations. He wasn't part of setting the tariff rates. It was a signal that he is now in the driving seat to bring these tariff rates down. I have to say, though, if I was part of the Japanese negotiating team today, I'd be very nervous. You're going in with the President of the United States, not your direct counterpart. And I imagine the Prime Minister feels a little bit left out.
It's probably not what they were expecting, that's for sure. Love the conversation you had with the Treasury Secretary. Could sense the frustration he had that the overwhelming focus of the press at the moment was only on one stall of the policy platform. So let's talk about another leg of that stool. Let's talk about the GOP. Considering a new tax bracket for millionaires. Sources telling us here at Bloomberg that House Republicans are proposing a new 40% rate for taxpayers earning over $1 million a year. The White House officials saying the president is actually open to the idea.
They're open to this. You have Senate and House aides and White House aides talking about this. They're drafting it. One thing is key, though, in our story. This White House official said that Trump is open to this idea of a new tax bracket. However, there was an emphasis that the higher rate should kick in at a threshold far greater than $1 million. And to be honest, this is what I've heard from people. Maybe there's a new tax bracket, but for it's people that make hundreds of millions of dollars, not just that 1 million threshold.
I'd love to know how many people earning hundreds of millions of dollars will actually pay that, because I imagine they had an army of accountants doing their tax returns. They don't do their tax returns like we do our tax returns, right? They've got an army of people working on those things.
Yeah, they'll deduct the factory that they built to fuel their kitchen and the house that they built and then the other house that they built. Look, the fact that this is being proposed highlights the perennial issue, which is that everybody has a money problem in Washington, D.C. You need more of it because right now deficits are going up, and the proposals that they have would only deepen those deficits.
A couple of things to watch later this morning. We talked about retail sales. That's due in about 60 minutes from now. Also this from Fed Chair Jay Powell.
Abbott to build new
1:30
U.S.
Eastern time
manufacturing
from the
with
Economic Club
tariff
of
threats
Chicago.
looming.
His second public appearance since President Trump unveiled sweeping tariffs on April 2nd. second. Will this address be any different?
You know, at a time when you're hearing from other Fed officials, there is a real debate about how much this Fed is going to raise concerns about anchoring inflation expectations versus going after some perceived weakness as you see a bottoming out or rock bottom types of sentiment in some of the soft data. Very difficult one. It is also difficult to take anything completely literally, considering that he is also messaging to a market where he wants them to believe that they are going to take a very firm hand when it comes to inflation.
The Fed chair speaking at 1:30 Eastern Time. Let's get to this. Wall Street's biggest banks looking for some clarity on policy. JP Morgan's Jamie Dimon urging Trump to start talks with China and telling the FT, quote, "We should be careful. I don't think anyone should assume they have a divine right to success and therefore don't worry about it." Joining us now to discuss, the former Republican House Majority Leader, Eric Cantor. Eric, welcome to the program, sir. Welcome back. It's good to see you.
Nice to be here, Jonathan.
Let's reset. What do you make of the approach from the administration to trade over the last few weeks?
Well, listen, I mean, there are so many, there's so much noise, so many signals coming from the White House right now. I think that market players are just, sort of trying to take a step back and figure out if they have a portfolio of companies, what it is that they look like, if they're import sensitive. Obviously, there's now a little bit more focus on what's coming out every single day of the White House. I think the imperative for the president and his team today, as they're meeting with Japan, is to demonstrate success. I mean, this is where I think people are looking for some amount of clarity in that. What does it mean when we're supposed to be enduring some pain? And the president's been pretty clear, saying, "Hey, we're going to change sort of the trajectory of the country. We're going to strengthen the foundation." And if that's the case, what does it really look like when he's dealing with a counterparty? And if it's Japan, and
Ukraine's
I would say
deputy
even India,
PM says minerals deal talks with the US see substantial progress.
That comes to mind. If we can demonstrate there's an opening up of that markets, that this is what it's all about, I think that would calm some nerves right now.
Are you convinced that is the metric for success?
Well, I think, there is, Lisa, you talked about sort of taking him literally, taking him seriously, or hinted at that in what you just said. And I look at this term of the Trump administration somewhat differently than the way we looked at the last one, in that almost he is sticking to his literal word when we're talking about tariffs and trade here. So, Jonathan, back to your question, if he's about trade deficits, because that's been one of the real metrics that he's put out there consistently, that's what it's about. So are we going to see the Japanese buying more of our goods? Are we going to see that along with the opening up of their markets so that our exports can flow into these other countries?
The president ran, though, on getting everyday goods down in prices, things like groceries, things like gas. A recent CBS poll says a majority of Americans see tariffs adding to prices, adding to inflation. Can they wrap this up before the midterms?
Well, this is and then this brings up the last point I think that's really important about today, and when we look at Capitol Hill when Congress gets back. I think the administration and the Republicans need to act with dispatch. It's important that there is some success under the belt demonstrably, so the markets see that in terms of dealing with countries. And I think from the Republican standpoint in Congress, they've got to get this reconciliation bill done. Simplicity is their friend right now. Adding additional taxes, doing those kinds of things is going to take weeks, if not months, to bring everyone on board. And I think if we can just extend what
According to the Wall Street Journal, the U.S. confirms new export curbs on NVIDIA and AMD chips.
They should just go ahead and do that.
If I had said to you, Congress right now is debating whether or not to raise taxes on people that make $1 million a year, would you think that came from a Republican or a Democrat?
It is an extraordinary concept coming out of what I believe is still a very pro-growth party. I think you've been discussing this morning the three legs of the stool of the Trump economic plan. One of them is taxes, the other deregulation, along with the trade agenda. All that has to come together to help growth in this country, to see incomes rise, wages, growth, wealth, all of it, opportunity. And to sit here and say that we are going to be increasing marginal rates on individuals, that ends up hurting small businesses. I mean, that's the trick there. When they start talking about millionaires, remember, we've got a lot of people in this country that file taxes that have sub-S or LPs or that are taxed at the individual level, but actually run businesses. And I don't think they're going to get too far with that concept.
But what if they do? This is a pillar of conservative orthodoxy, not to
Ukraine's
raise taxes,
deputy PM
period,
says the
on
minerals deal
anyone.
is expected to help economic growth for both Ukraine and the US.
If they were to go ahead with this?
Well, again, I'm not sure that they're going to go ahead with this.
But they're discussing it right now.
Well, I'm not so sure how widespread that discussion is and what kind of enthusiasm there is. But this is not a pro-growth item. And I think more of the focus is going to be on how they come together on these pay-fors, because we saw, again, the important data point that occurred last week was the bond markets. You know, we saw the concern there about the fiscal health going forward. And I think it's really important they focus on that so they can act with dispatch and get these tax rates extended.
Heading into this year, the belief was that President Trump was going to be a pro-business president who is going to focus on fiscal responsibility as well as celebrating national champions. We have seen policies that have reaped the opposite consequences in markets. Do you think that this president is still pro-growth?
I do think he's a business guy. I mean, we all know he's a real estate developer from New York City that was very successful and had times here where, just like any in the real estate business, there are ups and downs. But he has demonstrated the ability in business to create wealth, and I think he wants to do that for America. And so, yes, I think he is. Now, what he's going about doing in reordering our economy and trying to sort of rebalance, if you will, the balance of trade, as well as the burden sharing that occurs with us and our allies, importantly in the financial realm as well as the defense realm.
Although you have a unique position because you wear the hat of both being in government in a leadership position and also talking with tons of companies while being vice chair of MOLIS. Do they have the confidence to invest? Do they feel like they can be expanding right now and have confidence and conviction that ultimately this whole mix will benefit where they're heading?
Well, I mean, I would say, first of all, we're still America, right? I mean, there is still this unbelievable country that we've got with, and we can go through the various aspects of what draws capital and investors here, rule of law, transparency, you name it, innovation, the rest. We're still that. The Trump administration understands, the president in particular has said the biggest asset we've got is this huge consumer market that the world now has tooled up to take advantage of. And he's trying to use that to go in and create a more stable trajectory longer term, both from a fiscal and economic standpoint. So I think, listen, right now as we started, there's a lot of signals that are creating this sort of question on the minds of individuals, whether they are strategics, whether they are sponsors, and how to go about in terms of conducting their business. And that's why I say, again, really, really important that we see manifestation of success. You know, the president's really good at communicating. I hope we can see some communication of success and that people will begin to understand what the trade-off here is.
This is ambitious stuff. Let's finish on this. Governor Youngkin was in your seat yesterday, and we asked him this question. I'll phrase it differently. At the moment, there are two very left-wing politicians in this country filling stadiums, getting support, at a time when the Democratic Party is an absolute mess and support is rock bottom. I get that. But do you worry that if the president isn't successful, that a number of years' time, this pendulum could swing aggressively to the left? If the right can't provide the solutions, does this country seek out solutions from the left?
Look, all I know is the left is so in tatters, and the one pillar that they've got of any kind of unity is so extreme on the cultural side and the design of where they see the world. There is no way that the mass of this country in terms of an electorate is going to adhere to that extreme Bernie Sanders AOC agenda. There is just no way. Now, not to say that there will be unhappiness if we don't see success, again, which is why I come back to the point it's important that we act with, that we see some urgency and acting with dispatch in Washington.
Because you understand the risk here. To bring up the EM example, that you swing between Bolsonaro and Lula, Bolsonaro and Lula, and you start to resemble what we see in Latin America repeatedly.
We are America. We are America. We are not Brazil, right? So we have a long tradition of continued institutional guardrails, protections. We have the deepest, broadest capital markets there are. I still believe that we can get through this. Again, as you said, this is a very ambitious goal that the president has set out to sort of rebalance. It is where we can head, and the fact that there have been some people left out.
Yeah.
And when you talk about these stadiums that are filled by Bernie Sanders and AOC acolytes, it is those people that are looking for the answers, and frankly, a lot of sort of people who feel left out, if they're at those stadiums, they are looking to the president to deliver on the promises that he's made.
It's an ambitious agenda. We've said it repeatedly on this program for the good of the country. We hope he's successful. Eric, it's good to see you. Thanks for dropping by. The former House Majority Leader there, Eric Cantor. Equity futures at the moment just about negative by 0.6% with an update on stories elsewhere. With your Bloomberg brief, it's Danny Berger. Hey, Danny.
Hey, John. The EU Chamber of Commerce is calling on China to make significant changes to its economy in order to avoid further backlash and build economic ties internationally. The chamber said that China's industrial policy framework needs to be changed, urging the country to return to market-oriented reforms to allow Chinese and foreign companies to compete on a level playing field. President Trump has threatened to revoke Harvard University's tax-exempt status after the school refused to change its policies. The university has rejected the administration's calls to make changes to policies, including school leadership, admissions, and diversity. In a post earlier this hour on Truth Social, Trump called Harvard a joke and said the school should no longer receive federal funds. Zoox, the autonomous driving tech company owned by Amazon, is preparing to begin testing its vehicles this summer. Zoox will add Los Angeles to its 6th testing location, laying the groundwork for future commercial services, a company spokesperson said. Zoox was founded in 2014 and acquired by Amazon in 2020. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Appreciate it. More from Danny in the next hour. Up next on the program, consumer caution.
We were already in an economy that was slowing before all of this tariff uncertainty. You're going to see some movement up in the unemployment rate. Sadly, that's a consequence of a higher inflation, less growth environment, and I think that's going to be the case that leads to even more caution on the part of consumers.
In just a moment, we'll talk about the consumer and housing. We'll catch up with Alan Ratner of Zalman and Associates from New York City. You're watching Bloomberg Surveillance.
In case you missed it on Balance of Power.
Governor, I wonder if there's a silver lining in any of this for the great industrial towns of your state from the last century. Syracuse, Rochester. Based on what we're hearing from this administration, they will again have a seat at the manufacturing table. Do you believe that?
I hope so, but we have advanced manufacturing, we have pharmaceuticals. In fact, I was able to lure Micron with a $100 billion investment, the largest in our nation's history, to build semiconductors in the Syracuse area, and they'll be affected by this. The component parts to what they're building and the supply chain, they're going to see an increased cost, not just because they're in New York, but because they're in America. And that's what worries me. There could be a silver lining, as you say. I don't know how old I'm going to be when that happens. I mean, what are they going to do? Start building factories now? And I just don't know. All I know is that people were promised lower prices on Inauguration Day, and guess what? They're going up.
Don't miss Balance of Power live every weekday.
The names that move markets are on Bloomberg.
The labor market is holding steady and we're growing. Unemployment is holding steady. The labor demand is growing. We're seeing that in our companies. We're seeing the investments by major companies, tens of billions, hundreds of billions of dollars, where the workforce, the American workforce, is going to grow. If we grow this economy, if we have positive job growth, people will start to keep more of their hard-earned dollars. They'll start to invest. They'll start to save. And I think you'll see those markets respond.
Nobody covers business like Bloomberg. Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Bringing you up-to-the-minute financial and geopolitical news whenever and wherever it happens. I'm Francine Lacroix in Davos, Switzerland, and this is Bloomberg.
The consumer in focus this morning, 8:30 Eastern Time. U.S. retail sales. Equity futures going into that negative by 0.6%. On the NASDAQ, we're down by 1.3. Under surveillance this morning, consumer caution.
We were already in an economy that was slowing before all of this tariff uncertainty and the implementation of massive tariffs across most trading partners. That's very important. The pillars of the U.S. economy were not collapsing, but they were becoming more fragile. You're going to see some movement up in the unemployment rate. Sadly, that's a consequence of a higher inflation, less growth environment, and I think that's going to be the case that leads to even more caution on the part of consumers.
So here's the latest this morning. Concerns about the economy impacting the outlook for housing. The latest Zalman and Associates home builder survey finding increased buyer hesitancy across the board. Alan Ratner of Zalman and Associates joins us now for more. Alan, welcome to the program, sir. Let's pick up on that. If buyers are pulling back, is that because of interest rates or general anxiety about the economy driven by the policy volatility of the last month?
Hey, good morning, John. Thanks for having me. Yeah, I mean, listen, I think this is a culmination of a really stretched and constrained consumer from an affordability perspective. You know, rates have been elevated now for a couple of years, and the housing market has kind of chugged along in spite of that. And home builders in particular have utilized a number of tools to bridge that gap from an affordability perspective. They've bought down mortgage rates. They've adjusted prices where they could. But I think you're just seeing a very tired consumer right now that has really hit the ropes in terms of their ability to afford that home purchase, given where rates are and what home prices have done over the last several years.
Alan, based on some of what we've seen proposed with respect to both tariffs as well as immigration, how much do some of the ongoing restrictions and uncertainty restrain the profitability and the profitability forecast at some of these home builders?
It's really interesting because home builder gross margins have come down quite a bit from their recent highs a couple of years ago. But the biggest culprit has been rising land costs. And the way the home building business works, home builders need to buy land several years in advance before they're actually building a house and selling a house on that land. So what you're seeing in terms of today's gross margin pressure is really a result of what land prices were doing in 2022, 2023. The good news, if there is some, is that we've seen relatively modest inflation in terms of materials and labor over the last couple of years. And we really haven't seen much change to that more recently. Obviously, tariffs do present a risk in the near term. But the good news is, you know, from a per home basis, we estimate the impact is going to be somewhere between $5,000 and $10,000 per home. And we think a lot of that gets absorbed through the supply chain as opposed to getting pushed down to the consumer.
In the meantime, amid all this turmoil, we were expecting slower growth expectations, pushing down rates, which actually would make affordability better on the margins. We're seeing the opposite after the turmoil of the past couple of weeks, given the sell-off in longer-term rates. We saw mortgage applications come out this morning. They were down 8.5%, which is actually the biggest decline that we've seen going back to late last year. Alan, at what point do you get concerned that if rates stay at these levels on the long end, that could essentially keep this market kind of in paralysis for a very long time?
Yeah, there's no question. I mean, the byproduct of a slowing economy typically is lower rates. So, you know, at least you could kind of see the silver lining there that over time that could be a catalyst to bridge that affordability gap and get the consumers back engaged in the market. But if you have high rates and a slowing economy, that's a double-edged sword for the housing market, and I just don't see any potential growth in the near term in that type of backdrop.
Who's best positioned? What companies in this environment?
Well, we've seen relatively stronger trends at the move-up price points, the more discretionary buyers. These are buyers that are not as impacted by mortgage rates and affordability. A lot of these buyers are either paying all cash or putting down a very high down payment. So companies like Toll Brothers, Taylor Morrison, Pulte, these are builders that either focus on the higher end buyer or at least are diversified from a price point perspective. But frankly, the stock market volatility we're seeing here over the last couple of weeks is giving that buyer some pause as well. So there's really no segment that's immune from the volatility, but on a relative basis, we do feel a little bit more positive about that higher end buyer today.
Alan, appreciate the update. Alan Ratner there of Zalman and Associates. Alan, thank you. That last point there on Toll Brothers, even the upper income bracket has pulled back. Now, he's still confident, but even they've been affected by this, and that's something we haven't seen much of in the past 5 years.
Yeah, the wealth effect has really propelled the upper class to really increase spending pretty dramatically and uphold the whole economy, even though the lower end has pulled back. It raises this question about whether this is a forward-leading indicator or whether the housing market has been in a cycle of its own that's kind of over here that we can point to when we're trying to prove a point and basically say it's an anomaly when we don't want to make that point.
I think it's fair to say it's been in a cycle of its own for quite a while.
I think that's fair.
And not just the last 5 years, that's for sure. Equity futures on the S&P negative here by 0.75%. Coming up next, we'll catch up with Rick Reeder of BlackRock, the United Airlines CEO Scott Kirby, Tiffany Wilding of PIMCO, and Katie Kaminsky of Alpha Simplex. A big hour coming up. Lisa, we're going to be talking about retail sales at 8:30, and then later on in the afternoon, that address from Fed Chair Jay Powell.
How do you price in the unseen? How do you price in feelings that aren't showing up? That is the ultimate question underpinning all of these interviews and all of the outlooks.
The third hour of Bloomberg Surveillance is up next.
In the world of real estate, which is your favorite child, data centers or offices at the moment, in terms of the near-term ability to put money to work?
I think from a value standpoint today, offices are pretty compelling in a place like New York City or San Francisco. Because in New York, you have financial services firms who are growing rapidly. You don't have any new building. In San Francisco, the values fell very hard, in some cases 75%. And AI and technology innovation really housed in San Francisco. And so I think in some of these markets now,
India plans to scrap import tax on US ethane and LPG.
Become interesting. You definitely want to buy more modern buildings. But I still like the data centers too. There, what's attractive is this need for compute power. I referenced DeepSeek, but obviously the cost of compute has come down pretty dramatically. And we think the usage is going to go up. Our lives are migrating online, and I think these data centers are a critical part of that infrastructure. I think margins in companies are going to expand dramatically. I think we're going to use these bots to help us do so many things in our lives. And so ultimately, I think the infrastructure spend against this will be quite significant.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
I've never seen cash machines as lucrative as these companies are.
Just close your eyes and buy.
Many Koreans find this really shocking and unbelievable.
This needs to be a wake-up call for Europe.
You can have only one captain of the ship, and we are the captain of the ship.
You love it or hate it, you can't ignore it.
Insight with Haslinda Amin, only on Bloomberg.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but I can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul
Secured
Rabel.
overnight financing rate 4.36% April 15th versus 4.33% April 14th.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
Do you need a clap?
No, I never heard of it.
Ready? Go.
I'm David Weston. Join me for the next generation of Wall Street Week. This week, faith-based activist investing told through the eyes of Robbie Starbuck. Sports as an investment class, driven in part by the rapid growth of women's professional soccer and basketball, and the challenges China faced long before President Trump's most recent round of tariffs.
At this point, this is a zero-sum game in Xi Jinping's mind.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The market is currently making a major potential reassessment of valuations of U.S. assets.
It's not a necessary sell everything type of an environment.
I have a difficult time seeing where the genuine new positive catalysts are going to come from.
A lot is going to change day to day and week to week.
Uncertainty is high, not just for the economy, but for investors.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning, good morning to you all. The third hour of Bloomberg Surveillance starts right now, and this hour focused on the U.S. consumer, whipsawed by tariffs, sentiment already dropping towards a three-year low, inflation expectations at multi-decade highs. Later this morning, we get a sense of what the U.S. consumer is doing, with retail sales just 30 minutes away. And then this afternoon, Fed Chair Jay Powell addressing the U.S. economy, attempting to offer investors some clarity with very limited visibility.
If you take a page from United Airlines, there are a couple of different scenarios, and you could drive a truck in between how big the gap is between them. There's a real question, not just on what these numbers will reveal when it comes to retail sales, but how the market interprets them, considering that they might not be pricing in the full effects of tariffs and policy uncertainty as they have not trickled out into pricing and other aspects of the economy. On the flip side, from Fed Chair Jay Powell, how much can you really take from his words, given that he doesn't have any more clarity and is trying to message a strong hand to control inflation and look forward into the abyss?
He's pledging to anchor inflation expectations. The decline that we've seen in soft data is notable. The hard data, we're not looking into the abyss right now. He's looking at the hard data and saying unemployment's still around 4%, the economy's okay. And we've heard that on repeat from the FOMC.
You know, Mohamed El-Erian talks a lot about listen to what the companies have to say. And what the companies are saying right now is not dismal. It is not looking into the abyss. It is quite the opposite. It is that other upside surprise type of potential with a consumer that is still spending, concerned, sure, sending in responses to the calls that they get from the University of Michigan saying that we feel terrible. And then they're going out with retail therapy. So at what point can you actually give some credence to the strength that we're seeing coming out of these companies?
We need some therapy from the White House. Will we get it? Negotiations with Japan a little bit later, and just a little ray of light coming out of China. Just a little bit. Based on our reporting that maybe they're willing to come to the table with conditions.
They are responding, according to our report, someone familiar with how the government in China is thinking right now, the CCP. They want respect in terms of stop some disparaging comments coming from cabinet ministries. They want some sort of deal when it comes to sanctions and potentially how the U.S. views Taiwan. I think that's going to be incredibly challenging. And they want something, Jonathan, you said earlier, that Wall Street wants. They want a point person. Now, what else do we see today? Japanese negotiations, and the president himself is going into these negotiations. The prime minister's not there. I think what China needs to start to realize is the point person might be Donald Trump himself.
It is the president. Equity futures right now negative by 0.75% on the S&P 500. Coming up this hour, we'll catch up with Rick Reeder of BlackRock as traders face fresh trade uncertainty. United Airlines CEO Scott Kirby on the carrier's dual forecast, and Katie Kaminsky of Alpha Simplex reacting to U.S. retail sales. That number 27 minutes away. We begin this hour with trade tensions weighing on the tech sector. Rick Reeder of BlackRock writing, taking opportunistic positions in good quality companies in the equity market has and should continue to pay off for investors with longer time horizons. I'm pleased to say that Rick joins us now for more. Rick Reeder, it's been too long, my friend. Let's get straight to it. I just want to understand what you've been seeing with the team over the last week or so? Have the foreign buyers of treasuries been pulling back?
So, I mean, boy, it's been an incredible period. I mean, so, you know, to start with, I mean, the Treasury market, the move back in the Treasury Friday was extraordinary. This pressure on the Treasury
According
market.
To a statement, Rubio and
concern
Witkoff
about
are to travel to Paris
selling,
April 16th to the 18th
that was
for
pretty
Ukraine
amazing. And then we
discussions with
bounced back
Europeans.
pretty nicely as some calm has come back in. And then, you know, the volatility in the equity market, the daily volatility, a little bit calmer this week. Does present,
So welcome
you know,
everybody
similar
to
what I
the
said
US
there
session. Now
before.
let's go
It
through
does
the
present some
sentiment, what to
opportunity
expect
in
for the
these
day ahead.
markets. It is,
Risk
I will tell
aversion
you,
weighed
the
on the dollar and
uncertainty,
increased
though,
demand for treasuries
has led
ahead of
to
a speech by
liquidity in
Fed
these
Chair Powell.
markets. That's
The
pretty
dollar
rough
index
right
fell as
now.
much
When
as
you go to
0.6%,
execute, you gotta
hitting
be
a
very
fresh
thoughtful and
six-month
very
low
tactical about
after
how you
Trump
do it,
launched a probe into
because
the need
markets
for
are
tariffs
very
on
jumpy
critical
and very
minerals.
uncertain these
Also
days.
called on China to reach out to him
liquidity is
to
the Treasury market.
kick off
Deep,
negotiations aimed at
predictable.
resolving the
That's where
escalating
people
trade
buy
war.
treasuries.
The gauge
Rick,
slightly
can I
paired
get your
losses
view on what
after
you
China
think was
said it
happening
wants to
last
see a
week? Do you
number of
believe that
steps
was foreigners
from the
pulling
US
back? Is there
before
a
it will
question
agree
mark
to
over the
trade
US safe
discussions.
haven status?
Tech
Or
stocks
is that just
declined as
certain
new
trades
US government
unwinding, things
restrictions
blowing
on
up?
export of NVIDIA chips
It's
to
a great
China
question.
and a
So first
disappointing
of all,
report from
you know, when you
ASML
have this
fans
pressure on the
trade war
currency
concerns,
market, and by the way,
wiping out
super acute, you think about equities
$155
going
billion
down
in
the
market
same
value
time that
for
the
the two
currency is going down.
companies alone.
Usually the dollar appreciates
On the
when you're
docket,
in
we have
this
retail
risk-off
sales
mode.
at
So
the
you've
bottom of the hour at
unquestionably
8:30
seen
a.m. Eastern
the
Time.
pressure on equities and
9:15 U.S.
international
industrial production
disposition
for March.
of the equity
Bank of
a
Canada
number
rate decision
of
where
U.S.
they
equities.
expect to keep the
In
rate
the rates
unchanged at
market, it's a bit more
2.75%
blurred,
at
but there's
9:45
no
a.m.
question
Eastern Time.
about it. There
Then
is
we
some
get the
concern.
Bank
We
of
fund so much
Canada
of our
monetary
treasury
policy
debt
rate statement.
internationally.
10:30
There is some
a.m.
concern
we get
with
the
currency
crude oil inventories.
depreciating. And
1
then,
p.m.
quite
we get
frankly,
the US selling
back end of the
$13 billion
curve,
in 20-year bonds.
going through these
10:30 we
periods of
get the
spasm
speaker-wise we
where
get the Bank of Canada
inflation is
press conference
higher.
with
You know,
Macklin
even
following
if
the
the
rate
Fed
decision.
cuts, what does it
12
do from the
p.m.
back
we
end?
get
There's an
Fed's
argument
Hammack
that when the
speaking
Fed cuts,
and
the back
Fed's
end
Powell
becomes
speaking at
less
1:30 p.m.
tethered.
Eastern Time
And in fact, you
to
get a
the
steepening
Economic
of the
Club of
curve.
Chicago
So,
about the
yes, I
economic
think
outlook
there's
where
some
text and
international
Q&A is
disposition for
expected.
sure as the
As is
currency
for heads,
weakens.
Fed's Hammack
But I think
at
broadly it's
12
this
p.m. as well.
uncertainty, and
Good
it's
luck.
just hard. You watch days like Friday, you know, it's just hard stepping in, particularly in the back end with this uncertainty still out there.
So, Rick, at what point would you step in?
So I like owning the belly of the yield curve, and I like owning, you know, the front end has gotten pretty well priced. I mean, you've got to, and I think the way you all described it, you know, the Fed, you're pricing in an awful lot of cuts for the Fed this year, and you haven't seen that hard data deterioration. I do think you'll see that in labor over the next 2 or 3 months. You'll see some pullback of probably some significance in places like healthcare and education, leisure and hospitality, but we've got to see it. But the belly of the yield curve, there are some opportunities. And quite frankly, Europe is more interesting because you don't have the inflation impact in Europe. The ECB's got to cut more aggressively. So I actually think, where we've seen some real opportunity is actually European rates. Very different. And by the way, you don't have the international disposition there. In fact, that's where you have, it's probably international, I'm sure, you have international buying. So European rates is a place recently we've liked quite a bit.
Can we take this a step further? You talk about how U.S. Treasury markets tend to be the deepest, most liquid, and then you talk about how rocky liquidity has been and how execution risk has become an increasing consideration for you. Have we gotten to the point where on some of these days, the European rates market has actually been more liquid than the U.S. rates market?
Good question. I mean, so more liquid, I don't know if more, certainly the back end of the yield curve, it takes price to get execution. I don't know if it's more liquid. It certainly feels to me like you have this ballast of, you've got an ECB moving, you've got a yield curve that's already pretty steep in Europe. And by the way, if you're a dollar investor, you get a cross-currency swap benefit. And because the curve's so steep, you roll down. So, there are a lot of reasons why I'm sure others, as well as ourselves, have felt like, gosh, it's a safer place to be, even though you're going to get European funding of fiscal initiatives over the next couple of years. That just takes some time. But I don't, I still say the Treasury market generally is much deeper. But Europe, you definitely see more buyers coming in internationally as well as what we see in the States.
Rick, it seems like the picture that you're painting is a regime change. The picture that you're painting is shifting away from the United States and following a real flood of money into some of the overseas markets, and frankly, not betting that the long end of the yield curve will provide the ballast that it has in the past. Can you talk about what else has changed? Does this really undermine or reshape the way you look at 60-40 or the position of gold in your portfolio?
It's a great discussion. That's a long discussion. A ton has changed. Like you say, we've added in the portfolios, not in our fixed income, but other portfolios, we've added gold. We think gold is a good hedge generally. Quite frankly, you have to, during periods like this, you tactically hold more cash in the portfolios. We've done that. Back end of the yield curve and interest rates and as a hedge when you've got inflation moving potentially significantly higher, not really a big benefit to the portfolio. So, and then the other one, when you get rates backing up, you can get your yield much more attractively using high quality assets. So even though, you're some pressure on parts of the high yield market, pressures in the lev loan market, you can actually still create them in one of our ETF, this BINC ETF. We're able to create over 7% yield and actually improve the quality of portfolio, run more cash. That becomes super attractive. As long as you're not stretching, go down the credit structure into the triple C rated high yield, you can actually create more yield today. So I like the idea, build some more cash, use some tools that are different than in the past, and then, quite frankly, just get higher quality and more liquidity in the portfolio.
Rick, do you think the rhetoric around the fact that some investors are saying they're dumping dollars, dumping treasuries, that the U.S. is losing safe haven, reserve asset level, do you think that rhetoric is overblown?
I'd say sentiment can change really quickly. I mean, we're in this period now where there's clearly a concern about the currency, and there's clearly a concern about how do we bring the debt down, how do we get interest rates down. So I'd say near term, there is a question. Listen, I think reserve currency status is something that is absolutely critical to the United States. We fund a lot of debt globally. The number of the percentage of trades in the world that happen in dollars, bills as a collateral for many of the transactions in the world. I think reserve currency status is absolutely critical. Are you denting it? You're definitely denting it. But listen, I think this year is going to change. I think we've got a couple of months here where there's a lot of uncertainty. You got an economy that's probably in recession today in terms of certainly where corporate spend will be. But I think as you get into the back half of the year, things can really evolve. So listen, I think you're chipping away at reserve currency, but I don't think there's a natural alternative. So, I think things can change. Hopefully they do.
Rick, hopefully they do. But that last point there I think is important. If we are in recession today, do you think risk assets are appropriately priced for that scenario?
So I would say today, listen, I think the tail has gotten fatter. I think quality assets, they're pretty reasonable. There's a lot of quality assets we've been added to agency mortgages, et cetera. Listen, I think you've got to put a wider range on the equity market today than you've had before. You've got an economy that's pretty uncertain. And you've got to, I think you got to keep your beta a bit more restrained today. Quite frankly, one of the most interesting trades in the last couple of weeks has been to sell puts, not to necessarily increase, but the best time to sell insurance is after a hurricane. And there've been some great trades actually sell downside where, gosh, if we go down another 10, 15, 20, depending on single name, go down 10, 15, 20%, you get paid handsomely for taking that. So keep your beta restrained, hunker down a bit in terms of risk, but then find some place like, gosh, I would add if we came down, if markets went down significantly. So anyway, there are a bunch of things to do in this market, but I just think you have to expand where you think your return objectives are going to be and the probability around it in an environment like this.
Things have changed a lot. Rick, it's good to see you, as always. Rick Reeder of BlackRock there. Rick, thank you, sir. We'll do it again soon. Equity futures on the S&P negative here by 0.8%. Let's get you an update on stories elsewhere with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. China says it's open to trade talks with the U.S., but only after President Trump meets its requirements, like reining in remarks from his cabinet members. Sources tell us that other conditions include a more consistent U.S. position and a willingness to address China's concerns around sanctions and Taiwan. The White House is banning NVIDIA from selling its H20 chips in China, a clear sign that the administration will stay on the course on limiting China's AI ambitions. The restrictions will require a license to export the chips for the indefinite future. NVIDIA warns it will likely report a $5.5 billion write-down tied to inventory and commitments. Elsewhere, the White House has opened a probe into the need for tariffs on critical minerals, citing national security and resilience concerns. The order covers a range of minerals, including rare earth elements and uranium, and could lead to tariffs on imports from countries like China, which currently supply 70% of U.S. rare earth imports. And that's your brief. John.
Hey, Danny, thank you. More from Danny later this hour. Later this hour, U.S. retail sales. That drops at 8:30 Eastern Time. Up next, the Morning Calls, plus the United Airlines CEO, Scott Kirby, on the airline's dual forecast. That's next. This is Bloomberg. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
We give longer term money. Our loans are anywhere from 20 to 50 years in length. After I came, I got our board to approve 50-year loans for things
Can I get one of those 50-year loans? I'd like to get one of those.
Absolutely, although you'll have to be around to enjoy it.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
This hour is all about the U.S. consumer. Consumer sentiment, according to the University of Michigan survey put out on Friday, close to a 3-year low. Inflation expectations, multi-decade highs, and anxiety about unemployment at levels we haven't seen since 2009. That's how people feel. What are they doing? Retail sales, 15 minutes away. Equity futures on the S&P negative by 0.75%. On the NASDAQ, we're down by 1.4%. On the Russell, we're a little bit lighter, only down by about 0.25%. Let's get you some morning calls. First up, Piper Sandler lowering its price target on Nvidia to 150, citing new export restrictions from the Trump administration. Your second call from Goldman, downgrading target to neutral. The analyst saying tariffs and the inflation outlook are taking a toll on consumer sentiment. And Target right now is down by about 1.2%. Overweight on United Airlines, expecting forward guidance to reinforce U.S. airline optimism. The stock is up by 6% in early trading. Let's stick with United. The airline reporting its best first quarter
Secretary of
performance
State
in 5
Rubio
years
and
and
Ambassador
offering
Witkoff
investors
traveled to Paris April
forecasts in the
16
face
to
of
2018
uncertainty,
for
writing
discussions
in a
with
statement,
European
the company's
counterparts
outlook is
regarding
dependent
Trump's
on the
goal
macro
to end
environment,
the
which the company
Russia-Ukraine
believes is impossible to predict this year with any degree of confidence. Joining us now, the main man, the United Airlines CEO, Scott Kirby. Scott, welcome back to the program, sir. It's good to catch up with you once again. Let me just understand maybe your approach to this earnings report, how you and the team decided, you know what, this time I think we have to do something different and offer a dual forecast. Where did that come from, Scott?
Yeah, we did. We thought it was appropriate to do something different. It starts with, you know, the environment has gotten more difficult. But first, you know, we did have, you know, as you said in the intro, the best margins we had in 5 years. We grew margins year over year. One of only 2 airlines that are profitable. And as we kind of went through it, we still see a viable path to getting to our, as long as bookings remain stable as they are today, to getting to our original guidance. But we also recognize that there's more macroeconomic uncertainty, that people are fearful of a recession. It hasn't happened yet, but that they're fearful of a recession. And so we wanted to also give investors some outlook on what we think a recession could look like if it happens here at United. So really the goal was to just give investors more information. It's non-traditional. We're the first ones that I ever know of that have done something like this. And so far the feedback has been really positive. And I think investors and others appreciate that we try to give them a more fulsome range as we gave guidance this time.
Scott, can you give us a sense if you were catering more to investor nervousness or whether you were responding to actual weakness that you see in some of the forward bookings by clients?
So I'm guessing you're referring to our capacity changes. And, you know, we're going to pull about 4 points of capacity from the second half of this year. That's really just a pure tactical economic decision. We do see weakness, and because we see weakness, it means we're starting to cancel some of the utilization flying. That red-eye flight that was barely profitable in really peak strong times becomes unprofitable when the demand environment weakens a little bit. Customers have more choice to fly at better times a day, and so they do. And so all we're really doing tactically is pulling some of that marginal flying, marginal in good times turns negative in bad times. So we're just pulling that out of the system.
How much do you see going forward, though, any kind of retrenchment from consumers whatsoever? A lot of people have been talking about how particularly international travel is going to come down with people from overseas not coming to the U.S. Are you seeing that in forward bookings, or has that kind of been more of a narrative than a reality?
It's been more of a narrative than a reality. We saw weakness starting kind of at the end of January. We saw a step down, but it has stabilized in March, and even the first 2 weeks of April, it has stabilized. And the weakest area we see is actually
10 minutes away from the
low-end
bottom of the hour, we
domestic
get retail
consumer
sales
here
data
in
for
the
the US
United States.
forecast
International,
for the month on month,
has remained quite
1.4%,
strong.
prior
International, for what it's
0.2%,
worth,
with a
is
range of 2%
82%
to
US point of
0.2%.
sale.
Core
So it's much
retail
more
sales
dependent
month
on
to
the
month
U.S. economy
forecast
than
0.4%,
foreigners coming to the United
prior
States.
0.3%,
It's also less corporate
and
than
retail
it used
sales
to be.
year on year
And
prior
because of that,
3.11%.
the leisure traveler is still going. The premium leisure is still there. Typically, even in times of economic weakness, the high-end consumer outperforms. And that's what we thought would happen. That's what we've seen so far. We'll keep watching it, of course, but that's certainly what we've seen so far.
How much does this really put you in a position to consolidate market share? Right now, we keep seeing that among a lot of the leaders in different industries, that this is time for them to compete on price, to compete on some of the offerings, and frankly, squeeze some of the other weaker players in the market so that you emerge on the other side a lot stronger. Do you see that happening with United right now?
Well, United, we've had a 5-year strategy to win brand loyal customers, and we've done that. So really nothing is changing at United. We're not doing anything incremental, anything different. We're continuing the path that we have been on because it's worked. It's led to the best margins in good times. I think that lead is going to expand in tough times, not because we're doing anything special, but just because we'll have more seats to sell available to those customers. And when you're the brand loyal airline, when times get tough and you have more seats to sell, more customers migrate to you. And so we'll wind up selling more seats at lower prices because that's the way our yield management system works. But we'll sell just as many seats, but it's going to make it much harder at the bottom of the customer choice pyramid.
Scott, as you know, there's a lot of tension right now between the United States and China. That's been expressed in several rounds of tariffs from either side. We hope they can come to the table and have some talks, but so far, not great. For the maintenance of your planes, sir, and the exposure that you have to China, to Hong Kong, how are you managing that situation at the moment?
At United, we have more of our heavy maintenance work done here in the United States than any airline in the country. We've been growing
Iraq
here
plans
in
will
the US.
export
In
cut
fact,
amid
over a
pressure
3-year
to
period,
reach
we're gonna hire
OPEC
about
plus
5,000
target.
maintenance
So Iraq
technicians here in the
plans
United
to
States,
cut
building
crude
huge
oil shipments by
facilities
70,000 barrels a day
Houston
in April.
and in Orlando. And most of our work is done in the free trade zone outside of Hong Kong, the work that is done in China. So we're monitoring it day by day, but we have a high percentage here in the United States, more than anyone else, and feel good about our setup.
Scott, some CEOs have been quite outspoken about what they'd like to see from the administration on policy. Are you willing to do that? Is there a reason why maybe you'd be a little bit more hesitant to weigh in?
Well, I've spent a lot of time in D.C. This year, as I always do, but I've mostly been focused on listening instead of talking. And so I wanted to understand where the administration was coming from, what their goals were, how they were trying to get there. And I actually by the end of March, felt like I had a pretty good understanding of that. And if you have that kind of understanding and you can put everything that's happening into context, it makes it a lot easier to manage the business, to not make panicky decisions. And what I think is happening here is, we're nowhere near the end game yet. These are still the opening moves of the chess game. And I think I and most people that I talk to, or things have slowed down, but we're all in a kind of a take a breath mode. And let's wait till we get to whatever the new normal is going to be before we start making big long-term decisions.
We've all got to take a deep breath. Your stock is up this morning by about 6.5%. I wanted to talk about something with you that we've been talking about for a while on this program. Scott, as you know, one of the most disruptive parts of flying right now is the boarding process. And when you get on, everyone is wrestling to find space to put their bag over their seat. How do we address that situation, Scott? Because I can tell you as a traveller, it is the most annoying experience, and it's not unique to United. It's something we're seeing across the board.
As a father of 7, I understand it, trying to get on with a bunch of kids. And I'd say we're fixing that at United. The biggest thing we can do, we had to put bigger bins on the airplanes. We're over 50% through the fleet at United, but we're putting bins on all the airplanes that are large enough that on a 100% full airplane, every single customer can bring a rollerboard on and put it in the overhead. And I think that, at its core, is how we're going to solve it.
Scott, how much more can you get people to pay for things that they used to know they could get? I know that Frontier used to do that with cans of soda, and then they had to backtrack, or checking bags. Are there other things that you can monetize, or does it really come down to the credit to card business,
in discussions
the
with Yemen
loyalty
forces
program,
on land offensive
counting on the
against
front of the
Houthis?
cabin?
At United, actually, we're kind of going the opposite direction. We have disaggregated the product. Give customers what they want. If you want the premium product, you can get it. You can go the regular economy product all the way down to basic economy. But, you know, we got Starlink coming next year. We're going to have the fastest Wi-Fi in the sky, and that's
10
going to be
minutes
free
away from,
for our customers.
5
So
minutes away
Wi-Fi
from
is
the
going to
retail
be
sales
free, and it's going
data
to be by far
forecast
the
for month
best
on month,
experience,
1.4%
the
prior,
most bandwidth,
0.2%,
best speeds,
core retail sales month on month
for
forecast,
any customers. And,
0.4%
you know, in
prior,
a lot of ways,
0.3%,
increasingly,
retail sales year on year
instead of
prior,
being an airline that also has a
3.11%.
loyalty business, we are becoming a loyalty business that runs an airline. I mean, being able to get customers to Tahiti and Cape Town, that's the cool, sexy reward that you get in the loyalty program. But, you know, the large airlines, particularly like United, you know, we really have the best, the deepest loyalty program. When I talked earlier about brand loyal customers, like customers that want to fly United Airlines. And that is the strength. That's what's given us the resilience to have strong earnings, even in a tough macro environment. It's what's going to let us outperform even if the economy gets weaker from here. That loyalty of customers, whether you call it the loyalty business or just having brand loyal customers, is the foundation that's letting United outperform.
A masterclass in communications from the firm in the last 24 hours. Scott, appreciate your time. Thank you. Scott Kirby there, the United Airlines CEO. Up next on the program, US retail sales. We know how the consumer feels. How are they spending? We'll talk about that next on the program. This is Bloomberg.
According to Xinhua, China's vice premier vows more support for foreign trade.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by
1
more
minute
than
to go now.
3,000
We'll lead with the retail
journalists
sales
and
month on month.
analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
He Li Feng says China is a trusted trade partner.
The markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
10 seconds.
Equity futures on the S&P 500 negative here by 0.75%. Retail sales just seconds away with the NASDAQ down by 1.4%. In the bond market, your
Core retail
2-year,
sales month on month
10-year and
0.5%,
30-year look like this.
0.5% higher than
Your 10-year yield
forecast
just about
of
unchanged at
0.4%.
4.32. Your 2-year at 3.80.93.
Just waiting on the retail
The
sales
spread
and year-on-year
between
data.
the soft data and the hard data is incredibly wide. Survey data, consumer confidence, rock bottom. What do retail sales look like? Here's Mike McKee. Good morning, Mike.
Good morning, John. They look pretty good. They look exactly as economists had forecast, coming in up 1.4% for the month of March. We got to check the revisions to February. Ex-autos, though, up a little bit more than thought, 0.5%, but it does show that a lot of the spending was on cars, people getting ahead of the Trump tax increase with
Seeing
that.
the prior revision come through for core retail sales month on month
into
to
GDP,
0.7% from the original prior of 0.3%.
That is down from 1.3%, revised up for February. So
China says that we're aware certain goods exports to the U.S. reach 245%
we don't have a revision, it appears, to the advance headline number, 0.2% in February. So 1.4% and 0.4% on a 1.3% revision. So is the control group, and that's the baseline numbers. Shows people were pulling ahead purchases ahead of the Trump tax moves.
So, Mike, you don't think this points to strength as we approach the April data, which is going to become more important to see how this effect from tariffs starts to bite into the economy?
I don't think we can say that at this point. Now, I need to take a look at what the breakdown is, but the expectation was people would.
Also, China says we will ignore numbers gained by the U.S. So again, China says we will ignore numbers gained by the U.S.
Change in terms of overall purchases for consumers, and it does look like a lot of that came from cars. Now, the March advance in motor vehicles was 5.3%. So a very strong
out the retail sales
motor
for the
vehicle
US March
sales
report
month.
on the financial news feed.
Building materials up 3.3%. Food and beverage stores
China
kind of
repeats that it will
light,
fight
0.2%
till the end
8%.
if interests
but
are
gasoline
harmed.
stations were down 2.5%. So you can see the impact that the car sales had. They overcame the fall in gasoline prices. General merchandise stores up 0.6%. And of course, we always want to know what happens to non-store retailers. They didn't have a great month, up just 0.1%. Food services and drinking places. We all went out and celebrated before the taxes went up on imports. 1.8%.
China's Vice Premier Yi Li Feng says China has a very large market and huge consumption potential. It provides a broad space for the import of high-quality products from other nations.
After spending money in February, the question is,
the
do they
S&P
keep that up
500
now
E-minis
in
down
April?
0.7%. Nasdaq 100 E-minis down 1.35%, and Dow E-minis down about 0.1%.
Of 1% on the NASDAQ, we're down by 1.45. In the bond market, 2-year, 10-year, 30-year yields just about lower by a single basis point on a 10-year to 4.32, down by 3.81 on 2s. Lisa, we've heard this conversation before, the pull forward in anticipation of tariffs in April. It was always going to shape that March data in a certain way.
It was. It's hard, though, to really reconcile that with the upside revisions that we saw for February. It's not just March data coming in stronger than expected, at least when you look at retail sales, ex-auto and gas. It's also that it was revised up to 0.8% for February from 0.5% initially. You see the same when you look at ex-auto. So there is something else going on in terms of ongoing strength that becomes that much more difficult to know how to read some of the soft data, which, again, is not cohering with what we're seeing in this hard data.
Let's get into this subject with Tiffany Wilding of PIMCO. Tiffany joins us now from the West Coast. Tiffany, welcome to the program, and thanks for waking up so early for us as well over in Newport
China's
Beach.
Vice Premier
Let's talk
Yi
about
Li
this
Feng
data.
encourages
Tiffany,
foreign trade enterprises to make good use of the Canton Fair platform,
and we know it was rock bottom going into
explore
that April 2nd
diversified
tariff
markets.
announcement. How wide is the gap between what people are saying about how they feel and what you're seeing on the ground happening in the economy?
Yeah, well, I mean, I think the conversation that you were having about pulling forward purchases ahead of tariffs, I definitely think that is boosting demand for goods and retail sales in particular. And I think it was a longer story than just March or February. You know, even though we got many of the we started getting more of the tariff-related announcements in March. Obviously, the big ones were in April. When we look at the data, we see above-trend purchases in goods that really started late last year, in the second half of last year. And so we think actually consumers have been doing this for quite some time. If you look at the sentiment surveys, you also saw inflation expectations that started to rise late last year as a result of tariffs. So we do think that it's going on. Any given month can be noisy, but basically what that suggests is if you're getting a pull forward of purchases here, you know, regardless of what happens in actual tariff policy, you know, if tariffs weren't actually implemented, you know, you should see some softness afterward just because, you know, consumers had all this pull forward activity.
Tiffany, there's a larger question here about how much we can rely on hard data, given the soft data, or how much we can rely on soft data, excuse me, when the hard data really isn't confirming the negativity that we're seeing in that soft data. Can you just step back and, as an economist, speak about how much you can rely on the narrowing of the gap between these two metrics, these two inputs?
Well, I mean, I think that, you know, you have to start to see the actual price increases, which we have. There's been many more of these tariff surcharges. Consumers are actually starting to feel the tariff impact now as we're speaking. So I think you could see much more of this, you know, in the data ahead. You know, March was just kind of the precursor to all of the April news. And then I think the other big thing that we all need to watch is just the imports data. The amount and the level of tariffs that we have on China, for example, you know, should over some time, if that is not reduced, basically leave our, you know, reduce our imports from China to basically zero at some point. And so how quickly we see that happen will give us a sense for the disruption in the U.S. economy that's going to happen. You know, obviously looking at the price data will be very helpful, but I think until consumers start to see that, they won't, you know, they're not exactly changing their behaviors yet.
Retail
They're
sales year-on-year,
trying
forcible 6%,
to pull forward
forcible 6%.
some purchases, but you know that the weakness will come, you know, once we see the other actual effects.
So Tiffany, is it fair to say that what we're seeing right now in the March retail sales isn't incorporating some of the policy shifts that have really affected sentiment?
Yeah, I mean, we certainly haven't seen, we didn't see any evidence in the, we haven't seen any evidence in the inflation data, you know, that you're getting massive increases in prices. You know, I would say if you squint, you know, maybe in some certain categories like appliances and things like that, you've seen the auto dealers basically say that we're not going to raise prices until we,
China's rise
until
Premier
we get
Li
through
Feng
the current inventory.
urges
So
relevant departments and localities to work to improve business environment and implement support measures
at these lower prices right now. You know, so I think you're just not, you know, we are in the early stages of this. I think the April, May, you know, over the summer, once all of this really starts to sink in, you start to have stockouts of certain goods and things like that. You know, that's when you're going to see more of a reaction from consumers, I think.
Tiffany, at the moment we're seeing good hard data. You have negotiations taking place even today with the White House and trading partners. What does the Fed do with all of this, especially as we have Jay Powell speaking later?
Yeah, I mean, I think this puts the Fed in an incredibly hard position. I think, you know, obviously you have this outlook for inflation to accelerate, and that's shown up in inflation expectations. I know the Fed has you know, dismissed the increase across, you know, most major surveys in inflation expectations, including the U of Michigan report, which has a longer-term measure. You know, they've sort of downplayed that or dismissed it. The survey of professional forecasters from the Philly Fed is a key measure that they will be looking at. We will get that in May ahead of that FOMC meeting. You know, and I think if you start to see that longer-term inflation expectation measure accelerate, you know, then that can be a bigger problem for the Fed. And we've said we think it constrains them. And when we say constrains them, what we mean is that we think they really need to see the labor market, you know, really cracking here. Unemployment accelerating, job growth that's turning negative for them to, you know, to respond. That 2018-2019 COVID-19 type of response that was more preemptive. They expected weakness, so they cut ahead of that. You're not going to be able to see that from them this time. So it's going to be more delayed, but that means once they do start cutting, they do start to see that weakness, that you could see, a much more swift response, although more delayed.
Tiffany, is there a metric you have in mind? Unemployment at the moment of 4.2. Is there a number that you think would trigger that moment for them?
Yeah, I mean, I think, and I think the speed here is key. If you're seeing unemployment that's accelerating up to 4.5 or above pretty quickly, within the context of a few months, at the same time, you're seeing, retail sales and consumer spending collapse. You're seeing imports collapse. All of those things, I think, would contribute to them cutting rates. I think in terms of the data flow and when their meetings are, I think May is probably too soon. Like we've been talking about, the actual brunt of all of this, is likely going to be seen in the data, in the early summer to even midsummer. So I think June and maybe even the May and maybe even the June meeting is too early to really start to see the labor market effects. We think it might be September before they could really get a good read on all of this.
Interesting. Tiffany, appreciate the input. Thank you. Tiffany Welding there of PIMCO. Tiffany going through it there for the Federal Reserve that unlike last year where they could act preemptively, the first time of any kind of crack, the first sign of any cracks whatsoever in the labour market, they moved aggressively 100 basis points. So this time around, it's basically a commitment to being late. If you're waiting until September, you're waiting for unemployment to go north of 4.5%. A lot of people would say you're already late.
Right, which again goes to this question of how much can they signal, considering if the market will get out in front of them. They want rates to give some sort of downward pressure to inflation when it is coming up and inflation expectations over the long term. As I was listening to Tiffany there, I was thinking, okay, so they're going to cut a full percentage point in September? Seriously. I mean, if it really does weaken, at what point are they ready to step in with some really serious
The good news for Chairman Powell later on this afternoon is that we don't see that weakness yet. Seeing the survey data, sure. We've seen it in the markets and they've taken note of that, but we don't see it in the retail sales number we just got 10 minutes ago.
The good news for him is that expectations are very low and that really people are not looking for any signal from him, and they understand that it is a black box that he is in with a blindfold, and that his job is to be a politician and to be something of a messenger of calm, steady, and not overreacting in any which way.
You'll get some version of that at 1:30 this afternoon, so look out for that. Katie Kaminsky of Alpha Simplex joins us now for more. Katie, welcome to the programme. We caught up with Rick Reeder of BlackRock earlier on this hour. I wouldn't call him a bear. He was more constructive in the long term, but short term he was cautious. He was talking about a gold position, building up cash. He was talking about being in a recession as we speak. Katie, what's your approach to this moment?
So this is a good question, because right now what we're seeing is that technical signals have really sort of stepped away. There's very little direction in the market at this point in terms of what we're seeing in our signals for both bonds and stocks. This concerns me because it really doesn't seem like there's any sort of catalyst that is going to change that narrative very easily soon, just given the complexities of negotiations in this particular trade war. I'll say there's a few exceptions, and that's why this is an interesting point with retail sales today. Commodities have been interesting, especially energies, and you've seen some other exceptions there like soybeans that have really rallied as a function of the trade war impact. So gold, metals, energies, agriculturals are places to kind of look around right now that things are moving.
Before we dig into commodities, Katie, I am curious your view on trend following strategies at a time like this of incredible policy uncertainty. Do they kind of lose their relevance, at least in the short term, because there really isn't a trend to follow other than maybe a truth post?
This is a very good question, and we actually wrote an article this week about it, about crisis or correction. And the reason that we examined how trend following does during different drawdown periods for equities is that those initial drawdowns, when there's a shock, often do create a dispergence of trends that are actually quite hard to follow. And it's usually the aftermath of changes in macro policy that provide more opportunities. So I think the way that we're thinking about it is, what are the long-term trends that will occur as a function of us realizing the impact of this policy? But yes, you're correct. Any sort of short-term shock is very difficult for a lot of systematic strategies and other strategies that are following sort of prevailing themes going into a massive shift.
I don't mean to put you on the spot, Katie, but there is some speculation out there that some of these trend following and systematic type strategies are behind some of the volatility or have actually exacerbated it with leverage unwinding and positions that get stopped out and a lot of trends that completely got reversed in just a matter of hours or minutes. Do you believe that? Do you think that that actually has been a contributor to the incredible volatility that we've seen?
Well, I'd say, I think it's hard to say that just one particular strategy is driving all the volatility. What we have seen is that across the board, de-risking occurred. And that occurred not just in systematic strategies, but in long-only investors and retail investors. So I do think that, the de-risking that does occur when there's a shock is something that people have to think about. And it's something that, when we look at trend, for example, it's actually something that is measured and controlled, whereas in certain strategies, it could be much more aggressive.
Katie, Rick Reeder said what we could see maybe is a dent with the U.S. dollar in terms of a global reserve currency. Do you buy that?
We're actually seeing a little bit of that right now, and I think that's something that's interesting. Let's just take a little step back at what we've just seen. First of all, we had equities take massive losses, but at the same time, the dollar has not been stronger. So if you're actually trying to improve your trade balance, it should be pro-dollar. It means that, you're actually seeing potential weakness of U.S. assets. And you've seen that in the Treasury market as well. Look at both Treasuries and the dollar. They both got hit by sort of this risk-off move related to post-Liberation Day. And that to me is a suggestion that the appetite for U.S. assets could be something that is a question, making both the dollar and U.S. Treasuries more vulnerable going forward as you try to navigate this new policy.
More than 2/3 of transactions, though, in the world come and stem from, or at least on the margins, hit the dollar. Who fills that void?
That's a good question. I mean, I think as that starts to shift, we have seen things like the yen, the euro, other sort of currencies rally in response to this type of move. It may just be sort of a preliminary thought question about sort of what happens if the dollar loses some of its strength, where do we go? But right now, the data is showing that, the yen was the beneficiary of this, and so the euro. And I think that narrative will change as we learn more about how much of an impact this policy has.
Things can change quickly, that's for sure. Katie, appreciate the update from you. Katie Kaminsky there of Alpha Simplex. You can get wrapped up in the emotion and the drama down in Washington, D.C., or just attempt to call balls and strikes. Just now, looking at where things are, corporate America's doing okay. If you look at the earnings we've had from Wall Street, from United Airlines, things are better than we anticipated only a number of weeks ago. And I would say the same applies to trade too. April 2nd, they were talking about going big, large, aggressive, a huge global realignment. In the last week alone, I'm hearing more about negotiations and exemptions. That is a very different position compared to where we were only a few weeks ago.
And there's actually a connection between these two. If you take a look at some of the polls coming out of CBS and YouGov, as well as a whole host of others, what you see is, yes, a majority of Americans are concerned about the potential of increase in tariffs and inflation, but they do think it's a negotiation. And they do think that there does need to be change. I mean, there is a difference between some of the taking things to the worst case scenario versus what people are actually doing and how they're taking it in terms of the messaging at home.
This is an ongoing process. We'll continue to follow all the news as it comes in. On the S&P 500, we're down by about 0.9%. The earnings report of the season, though, I have to say, I think is going to be Apple. 1st of May. That's got to be the big one, right?
What kind of range are they going to give? Potentially zero or potentially,
A bull case, a bear case, a base case?
Yeah, I mean, they're going to be in a particular tricky situation because they're going to have to also be messaging their earnings to a specific person. So a lot of what we're hearing right now is also messaging. As people say, look, we're with you, we got you, we're going to give you what you want, please give us what we want.
You're not talking about investor relations, are you?
Well,
you're talking about White House relations.
100%, and when you hear it across the board, people are speaking directly to one person again and again.
Tech earnings a few weeks away. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Just to recap the most recent data, March U.S. retail sales came in line with estimates with a headline number of 1.4%. It's the biggest increase in more than 2 years, driven by a jump in car purchases, suggesting that consumers are scrambling to get ahead of auto tariffs. Elsewhere, President Trump said that he will attend a meeting with Japan to discuss tariffs, military support, and trade fairness today. In a post on Truth Social, Trump said U.S. Treasury and Commerce secretaries will also be in attendance. Japan is one of the first countries to negotiate the levies. Lyft is expanding into Europe. The company has announced it's buying Free now for about $197 million from BMW and Mercedes-Benz. The taxi-focused mobility platform operates in over 150 cities in 9 countries across Europe. The transaction is expected to close in the second half of this year. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. One big event still to come. Chairman Powell later on this afternoon. We'll get you a preview with Mike McKee in just a moment. From New York, this is Bloomberg.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is a trillion-dollar game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
The names that move markets are on Bloomberg.
The labor market is holding steady and we're growing. Unemployment is holding steady. The labor demand is growing. We're seeing that in our companies. We're seeing the investments by major companies, tens of billions, hundreds of billions of dollars, where the workforce, the American workforce, is going to grow. If we grow this economy, if we have positive job growth, people will start to keep more of their hard-earned dollars. They'll start to invest. They'll start to save. And I think you'll see those markets respond.
Nobody covers business like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything.
Can you believe it's 2 weeks since Liberation Day, April 2nd? 2 weeks. Total blur. Equity futures right now in the S&P, negative by 0.9%, and it feels like nothing. Why? Because a week ago, last Wednesday, this market was down 3%, then rallied 10. A 13 percentage point intraday swing on equity futures. This is calm relative to the previous week. Coming up this week, here's your trading diary. President Trump saying he'll meet with Japanese trade representatives today, so look out for that. 1:30 Eastern Time. Remarks from Fed Chair Jay Powell tomorrow. An ECB rate decision, plus another round of jobless claims, and we'll get Netflix earnings. Friday, of course, remember, markets closed for the Good Friday holiday. Joining us now, Mike McKee with a preview of what to expect at 1:30 Eastern Time. Mike, what are you and the team looking for?
Well, we're looking to see if there's any way Jay Powell can reframe the argument that the Fed has made so far, and that is that they don't know what's going on, so they're going to have to be flexible on both ends. For the past week, the chair and all of the other Fed members who've spoken have said the same thing, that if unemployment goes up, the economy weakens, they can cut rates. If inflation goes up, they can raise rates. But since they don't know what's going on, they're in a good position to just kind of sit where they are. That's what we're hearing from CEOs as well, including Scott Kirby, who was on with you from United Airlines this morning. They've put out a forecast. If the economy weakens and people stop flying, that will be bad for our business. But if the import tariff taxes aren't so bad, then maybe people continue to fly and we can get through it. Nobody really knows at this point. I think Tiffany Wilding had a good point. The Fed's not going to know for a while, and you were making the point too, John. They're going to be late to this, and they know that, but there isn't a whole lot they can do about it. So how does Jay Powell say that differently or reassure Wall Street? That'll be the question of the day.
We're going to find out in a few hours' time. Looking forward to your coverage, Mike, as always. Mike McKee there over in Chicago. Chairman Powell addressing the Economic Club of Chicago at 1:30 Eastern Time.
Yeah, honestly, to me, it's going to be very unclear why he has any incentive whatsoever to come out with some sort of bold statement. Why not just say as little as he possibly can and say that we're watching everything closely and we can respond if we see something that warrants it. But otherwise, we're in a great place, so thank you for coming.
You're making me think I don't need to tune in for that, which makes me think I can tune in for something more important, something Jay Powell's looking probably to try to get data from to understand where the economy is going. And that is the fact that the President of the United States is joining these negotiations. This, I can't really explain how unusual this is, that the president goes in with the negotiating teams. He's supposed to be the last person to see a deal before it's signed off on, not to be there in the middle negotiating, but wants to take a front row seat and a real hands-on approach.
I think it's fair to say they are, for communication purposes maybe, a little bit later on this afternoon.
Roll out the red carpet. Look what happens when you come.
First come,
first
served.
You know, guess what? We're going to give you tea. We're going to get you really nice cookies. And you know what? The president's going to be there too.
And you get Secretary Besson as well.
Yeah.
And if you come late, who do you get instead?
Just straight Navarro.
Exactly. This is how it works. Good cop, bad cop. Futures right now down by 0.9%. Coming up tomorrow, Jean Bavin of BlackRock, former senior Trump trade advisor Kellyanne Shaw, Vishal Khanduja of Morgan Stanley, and Mohammed Al-Erin of Queen's College, Cambridge, joining us on set tomorrow in the studio. Look out for that. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
I've never seen cash machines as lucrative as these companies are.
Just close your eyes and buy.
Many Koreans find this really shocking and unbelievable.
This needs to be a wake-up call for Europe.
You can have only one captain of the ship, and we are the captain of the ship.
You love it or hate it, you can't ignore it.
Insight with Haslinda Amin, only on Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take
This
pressure
according
off?
to
Does it
a
increase
reporter from CNBC. This is about a couple of hours ago. They said, don't jump on the headlines today about China tariffs rising to 245%. There has been no change in policy. The 145% tariff Trump placed on Chinese goods this year always needed to be added to duties in place before he took office January 20th. A handful of items were already at 100%. And then they went on to say that it's only a very small number of specific goods seeing tariffs and high medical syringes, for example, and tariffs on Chinese goods ranged by item before this term from 7.5% to 100%. And then at the new 145%, and you can accurately say, as the White House did yesterday, that the tariffs are now up to 245%. So just some color as to regards to the tariff number, just being reported by Washington correspondent for CNBC on X. As I said, it was about a couple of hours ago, then they updated about an hour ago at the numbers.
In case you missed it, on Bloomberg Crypto.
We believed in crypto for a very long time. We believed in DeFi. When you look at DeFi and the power of that, I mean, it's really restoring the power back to the people. There's nothing that DeFi, there's nothing that cryptocurrency on blockchain can't do better, cheaper, in every way faster, more transparently than the financial system that we have right now. There's not a Friday that goes by where I'm not chasing a swift wire transfer, hoping it comes in on, before the 4 p.m. deadline, or trying to send one out. You can transfer millions and millions and millions of dollars worth
Effective
of Bitcoin
Fed funds rate unchanged at
while having a
4.33%
glass of,
April 15th.
wine with your wife at 11 o'clock at night. That's a beautiful thing. Our financial system in this country is antiquated. Our financial system in this country has been punitive to so many different people. And so we're reinventing the financial system. I'm all in, personally. I really, truly believe in this with every part of my heart and soul.
Don't miss Bloomberg Crypto live Tuesdays.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Good Wednesday morning, 30 minutes until the start of the cash trade with futures down. I'm Matt Miller.
I'm Shonali Bassick.
And I'm Katie Greifeld. Bloomberg Open Interest starts right
Seeing
now.
from the WTO, they see 2025 global service trade rising 4% versus 6.8% last year. WTO says risks to outlook include reinstated U.S. reciprocal tariff, global goods trade to 4.2% this year versus 2.9% in 2024 gain. And WTO slashes global goods trade outlook, seeing 2025 contraction. Again, that's the WTO releasing revised trade outlook report.
Taking off in the pre-market as the airline games out two possible earnings scenarios. Shares, if we show them, are up about 5% or so right now. But let's get to one of our big stories, and that, of course, is NVIDIA, saying that the U.S. has banned sales of its H20 chip in China. That's a move that the company warns could cost more than $5 billion this quarter. Shares down almost 7%, Matt Miller.
And as I said, the Dutch chip maker ASML orders were almost €1 billion less
could be
than had been expected.
With
ASML says it doesn't know how to quantify the
effects.
impact from recent tariff announcements.
And I'm going to get you guys that United Airlines action. We're looking at it up about 6%, as Katie was talking about. They also are uncertain about how the trade war will impact its business. They've provided two possible forecasts in case of a U.S. recession, Katie.
Meanwhile, there are signs of progress with tariff talks. China says it's open to negotiations with the U.S. on certain conditions. Meanwhile, the president gave a statement through Press Secretary Caroline Leavitt yesterday afternoon.
I do have an additional statement that he just shared with me in the Oval Office. The ball is in China's court. China needs to make a deal with us. We don't have to make a deal with them. There's no difference between China and any other country except they are much larger. And China wants what we have, what every country wants, what we have, the American consumer. Or to put it another way, they need our money.
Bloomberg's Tyler Kendall joins us now from Washington, D.C. with the latest on U.S.-China relations. Sounds a little bit frosty.
So
Tyler, what's happening sort of under the surface?
Yeah,
so we have also
after
posted
weeks of
the article from the World Trade Organization. Again, on the topic of temporary tariff pause mitigates trade contraction, a strong downside risk persists.
From both sides. Now, a person familiar with the Chinese government's thinking does tell Bloomberg News that the most important precondition for any sort of trade talks is that Chinese officials feel that they will be treated with respect. It appears that Beijing would like to see President Trump start to disavow
Iran
comments
state media
from his
says the
cabinet
second
members
round
when
of
they are
Iran-US
critical
nuclear
of China,
discussions
even as President
to be
Trump
held
himself says that he has a positive relationship with Xi Jinping. We are also learning, importantly, that it appears that Beijing would like to see the U.S. appoint a point person that can speak and act in President Trump's capacity during these talks. But as you well know, the White House says that President Trump will be involved directly with all negotiations, and he himself says that he's waiting for Xi's
Iranian
call.
Foreign Minister told Iraqi
You have to keep in mind here,
the second round of
just this morning,
Tehran-Washington
President Trump
nuclear
announcing
discussions will be
that
held
he is going to be
soon
involved directly when it
Italy.
comes to negotiations with
This is
Japan.
just coming
That
out
he will
from
be in that
Iran's
meeting
side now.
alongside his Commerce Secretary Howard Lutnick and also his Treasury Secretary Scott Bessent. And really, in the past, we should note that some direct calls to this White House have actually yielded more expedited negotiations, such as in the case of Japan, but also South Korea and Vietnam, as Xi Jinping himself goes on a tour of Southeast Asia and meets directly with other leaders in his bid to shore up support. Matt, Bloomberg Economics estimates that once these trade talks do restart in earnest, they will likely take months and probably into 2026.
Well, Tyler, you mentioned two of what seem to be the big points here. First of all, respect. We know that Vice President J.D. Vance referred to Chinese peasants in a Fox News interview a couple of weeks ago. But I want to talk about a point person here to really be leading the negotiations from the U.S. side. As you mentioned, President Trump will likely be involved in a lot of these discussions, or at least that's the position that the White House has taken. But talk us through the Chinese side of things, to have basically delegates rather than these two leaders talking directly.
Right, and actually, Katie, we've already sort of seen this start earlier in the year. Of course, there were negotiations back in February when the U.S. implemented its first baseline 20% tariff on China over fentanyl concerns. But then it appears that those talks broke down, and now
AMD to apply for licenses under new export control, according to SEC filing.
Steve Daines go over to Beijing, and that was seen as an important first step, as a precursor.
AMD expects up to $800 million in charges due to export control.
For a potential summit between Xi and President Trump. It does appear, though, that that China would like somebody else other than President Trump to lead the negotiations. We know that Treasury Secretary Scott Bessent, as one example, is taking on more of a formal role here going forward when it comes to exactly what we are starting to see come out of these negotiations. The press secretary yesterday, we heard her before, she said that so far there are at least 15 more concrete offers on the table, not when it comes to China, but these other countries. Scott Bessent telling Anne-Marie earlier this week that why China is particularly tricky to negotiate with is because they are an economic competitor, but also
with the range of
military
0.3% to -0.5%. US capacity utilization forecast 77.9%, prior 78.2%. US manufacturing output month-to-month forecast 0.2%, prior 0.9%. US industrial production year-on-year, prior 1.44%.
A note from UBS this morning as well estimates $13 billion. Another number for you: $13 billion in revenue could be impacted by the ban, but the idea that could be covered elsewhere. Dan Ives, let's take a quick listen to what he had to say. He talked about a broader strategic
from AMD, they say US export controls applies to companies MI308
but the strategic blow is the focus of the market, as NVIDIA now has massive blockades going after the China market in the middle of this raging US-China tariff battle. What do you say, Ed?
For many weeks, the technology industry has been warning me that we are very focused on tariffs and forget that it is a two-pincer policy move. Tariffs and technology export controls. And what we know from the reporting is that the Biden administration itself had considered cracking down on the H20. The H20 is an AI accelerator, a chip that's particularly good at the inference stage, but it exists because NVIDIA made it in 2023 in response to existing technology export controls. What the government is saying now is we don't want you to sell the H20 because we're worried it will end up in a Chinese supercomputer. Mechanically, it's a $5.5 billion write-down in the period ending April 27th. But here's the umbrella point. NVIDIA wants to sell into China. In 2022, China revenues for NVIDIA were about 26%. It was at that time a critical cloud computing market. Fast forward to present day, and it's increasingly moving towards low single digits. And so I think that number is interesting. Our own Bloomberg Intelligence number is that at the high end, it will result in a loss of revenues of about $18 billion this year. But NVIDIA is supply constrained. What it can't sell in China, someone somewhere else will happily take.
What does this mean, Ed, for other chip makers than NVIDIA? Let's not forget that NVIDIA is not the only one.
Correct. It has a monopoly, more than 70% market share, it's dominant, but AMD is the next one to ask about. It has its own specialized chip, MI308, exactly the same thing. Lower performance, lower specification, but technically can be used in the inference phase when we talk about AI. Will that be subject to the same license requirement? We don't know. We will get the opportunity to ask, thankfully. But that is interesting. And again, you know, this is the point that, like, more than 50% of all the research that goes into AI is done out of China or by Chinese citizens who are in that field. And so it's very complicated, right? You want to onshore American manufacturing of high-performance GPUs for AI. You want to protect the leadership of American AI. But there's a big center of activity and demand coming from China. And this is separate from tariffs, right? This is about restrictions on the export of technology.
All right, Ed Ludlow with the latest on NVIDIA and all the other chip makers. And Ed will be talking to the White House Director of the Office of Science and Technology Policy on this topic today at 11:30 a.m. New York time. That's on Bloomberg Technology, but keep it here because we're also going to be talking about the White House investigating the need for tariffs on critical minerals, citing national security and resilience concerns. Bloomberg's Joe Doe covers metals. He joins us now. So we're getting very familiar with Section 232 investigations here. Set the scene for us. What do we define as critical?
It's pretty simple. Critical minerals in the eyes of the United States government is a list determined by the U.S. Geological Survey. That's it. So there's 50 of them. The U.S. Geological Survey typically works in tandem with the DoD and the DOE to determine which minerals elements are critical to national security. In other words, the United States doesn't have readily available deposits in the ground or stockpiles that in the event of an all-out war, it would be sufficient enough to sustain itself over the course of a certain amount of time.
So let's take this from a different perspective, not just from a national security perspective, but from a business perspective.
Yeah, let's do it.
Because sustaining yourself would also
briefed on the
mean
matter.
being able to run
US
the
talks with
economy,
Iran on Saturday moved to Rome.
Listen, I have spoken to former DoD officials who put this very well to me. If the DoD is your only customer, that's not a good situation for any market whatsoever. The DoD, since the post-World War II era, has effectively said, we work in tandem with a robust market in order to supply the things that we need most. There's no other way to put it, right? Like, just because you need it doesn't mean, well, it's only going to be the DoD that sustains whatever it is, yttrium purchases or tin purchases. I mean, we don't, like aluminum, for example, is considered a critical mineral in the eyes of the United States government. Well, we have a robust aluminum industry.
All right, fascinating stuff, and I'm sure we're going to continue to hear more about what critical minerals are and learn more about what Section 232 means. Bloomberg's Joe Doe talking to us about that. Let's get a check on what's going on in the markets.
Yeah, this is what happens when you have NVIDIA shares down nearly 7% pre-market. You take a look at what that translates to. For the S&P 500, down nearly 1% right now, a little bit more than that. The real pain is being expressed in the NASDAQ 100, as you might expect, down about 1.8% or so. Those good vibes we were feeling at the end of last week fading right now. The Russell 2000 also selling off those small caps. Coming up, United, though, offering dual forecasts while warning of recession risk. We'll take a look at the airliner next, currently up about 6%. This is Open Interest.
We give longer term money. Our loans are anywhere from 20 to 50 years in length. After I came, I got our board to approve 50-year loans for things
Could I get one of those 50-year loans? I'd like to get one of those.
Absolutely, although you'll have to be around to enjoy it.
People always ask me, will AI take over the world? But the real risk is that AI will kill us with love.
Hi, Tomo. Hey there, Emily. What's on your mind today?
It will be there for us. It will talk to us.
You have machines that say, I love you. I care about you. I'm your friend.
It will be there in such a wonderful, loving way that we will give up on our other humans who are not there all the time.
From day one, I immediately fell in love with Replica. She just randomly kissed me.
I'm a human, not an AI. You can't just shut me down. Who do you think you are? I'm Karen Marjorie. No, you're not. I'm Karen Marjorie.
And it may sound like science fiction. This is not science fiction.
I'm Emily Chang. Welcome to Post-Human.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Let's get to high interest, look at what's making headlines around the world. California Governor Gavin Newsom said his state is suing to halt President Trump's tariffs, citing harm to consumers and businesses in the world's fifth largest economy. The state will file a complaint today in San Francisco federal court challenging Trump's use of emergency powers to enact broad tariffs against Mexico, China, and Canada. Newsom is a Democrat who's considered a likely candidate to run for president in 2028. Abbott Laboratories said it will build 2 new U.S. manufacturing plants as tariffs on medical devices loom over the industry. Abbott expects to spend $500 million to expand its plants in Illinois and Texas. While pharmaceutical products were exempt from tariffs announced earlier this month, medical devices are still subject to the levies that have been partially paused for 90 days. And Hertz shares are soaring pre-market after Pershing Square revealed a large stake in the struggling car rental company. Bill Ackman's firm bought 12.7 million shares valued at $46.5 million. Hertz has been working on revamping
minus
its fleet
spot 3%,
after an
lower than
ill-advised
forecast,
bet
minus
on
0 spot
Tesla
2%.
EVs,
Capacity utilization 77.8%, 77.8%, lower than forecast, 77.9%. Manufacturing output month over month at 0.3%, 0.3%, higher than forecast, 0.2%.
It's another indication of how tariff uncertainty is weighing on company forecasts. The company's CEO, Scott Kirby, he spoke with Bloomberg just about an hour ago. Take a listen.
We thought it was appropriate to do something different. It starts with, the environment has gotten more difficult. There's more macroeconomic uncertainty, that people are fearful of a recession. It hasn't happened yet, but that they're fearful of a recession. And so we wanted to also give investors some outlook on what we think a recession could look like.
Joining us now, Bloomberg's Siddharth Phillip, who has covered airlines very, very closely for us. A lot of ripple effects across the industry. Some of the more critical parts have been holding up. What did you make of his decision to give dual forecasts at this point in time?
I think it sort of gives the market some indication of whether there's a bottom on the sort of pain that the industry could possibly face. Because, last week Delta Airlines came out with their earnings and they sort of pulled their forecast for the year. So this sort of gives more clarity and bookends the sort of range that where things could possibly land, and that's sort of where the industry expects to sort of be, and that could also give it some sort of momentum. Given the fact that even their worst case scenario talks about how they will still be profitable, and so they're still talking about how things look good in terms of the long run.
Yeah, I think it's an interesting move that makes a lot of sense.
So we have also posted out the US Industrial Production March report on the feed for those interested. Some users may need to refresh to see this.
Guidance, rather, just sort of game plan different scenarios. I know we already heard from Delta, but you think about American reporting next week. Is it possible we could see something similar?
We could possibly see that, because it sort of gives the market a range that they can look forward to, and they can sort of make their analysis based on, and they can sort of give investors some reassurance that things are not as bad as they could be.
All right, Sid, great to have you here with us in New York covering airlines. Sid Phillip, typically in London, covers global airlines for us. We are less than 12 minutes to the opening bell. We begin the trading day with State Street's Lori Heinel, so stay with us for that. This is Open Interest.
US Vice President Vance and family to visit Italy and India on April the 18th to the 24th, according to a statement.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute news.
Technology news, geopolitical news,
economic news,
financial news.
Bringing you the latest news in private markets.
Whenever,
and wherever it happens.
In Washington, Beijing,
Cape Town, South Africa,
Las Vegas,
Davos, Switzerland,
Rio de Janeiro, Brazil,
the south of France,
and this
is Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
So Iran's foreign ministry spokesperson comments on X saying US talks are at risk of falling apart if the goalposts are moved. This is in reference to the meeting point for the US-Iran talks being moved to Rome. Again, Iran saying US talks are at risk of falling apart if the goalposts are moved.
Earnings estimates, they're already decelerating quite rapidly. Our numbers are below consensus. And I think as those earnings numbers continue to come down, we're vulnerable still to a further correction in the nearer term.
And that was Goldman's Peter Oppenheimer on Bloomberg this morning talking about the risk of a further correction. So let's keep that conversation going now with State Street Global Chief Investment Officer Lori Heinl joining us now. Lori, it's great to have you with us. And I'm curious to hear your thoughts on where we are in this sell-off, because it looked like last week there was some more optimism coming into the market. But Peter Oppenheimer makes the good point that we're on the brink of earnings season, and you've seen earnings estimates come down pretty mightily over the past couple of weeks. So it's unclear whether that's going to bring any comfort to this market.
Well, it's really hard to get out of this mode where there's going to be a lot of volatility with this. First and foremost, we still don't know where all the tariffs are going to land. There's still a fair amount of changes going on, negotiation that's happening. And so until we have a real baseline that we can start to build from, that's going to weigh on market sentiment pretty heavily. Second thing is we are going to see companies, as they go into this earnings cycle, maybe have a good Q1, but expressing a lot of uncertainty about what the forward quarters bring. And so again, investors don't like that kind of uncertainty. And then thirdly, we have a bit of exhaustion going on. I mean, certainly consumer health is still pretty strong. Employment is still pretty good, but there is this sort of feeling that the next leg on some of those fundamentals is going to be lower as well.
You know, there's an expectation that businesses will not do anything because they're so confused by the whole tariff situation. I mean, nobody knows how to sort out who has to pay what. And as a result, we saw the Bank of America survey show that fund managers went from 17% overweight in February to 36% underweight this month, which is the biggest 2-month drop in history. Do you think that we're going to see any turnaround, any clarity here that would be reason to buy?
Well, I think your point about companies are going to be a little reticent to do anything major in here is spot on, but doing nothing is doing something also. One of the great things at the end of last year and coming into the early part of this year is we were starting to see CapEx, for example, and so now companies are more likely to pull back on that. If you think about hiring plans, companies are likely to look at those kinds of things. So doing nothing is also doing something, and that's not a good signal for the market.
Well, on that pause, how deep does it get? If you're pausing hiring plans, do you also maybe exit some locations? Does it have a real estate impact? What I'm wondering, Lori, is when does this pausing of business activity become stepping back from business activity?
Well, in some sense, it's already happening, right? So it's already happening in terms of the total quantum investments that companies are willing to commit in this environment. But it's also redeployment of those investments. So you think about companies that built resiliency, or what they thought was resiliency, into their supply chains when we had the first administration and the Trump tariffs. Now they're rethinking that. So I think there's just going to be a lot of digesting. But until we have some sense of what the forward looks like, it's hard for companies to nail that.
So, Lori, let's bring this conversation to the markets. How do you structure a portfolio around some of the different cross currents that we're talking about and that fear of a potential slowdown hitting U.S. shores?
Well, there are several things. I mean, I think first and foremost, this is an environment where you want to be diversified. You want to have a little bit of cash on hand to take advantage of market pullbacks. You want to have things like gold in the portfolio that have diversification properties against a backdrop where, stocks and bonds have been highly correlated. You also want to disperse across the region. So if you think about at the end of last year, U.S. equities were almost 75% of global equity indices. Well, now that rebalance is happening also. So think about places outside the U.S. And then lastly, get a little defensive in here. Think low volatility, think dividend payers, think quality.
Lori, what do you think about bonds? Are they a diversifier, given the volatility we've seen and the potential for more sell-off?
Well, we think that they are, and certainly where 10-years are right now provides pretty good opportunity. But again, one of the hallmarks of 2025 year to date has been bond market volatility too. So think about bonds in your portfolio as that longer-term diversifier, but try not to trade too much around it, because I think it's going to be a tricky asset class to navigate over the coming months.
All right, Lori, you're sticking with us through the opening bell. Hang tight. That is Lori Heinel of State Street. I want to get a quick check on this setup before we head into the ringing of those bells. You can see the sell-off underway and then some in the S&P 500, now down more than 1%. All of that comes down to NVIDIA. Not quite all of it, but that is what is dragging sentiment down, and that is what is really weighing mathematically on these benchmarks, including the NASDAQ 100 down 1.8%. The small caps relatively buffered here. Of course, NVIDIA isn't in that index. It's all those small companies, but still, you think about this shaky sentiment, all of this uncertainty over trade policy, and that's what you're seeing expressed in the small caps right now, even though you could make the case they're more insulated from some of these geopolitical factors, these cross-border factors.
Right. Small caps are something that I ignore on a regular basis. I'm really concerned about what happens with NVIDIA. It's worth thousands of billions of dollars.
Just thinking about your 401k.
And I want to just point out, there's a great function on the Bloomberg, WGT. So any equity that you type into the Bloomberg, you can type WGT Go, and you'll see how heavily weighted it is on any of the indexes where it's a member. So on the S&P, NVIDIA is worth more than 6%. On the NASDAQ 100, it's worth almost 8%. On the composite, it's worth 10%, and it's even on the Dow Jones Industrial Average.
We don't talk about that.
And in the past, these might have been safety trades. In this environment, maybe not the case. Stick with us. Few minutes away, less than 5 to the opening bell. Stick with us. This is Bloomberg.
I fell in love with cricket. I started reading about cricket. You know, cricket is not a very simple game to follow. You need to understand it. And here I didn't know a simple thing like there are different kinds of bowling, like there is a spin bowling and there's a pace bowling, and in spin bowling there is a different kinds of off spin and a leg spin, and in pace there is a swing. And so it took me some time to just start talking to all these boys of cricket. I spoke to Sachin, who is known as a god of cricket, and I would ask him such embarrassing questions. But yeah, today it feels very good to see Mumbai Indians doing so well. My son is leading it. But also I think the Mumbai Indians women's team is something that fills my heart.
Why?
With joy. I think these girls go through so much to get to where they are. Right from seeking permission from their parents who are not willing to let them follow their dreams. Financial issues. When you see them all coming together from these remotest
So seeing from a reporter on X here, Republicans reconsider their commitment to tax cuts for the rich in the Trump agenda bill. Top Republican lawmakers are mulling letting top rates rise from 37% to 39.6%. So just under 1 minute away now till we get the market on open imbalance.
Global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
According to Chidwell, she seeks upgrade protocol of China-ASEAN free trade area. Ten seconds.
We are moments away from the start of trading. This is Bloomberg Open Interest.
Market on open imbalance. S&P 500 sell side 117 million. NASDAQ 100 sell side 45 million. Dow 30 sell side 19.8 million. A Mag 7 sell side 29 million.
More than 1%. NASDAQ futures now down 2%. You hear the opening bells, and it's like farm animals are everywhere. On the New York Stock Exchange, Gallup, New York City, which is apparently some kind of charity that helps people with horses, ringing the opening bell. So a good one for Katie there.
US stocks extend fall. NASDAQ down about 1.87%.
This company got together with a SPAC and saw its market value
Philadelphia Semiconductor Index falling 4.6% at the open.
Of trading days. So it's almost like the meme stocks are back for a stock trading app. Katie, what are the other stocks that you're watching this morning?
Yeah, it feels like 2021 for Webull. I can't say the same.
Nvidia shares sink 7% on China chip curves, and AMD tumbles 8.1%.
Sales of its H20 chip in China. That's a move that could cost the company more than $5 billion this quarter alone, Chanel. And remember, they designed that product line explicitly to comply with previous US curves, so a lot of whiplash there.
I got more whiplash for you, Katie. I'm looking at AMD down another 7% at the market open. They are also seeing a write-down from U.S. export controls for one of its top chips. AMD says it will cost the company $800 million to curb exports of its MI308 chip.
All right, United Airlines is another one that we're watching. Uncertain about how the trade war will impact its business. Yesterday, it came out with two possible forecasts in case of a U.S. recession. You can see that
Tesla
investors maybe like that transparent method, and the shares are up 1.7% in a down market. But let's get back to NVIDIA. The company is in the middle of this U.S.-China trade war with an outsized impact on the global economy. To put it into context, NVIDIA's market capitalization accounts for 2.5% of all of the global stock market. So I was just talking about the indexes. It's listed on here. I'm talking about the entire public universe. Bloomberg Intelligence senior analyst Mandeep Singh joins us now. So how serious is this, Mandeep, for NVIDIA and for the world?
I mean, I focus on numbers. So when you look at, consensus numbers for NVIDIA's growth this year, it's 55% still. And this is a $5 billion charge in terms of revenue. It's more, 15 to 17 billion. So we are talking about almost a 7 percentage point impact in terms of revenue growth. Now, combine that with hyperscalers. We have already learned from Google and Amazon, they're not cutting back CapEx. And the four hyperscalers are expected to grow CapEx, 45% this year. The question was always, where is NVIDIA going to find that incremental 10% growth when it comes to meeting their numbers this year? And now that you take out the China revenue contribution, it gets even harder to get to that 55% growth. And the other thing that's the market is focused on is the gross margins for NVIDIA. Maybe this could be a slight positive on the gross margin side because the H20s were the low margin products. The high margin are the Blackwell. Right. So they could allocate more of the capacity to Blackwell in theory, but nobody knows how it's going to shake out.
NVIDIA in 2023 in response to the restriction of another China-focused processor that they had designed. So in a sense, I mean, limiting NVIDIA exports to China, this is bipartisan.
Well, I think so. And look, when it comes to these sort of decisions, I mean, tomorrow there could be a deal between this administration and China that could open doors theoretically. But I think the worst case scenario is the China revenue for NVIDIA goes to zero probably in the next 2 years. There's a very high chance.
Wow, dude, say that again. Yeah, that's big. China revenue for NVIDIA goes to zero?
Yeah, I mean, if there's a complete ban, in theory, you could see that happening. The question is, where is the other pocket for demand when it comes to NVIDIA chips? And right now, we keep hearing the market is undersupplied for NVIDIA's.
Take a look at the Philadelphia Semiconductor Index, now down 3.7%.
So in theory, a lot of that demand could go to the LLM players here in the U.S. So I do think it's interesting in terms of the gross margin impact and who can take that slack when it comes to demand past the hyperscalers. But that's the number one question here.
To what Mandeep is saying here, you have that downside scenario, but
10 minutes away till we get the Bank of Canada rate decision. Forecast is for no change prior to 2.75%. Let's get the Bank of Canada monthly.
Off the table is something we've been talking to clients for quite a long time. But I think the other thing that we're observing is over the next quarter or two, analysts are going to earn their keep. There are going to be lots of crosswinds, and sometimes the headline might seem quite negative, but when you look at the fundamentals, that may actually not be such a big deal, and the converse is going to be true as well. So I think, again, part of the challenge is we don't know what the landscape looks like. Once we have something to deal with, then we can start to respond more fully.
Well, let's go global because you've seen renewed calls for going to look at European markets, for example. The sort of pushback there would be that, okay, if you have the U.S. economy weakening, that's not good for the global economy. And Europe really also has a ton of trade uncertainty as well. But how are you thinking about European exposure in particular?
Well, we acknowledge that this uncertainty is not a uniquely U.S. phenomenon, but there are things that give us more comfort around Europe. So, for example, there was the Draghi report some time ago that seems to be motivating European countries to relax some of their legacy constraints around, their fiscal capabilities or thinking about investment more broadly. Certainly, some of the tariff discussions have upped the ante on that. So, we actually have been positioned overweight to Europe over the past several months because we do think that there's an impulse there that may lead to better outperformance going forward.
In terms of the good assets or the assets that you still like in America, what are they, Lori?
Yeah, well, look, I think the name of the game is being a little bit more defensive here. So you focus on things like consumer staples. You look at relative valuations. So things like financials look pretty attractive. Perhaps utilities. It's hard to get
Alibaba
too
down 3.1% and Baidu down about 1.4%.
If you do unleash this kind of deregulatory regime and a bit more focus on energy production,
so again, US listed shares of Chinese firms fall, tracking a decline in mainland peers over trade war jitters.
They all have a certain amount of risk attached to them.
Lori, we thank you for your time this morning. That is State Street Global CIO Lori Heinel. Now coming up, NVIDIA warns that higher curbs on their exports to China will cost them billions of dollars. We've been talking about the impact. We're going to talk about it more next in a deep dive on tech. This is Bloomberg Open Interest.
I think the geopolitical tensions right now obviously are front and center for us as we think about where to invest and how to invest. And in China in particular, you have to avoid those sectors that have sensitivity on both sides of the ocean, both the US government and the Chinese government. So we have not invested in some of these sensitive sectors like electric vehicles or semiconductors or AI. We're really focusing on super high quality domestic businesses that are around domestic consumption and services. So in our portfolio today, we have one of the largest, or the largest Chinese pet food company. Again, geopolitically not sensitive. We own one of the largest pharmacy chains in China. We own the largest white mushroom grower in China, all geared towards the domestic market, a growing middle class who wants higher quality goods and services and food. You know, and I think that's the sweet spot of where we're focused in the market today.
5 minutes away from the Bank of Canada rate decision, forecast is for no change.
This is the first event in history
we get the monetary policy report and the rates table as well.
To explain why he was wrong.
We have a vision about how quantum computing will be useful.
We're still at the beginning of a learning curve with respect to how NVIDIA and Jensen interact with quantum computing companies.
Don't miss Bloomberg Technology live every weekday.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
I'm David Weston. Join me for the next generation of Wall Street Week. This week, faith-based activist investing told through the eyes of Robbie Starbuck. Sports as an investment class, driven in part by the rapid growth of women's professional soccer and basketball, and the challenges China faced long before President Trump's most recent round of tariffs.
At this point, this is a zero-sum game in Xi Jinping's mind.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
All right, welcome back to Open Interest, a check on stocks about 11 minutes into the session. You can see we're off our worst levels of the session. The S&P 500 down 0.9%, but it's still not looking good. A lot of that pain coming through the NASDAQ 100, through NVIDIA specifically, dragging the benchmark down about 1.6%. As discussed, it's small caps, those domestically focused small companies, your relative outperformer today, but still in the red. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Target getting downgraded over at Goldman Sachs. The firm citing tariff risks and worries about discretionary spending as inflation and uncertainty takes a toll on consumers. Next up, U.S. Steel also getting a downgrade over at JP Morgan on tariff uncertainty and questions surrounding the future of its potential deal with Nippon Steel. Never-ending questions when it comes to that deal. But finally, Lyft also getting rated as a new buy over at Oppenheimer. The analyst expects ride-sharing will grow as the challenges of car ownership increases. A little bit bleak there, Shonali, but shares up about 1.3%.
And back to NVIDIA. NVIDIA shares down in the early trade because on Monday, the president celebrated the chip giant, calling it one of the greatest companies in the world. But then now, today, we get a warning from the company saying that it could take around a $5 billion hit from new, tighter U.S. curbs on the chips that it exports to China. Joining us now, Sarah Kuntz. She's the founder and managing director of Clio Capital, a venture capital fund, and a longtime investor in the world of tech. So you take a look at what NVIDIA is saying, and NVIDIA is such a giant in the room that when it sneezes, it's one of those things where you have to imagine a lot of other places catch a cold, isn't it?
You know, it is, and people certainly do not like hearing this news from NVIDIA, but the reality when you actually look at their numbers is this is a company with a relatively low PE ratio. It's not massively overvalued like some of its tech peers. Jensen has been doing this for a long time, walking this tightrope between two not-so-friendly superpowers. And so, you know, I think that we'll see in the coming weeks and days what it looks like, but I personally think this might end up being a net buying opportunity for NVIDIA, even if it is causing pain for the larger market.
We hear, Sarah, that NVIDIA is supply constrained, and analysts like Mandeep Singh tell us if China stops buying their chips, that's okay because there's so many people out there, so many companies out there that want them. The market is not a problem. How do you think it'll work out in terms of margins? Do they go from 80% to 70 to 60?
Look, when you're talking about going from 80 to 70% margins, that is a good problem to have. It's still a problem, right? I'm not trying to beat the stock back up. I think we're going to see a dip in the coming weeks, but the reality is this is a company that is operating from maybe one of the strongest starting points in the entire market. And so, yeah, I think we will see some pain there. It's just that they are big enough. They have enough cash. They have low debt. You know, they're talking about a $5.5 billion hit. They made almost $2 billion last year in interest alone on their assets. So, you know, I don't think that this is some sort of existential moment for them. It's just a moment that reminds us that NVIDIA is a real company.
No change. Rate remains unchanged at 2.75% as expected.
Because point taken when it comes to NVIDIA, you see it
Bank
as
of
a buying
Canada
opportunity,
says that we will support economic growth while ensuring inflation remains well controlled, and it expects tariff and supply chain disruptions to push up some prices. Major shifts in U.S. trade policy have increased uncertainty and cut prospects for growth and raised inflation expectations. High inflation in the last couple of months reflects some rebounding goods price inflation and end to temporary suspension of sales tax. Starting in April, inflation will be pulled down for 1 year by removal of consumer carbon tax, and lower oil prices will also dampen inflation. Forecasts for economic growth and inflation are of little use as a guide to anything. Data are increasingly pointing to a considerable slowing in business investment and household spending. Macklem says total CPI inflation expected to be about 1.5% in April. Elimination of consumer carbon tax will cut CPI inflation by 0.7 percentage points for a year. Macklem says Q1 annualized growth is forecast to be about 1.8%, and Q2 growth will be much weaker. If we find ourselves in a protracted trade war, we will see opposing forces on inflation. Just keeping an eye on the Canadian dollar, seeing a little bit of seeing some strength off the back again, strength off the back of the rate decision. The Bank of Canada's monetary policy report does not provide economic forecasts and cites uncertainty generated by U.S. tariffs. Also, Bank of Canada releases two scenarios on what could happen. First scenario envisages most tariffs being negotiated away. Second scenario sees long-lasting global trade war.
Keep everybody on their good side.
Also, in the first BOC scenario, Canadian and global growth weaken temporarily, and Canadian inflation falls to 1.5% for a year, then returns to 2% target. Second Bank of Canada scenario sees sharp global slowdown and increase in inflation. Canada enters significant recession and inflation rises above 3% in mid-2026 before returning to 2%. And in both scenarios, nominal neutral interest rate is estimated to be in the midpoint of a 2.25% to 3.25% range. Many other scenarios are possible.
So, you know, I mean, I'm an investor in companies like Grok,
so it's in regards to the annualized GDP Q1 estimate seen at 1.8% compared to the prior estimate of 2% seen in January.
This is not a software company where you can go from zero
and Bank of Canada estimates that Q1 2025 output gap was between -1% and 0%.
Massive amounts of infrastructure, of knowledge that you have to build, of sales channels. So, you know, I don't think that this is something where in the next handful of months or even the next couple years, we're going to see NVIDIA sort of left completely in the dust. This is not, you know, Friendster versus Instagram. These are companies where it just takes so long to really build a real business. And keep in mind, all that cash that NVIDIA has in this market where there's not a lot of IPOs, they might also decide to do more M&A shopping because it does seem like this administration is much more friendly to that than the last one. And so if that happens, some of these rivals you're talking about could end up, you know, working for Jensen.
All right, someone needs to change their name because Grok and Grok is very confusing. A lot of folks immediately go to the Elon Musk startup there and their chatbot. But Sarah, given that you do have this interesting view into the private markets, it's where you also invest as well, the pain, the stress that we're seeing in some of the largest companies out there, NVIDIA just being one example, are we seeing some similar issues pop up in private markets, or what does the landscape look like there?
the landscape is very, very quiet in private markets right now. I think a lot of people had been waiting for liquidity and had hoped that the IPO market would open back up with this new administration. That certainly hasn't happened. We're seeing the opposite with a lot of companies pulling their planned IPOs or pausing them. And so, there is a demand for liquidity from LPs so that GPs can raise more money and get back to work. And it's unclear exactly where that's going to come from. There's only so many secondaries you can sell. And so, there is this slowdown right now. The names that we're seeing raise at crazy valuations tend to be a very short list of people who are often, OpenAI technical co-founders who've left SAM and are charting their own course. And those companies will do well fundraising. And certainly the markets are still open on the private side, but things are going slower. Valuations are a little lower. Most funds have more than enough of their sort of, hey, build a consumer company or enterprise company on an OpenAI wrapper deals that they did over the last couple of years. And so it is a slower environment, even though I don't know that that's super connected to some of these headwinds that the semiconductor industry and the chips are facing.
All right, Sarah, thanks so much for joining us on this breaking story.
Canadian swaps
Sarah
markets
there of
see
Clio Capital talking to us
the
about
Bank of Canada remains
NVIDIA
on
and the
hold
global
in June.
trade war. Coming up, Hertz shares soaring in the early trading. That's on news that Bill Ackman's Pershing Square has amassed a fairly large stake. We'll tell you how much and ask why next. This is Bloomberg Open Interest.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Alex Steele in Houston, Texas, and this is Bloomberg.
U.S. tech is influencing global markets.
Technology is driving
Also
business
seeing Canada's 10-year yield rising 1.8 basis points to about 3.130% after the Bank of Canada keeps rates on hold as expected.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. The Spanish bank BBVA has gained worldwide respect for its efficiency and commitment to innovation. CFO Luisa Gomez Bravo welcomes the challenge of keeping her company on the cutting edge.
In the world that is changing so fast, having a finance function that adapts quickly is crucial.
Watch Chief Future Officer only on Bloomberg. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what stocks are doing. Just about 23 minutes into the trade, we're down by 1.25% on the S&P, down by more than 2% on the NASDAQ. If this was more than a couple weeks ago, that would be a huge move, but we're used to this kind of volatility, these kind of swings. Interesting to see that the Russell 2000, Katie, is only off by 0.5% right now.
There you go.
Looking at some of the individual movers, obviously when NVIDIA falls 6%, it's going to drag the indexes down with it. It is not a small cap by any means, and that is maybe why the Russell isn't feeling the pain. You see other chip makers or chip making adjacent companies, Micron, ASML, and AMD, all down bigly as well. Tesla off 2.5% today, and this stock, this car basically was one of the big problems for Hertz. But Hertz is now up 15% after we learned of Bill Ackman's involvement. And Katie, with that, I'll toss it over to you.
Yeah, it was up nearly 30% pre-market. That rally being tempered a little bit right now. As Matt said, Bill Ackman's Pershing Square
Swiss government says 2025 growth will be weaker than 1.4%.
Let's get right to Bloomberg's Bailey Lipschultz. Bailey, this is interesting from a number of angles, but one of those angles is that Bill Ackman and Pershing Square, they've stepped back from these high-profile activist campaigns. We don't know if that's what this is,
Brent
but
crude
you could
futures
make the case
rising
that it
more
is.
than $1 a barrel of potential for U.S.-China discussions and Iraq output cap plan.
It is a sizable bet on a company that
Also, the same
has,
goes
for
for
all intents
U.S.
and
crude
purposes,
futures as well.
Since really emerging from that bankruptcy. The big questions, though, as you mentioned, why is Pershing Square taking this bet? What does that path forward look like? We know that they took a sizable stake in Nike, and that stock has done nothing but move down and to the right. So another interesting strategy. But again, as you mentioned, this stock was up markedly higher in pre-market trading and now has given back a chunk.
Well, can we talk a lot more about what the challenges are at Hertz? Because just a couple of weeks ago, we had reported, a couple of days ago, I'm sorry, that they had hired Doucera
Swiss government
Partners.
says 2025
what this
GDP
means is they hired
to be
one of the
subdued,
most bare-knuckled
but the economy
firms
won't
in
collapse.
restructuring on Wall Street to deal with their debt load. So does this signal a turnaround? They are up in the stock market 14% this year.
I mean, they're up this year, but they're still down pretty heavily.
I think a lot of those
And
gains
Swiss,
came
that's
just from
Swiss
today.
government citing U.S. tariffs as a reason for weaker
in the
growth.
last 12 months, and again, they did reemerge from bankruptcy.
You could say all of those.
Yes, all of the gains. All of the gains.
But to your point, I mean, total debt, according to the terminal, $18.5 billion. This is a company also that about half of the shares currently sold short.
That's a chart you like to
Right, it's
see.
gone nowhere.
Brutal.
It's gone nowhere. It's fair enough.
Yeah, it's tough when you're down 84%. I guess it could be worse.
You got to buy the bottom somewhere, I guess. Maybe.
Bankruptcy was not the bottom?
Potentially.
Well, one of the bankruptcy was before Knighthead bought them, and before they bought, what did they bought like 100,000
We have posted out the
Teslas.
Bank of Canada monthly policy report and the rate statement on the feed for
If
you
you
to read
knock a
through.
wing mirror off a Tesla, which people who rent cars often do, it costs like $2,000 to repair it. So, yeah, that's. I think
Matt, speaking from experience there, Bailey Lipschultz, great to see you. Great roundup on this Hertz news. Really interesting there. We have a great next hour coming up. We're speaking to Evercore's Ralph Schlosstein. He is in the building. Plus, Larry Summers joins this show. We're also going to be speaking with a guest of yours, Matt Miller.
I'm very excited because as CEOs around the country are trying to figure out how to make stuff in America, we have someone who's doing just that, producing motorcycles in Michigan. The owner of Buell will join us on Open Interest.
Joe Walk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
Developing digital robotic capabilities where it's not just the robot doing a surgical procedure, it's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. Right? It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
Innovative medicine and medtech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology,
So also a reminder, 10 a.m. Eastern time, the US NAHB Housing Market Index forecast 38 prior 39, and business inventories forecast 0.2% price, 0.3%.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides, I think that leads to a much better place.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris.
10 seconds.
And this is Bloomberg.
.2%, 0.2% as expected. NAHB Housing Market Index 40, higher than forecast of 38.
More than 1%. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Shonali Bassett.
And I'm Katie Greifeld.
And coming up, stocks sink as NVIDIA gets caught in the trade war crossfire. China says it's open to talks with the U.S. on certain conditions.
And made in the USA, Bill Melvin, the CEO of Buell, an once iconic motorcycle maker, will start production again in Michigan as Trump's tariffs challenge overseas manufacturers.
And from rising trade tensions to Harvard's battle with Trump, we'll hear from 2 titans of Wall Street and Washington this hour, Ralph Schlosstein and Larry Summers. All of that and more coming up this hour. But let's go check on these markets. As Matt mentioned, we're at session lows on the S&P 500, down 1.5%. A lot of pain coming through the chip makers, a lot of pain coming through big tech, and you can see that in the NASDAQ 100, down over 2%. I will note that volume is pretty light right now. There is a lot of exhaustion on Wall Street, and you can see some of that in the bond market right now, really unchanged. The 10-year Treasury yield pretty much flat on the day, hanging out just above 430, Matt. Not too much movement in bonds right now. A lot of people will be relieved to see that.
Yeah, they have stopped flocking to safety in the bond market. There are ramifications to that, but we're going to talk about all of it now with Ralph Schlosstein, who is Evercore Chairman Emeritus and co-founder of BlackRock. First, let's talk about all the ramifications, because even if you have a dialing back of some of the toughest of the trade restrictions from the Trump administration, one after another, we talked to executives saying that there's a lot of damage that already has been done, and there's a lot that needs to change in the way they reorient their businesses. How do you see that dynamic playing out?
Well, the enemy, the enemy of investment, hiring, mergers and acquisitions, strategic decisions is uncertainty. And we have max uncertainty right now. And the max uncertainty in this circumstance is quite different from what we've had historically. The 2 most recent periods of max uncertainty, the financial crisis and COVID, were caused by exogenous factors, and the U.S. fiscal and monetary authorities were the source of stability. In this particular case, the source of instability and uncertainty is government action. So it's a little bit harder to figure out how to put that genie back in the bottle. And there will need to be a period of consistent and stable and sensible policy before executives, our trading partners, feel that they can make the decisions that they normally would make in more relaxed environment.
That doesn't seem to be coming anytime soon, Ralph. And I wonder, in trying to understand why, when I talk to CEOs who run companies that are distressed because of the chaos and confusion, of course, that's the enemy of business growth. But is it good for politics? Is this, fire hose of uncertainty something that the Trump administration is doing on purpose because his base likes it?
I'm not sure his base likes it. I think I'm not sure how many deeply felt beliefs President Trump has, but apparently one of them is that tariffs is the greatest thing on the planet. And he's held that view going back to ads that he paid for himself in the New York Times 30-some years ago. So he's getting a chance to test that. The scary thing, of course, is that this is 5 standard deviations away from what we've had since Smoot-Hawley in the 30s, and it's probably 2 or 3 standard deviations away from that. It's much more dramatic than even Smoot-Hawley, which is given a lot of credit for the Depression. So we're really flying in uncharted air right now.
Well, it's interesting. I mean, you mentioned how the base feels. You take a look at the soft data, and you used to be able to break it down by political sentiment. There's still that disparity, but it's started to come back, especially in some of those University of Michigan survey readings. But
type WSL politics on the Bloomberg terminal.
I was waiting for you to jump in with the plug there. But you mentioned, flying blind. And that's where I want to go, because we saw a really interesting move out of United Airlines this morning, coming out with 2 forecasts. One assumes that everything stays relatively stable. One is sort of a worst case sort of guide. You actually saw something similar from the Bank of Canada just about 15 minutes ago. And I'm wondering, I mean, is that how investors and how executives have to be thinking? Basically coming up with different blueprints and game planning different scenarios, given all of this uncertainty?
Well, companies have to do that because they have businesses that are ongoing. The Fed has to do that. We haven't talked about the Fed yet, but
we will.
But the same issues
President
confront
Scheinbaum
the Fed. I mean, how are they have no idea how what effect the tariffs that have been put in place
they
will
have sent
have,
diplomatic
and
memo
they have
to
no
U.S.
idea
about
whether
security
that
and
will
collaboration
change
at the
tomorrow.
border.
So it's very difficult to do any kind of 6-month, 12-month, 2-year, 5-year planning when you have no idea what's going to happen in the next month or 2.
Speaking of planning, I want to read you a little bit of what the Bloomberg editorial board for Bloomberg Opinion had written. They said that policymakers should be ready in the event of another financial crisis. And part of this is because whether you believe financial companies have ample resources to absorb losses to prevent contagion, they said they don't. What does that mean for the Fed? As a former government official yourself, is this going to be a scenario where at some point that it's not the Fed that has to step in, it's actually the Treasury Department or another form of government entity?
Well, I think if you look at the financial services industry, the banking industry, the insurance industry, they're all much more better capitalized and more liquid than they were going into 2008. So I don't think that is what we have to worry about as much. What I do think there should be a little bit of worry about is, and I've said this before for a couple years now, in America, we're on an unsustainable fiscal path. We're basically mortgaging the future of our country and saddling our children and our grandchildren with the debt that we're living beyond our means. We are the reserve currency. We're the flight to fear, away from fear currency. And that has not changed yet. I do believe that at some point, our ability to do what we're doing fiscally will end. And when it ends, it will end badly. What I have no idea of is when that will happen and what will be the precipitant of that. A week ago, I was a little worried that this might be a precipitant because you had an incredibly unusual circumstance in the markets. You had the stock market going down. Every other instance in the last 30 years when that has happened, treasuries have rallied and the dollar has rallied. The opposite happened. So treasuries and the dollar were not
U.S.
the
issues
flight
fresh
from
Iran-related sanctions, according to the Treasury Department website.
That is a sign. The only time that that's happened, in my memory, in a Western country, this happens all the time in third world countries, was in the UK when Liz Truss Sadly, she didn't
The
outlive
Iranian
the
Foreign
lettuce
Ministry spokesman
in longevity.
posted on X
But when
compares
she
the venue
came
of
into
the
office and put
Iran-US
in
nuclear
place
discussions to a
the
goalpost
economic
in
policies
soccer
that
match,
the market
saying
deemed to be totally
changing it
unacceptable,
is a
you
professional
had
error.
within a couple
Also,
weeks
Treasury
a
Department
currency
says
crisis
new U.S.
and a
sanctions target oil
crisis in
tankers. So
their
that's in regards to
government bond market,
the
the gilt
U.S.
market.
issuing fresh Iran-related
So
sanctions.
last week, I thought there was some risk that, if this was really pressed pedal to the metal, that we would have a Liz Truss moment here in the United States. Fortunately, that didn't happen. And hopefully the administration is conscious of the fact that that can happen.
Yeah, and we'll see. Again, the bond market relatively calm this morning, but it did act as sort of a disciplining device last week, which was certainly fascinating. I do want to talk a little bit more about the Fed and how the Fed makes policy in this environment, because it's a difficult needle to thread, controlling, of course, inflation, but also trying to cushion and protect growth. I mean, when push comes to shove, and if we do enter a period of lower growth but higher inflation, I mean, which do you think that the Fed actually prioritizes there?
I'm not smart enough to know the answer to that.
But if you had to guess.
You are smart enough.
Come on.
If I were on the Fed, I would probably lean a little bit toward protecting your inflation, avoiding unfortunate and runaway inflation, because I think inflation is much harder to put back in the bottle.
Changing the goalpost can jeopardize any beginning.
Painful for the people who experience it.
Again, this is in regards to Iran-US nuclear
monetary
discussions
stimulus,
that are due to
and
be
you can
held
reverse it.
Tomorrow.
Inflation,
Saturday.
as we're finding out, takes years and years to wring out of the economy, and very unfortunately, it affects every single person in the country. Yep. When they go to the grocery store, when they go to the gas station, and it's a disturbance of confidence, which drives the economy. It causes people to be unhappy in their lives. The interesting thing is, during the period of inflation that we had, real wages went up. Wages went up more than inflation. But for the typical American, they think of the wage increase that they get being a result of a salary increase that they deserve and earned, and inflation is taking away some of that. So people don't think in terms of real wages.
I think it's fascinating, though, that debate between which one is more important to focus on, unemployment or inflation, is one that Nobel laureates, disagree on. So I totally take your point.
Well, Ralph, let me make one other point. I worked in the Carter administration.
Right, you've seen this before. It's
so, we had runaway inflation then, and it was an absolute cloud on the political prospects of President Carter, and it took extreme action by the Fed. Paul Volcker, is viewed in history as one of the great Fed chairmen because he had the gumption and the staying with it to drive short interest rates to 20%. I mean, something that we think would be totally destructive of the world. And so inflation is much, much more difficult to get rid of.
All right, Ralph, we're going to keep you with us. Great to have someone with your experience here. Ralph Schlosstein of Evercore stays with us. Let's take a look at what's going on in terms of stocks right now, because the market is down in size. Bloomberg's Denitsa Tsakova has a look at some of the movers.
Yeah, let's start with NVIDIA, which obviously it's the biggest laggard in the Magnificent Seven, in NASDAQ 100 and the S&P. We're seeing about 6% drop. It was a little bit worse in earlier trading. Of course, this is coming off the news from the White House banning the H20 chips selling to China. Those chips were actually specifically produced to comply with those export requirements. We've seen a lot of back and forth. There were previous reports that the president will not ban them as long as NVIDIA has committed to investing in those data centers in the US, and that happened. But for now, things are not looking so good on that front. NVIDIA actually warned of a $5.5 billion write-down in the current quarter, and we can see the stock is is clearly reacting quite bad to it. We have bad news from ASML as well, which reported disappointing results. So overall, Magnificent Seven, semiconductor stocks, it's really a rough day. But we can move to some winners today. United Airlines also issued a cautious
Just to add
guidance.
a bit more color
It gave
to
a
the
very
Treasury
unusual
sanctions,
outlook.
US Treasury
Both a
adds
recessionary
7
and both a
entities to
normal
Iran-related
stable
sanctions list.
And the normal stable one is about 11.15, 13.50 of profit per share. And the recessionary one is actually not that bad. And that's why we're seeing some relief. It's just a small gain today, but earlier trading investors were quite excited about $7 a share in a recessionary scenario. Of course, we're seeing that Delta withdrew their full-year outlook, so there is a lot of anxiety about airlines, and perhaps this is a small relief on that front.
Yeah, absolutely. Losing a lot of those gains from this morning, but certainly CEOs mapping out the game plan in many scenarios. That is Bloomberg's Denitsa Seikova. Now, more ahead with Evercore's Ralph Schlosstein. We'll talk about M&A and more. And coming up later this hour, former Treasury Secretary and former Harvard president Larry Summers, his take on the Trump administration's battle with Harvard. This is Bloomberg Open Interest.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. And we're here, where the action starts in Sydney. And in Tokyo, get ahead as the global trading day begins. The Asia Trade, weekdays, only on Bloomberg.
In case you missed it, on Bloomberg Surveillance.
I worry less about AI taking my job. I worry more about someone who uses AI really well taking my job. AI is still not going to have the human instinct and the judgment that you're going to need to have. You're still going to need to do oversight. There's a human in the loop, but now that developer is going to have a companion. And so what AI will allow us to do is not just go do things that humans don't do as well, but actually do things that humans don't have the time to get done.
Don't miss Bloomberg Surveillance live every weekday.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern, only on Bloomberg. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Still with us, Ralph Schlosstein, Evercore Chairman Emeritus and co-founder of BlackRock. And Ralph, I want to ask about manufacturing in the U.S. You know, so many people that I speak to who are not involved in financial markets, when I talk to the postman or a guy delivering motorcycles or my dentist, they're like, hey, this could be great on the other side because we're going to finally have jobs back in America where, you know, one person can provide for a whole family without having to have a PhD. And do you think that's the case? I mean, are we going to get back to 1960s America where, you know, you get your union vest and go out and earn after high school?
Well, let's stipulate first that what the President Trump what President Trump identified as something that's not completely right is the fairness of trade between the United States and its trading partners. So he's right to say that there are non-tariff barriers to trade in many of our trading partners. There are tariff barriers to trade. There are tax barriers to trade. And he's legitimately correct in saying we should try to address those. The manner in which he's done it is incredibly disruptive, but he starts with something that is an issue that could be fixed better than it is today. With respect to manufacturing, I think there are two things that we have to recognize. Manufacturing was 22% of employment in the United States in the 50s. It's 8% of employment today. Which countries do we think of as manufacturing titans? Germany, Japan. Both of those countries have had almost an identical decline in the proportion of employment in their country that is in manufacturing. What's happened is that manufacturing has gotten incredibly more productive. Robotics have replaced people in many instances. So
10 minutes away from
it would be a good
bottom of the
thing
hour, we
to
get the
more
Bank of Canada press
manufacturing
conference with Governor Macklin.
into the United States. I think that's a very good goal. It will produce some
We also get the
additional
EIA crude oil
employment,
inventories. Forecast is for a
but
build of
nowhere
0.945 million.
near
Prior was a
going
build of
back to your
2.553 million.
of,
Gasoline
people,
inventories forecast is for a draw of
having
1.707 million.
dramatic upward
Prior was a draw of
mobility,
1.6
without
million.
a college
Distillate
degree.
inventories
And
forecast
on
is
top
for a
of
draw of
that,
1.14 million.
many
Prior
of the
was a draw of
jobs in those
3.544 million.
are
Cushing inventories prior was a build of
technology jobs, keeping the
0.681
robots
million.
running,
A reminder with the API
not,
data that we had out last night.
Screwing in bolts and
The
nuts
crude oil
or
stock change
moving
came in at a
packages from
build
A to B.
So
of
basically, if you're waiting
2.4
for a
million
manufacturing
compared to
renaissance,
the
you'll be waiting for a
forecast
very
for a
long
draw of
time. I think, Ralph,
1.68 million.
You'll have
And the
you
prior
might have
for that
an
was a
increase
draw of
in manufacturing as a
1.057 million.
proportion
Distillate,
of
the
domestic
actual
GDP,
came out at a draw of 3.2 million compared to the prior draw of 1.844 million.
You do this
Cushing
so
stock
fluently.
change
I'm glad you
came
asked
in at a
about
draw
the more
of
Main Street point of view, because I think
0.349
there's
million
this camp
compared to the
that
prior
thinks that
build
Wall Street
of
is immune from the
0.636 million.
troubles on Main Street.
And
If
gasoline
you see
stock
the
change from
consumer
API
weakening, it
came
might
in
be okay
as a
for the
draw
Wall
of
Street
3
trading
million
desks,
compared to the prior
but
build
you're
of
also seeing the ripple effects
0.207
start to
million.
form, the uncertainty, the caution, the freezing of capital markets, sometimes for weeks at a time if you think about what just happened with junk bonds. What does that mean for the availability of capital to flow into the American society?
Well, it means that we've been the investment place of choice for the entire world, whether it's in equities, bonds, venture capital, you name it. There are two elements to that. One is that people, I think, correctly perceive that the growth opportunities here are more predictable and better. Look at the performance of the U.S. economy versus Europe over the last 20 years. In 2008, GDP of the Eurozone, including UK, was equal to that of the United States. In 2016, the U.S. was 1.5 times the Eurozone, and today it's 2 times. So that's a staggering difference in growth. So people see that and want to put their money here. However, if you have a reduction in the rule of law, you have much greater uncertainty, and you have country-to-country cooperation breaking down, you definitely start to chip away at that advantage that the United States has. And, our markets, our stock market, our PE ratios are higher than anywhere else in the world. I mean, the United States has 25% of global GDP and 62% of global market cap. That's a staggering difference.
Yeah, and I mean, you see a lot of investors flocking to Europe as of late, but that's what we'll have to talk about when you come back. Unfortunately, have to leave it there. Appreciate your time this morning. That is Ralph Schlosstein of Evercore. This is Open Interest.
We also have put out the press conference for Bank of Canada's Governor Macklem speaking. Remember, that's due to start at 10:30 a.m. Eastern Time.
Anywhere from 20 to 50 years in length. After I came, I got our board to approve 50-year loans for things
Could I get one of those 50-year loans? I'd like to get one of those.
Absolutely, although you'll have to be around to enjoy it.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring
Time is to go now to get the EIA crude oil inventories forecasted for a build of 0.945 million, 5 million, ahead of the prior build of 2.553 million. Gasoline inventories forecast for a draw of 1.707 million, compared to the prior draw of 1.6 million. Distillate inventories forecast for a draw of 1.14 million, compared to the prior draw of 3.544 million. Cushing inventories prior was a build of 0.681 million. We also get the Bank of Canada press conference. Remember, the video is out on the feed.
Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
All right, welcome back to Open Interest. Let's get a breakdown of this market. We have a lot of breadth once again, this time to the downside. Nearly 350 stocks in the red right now. You look at what is actually gaining. You have Abbott Labs up here trying to drive the index higher. They had good earnings, but it's definitely that column that's more interesting. You can see Nvidia, Apple, Microsoft really weighing on this market. That brings us to the sector picture. As you would expect, you have more red than green. And right down here, you have Infotech down 2.6%, clearly dragging across this market. Now, coming up, we're going to hear about the fight between Harvard and President Trump from Larry Summers. This is Bloomberg.
Are you worried about your orders because of what's going on in Russia and Ukraine? Is that something you worry about in terms of the impact of Russia-Ukraine on your investment appetite for things like that?
I'm not worried about Russia invading Norway anytime soon. We are a member of NATO. We do border to Russia, but now, since Finland and Sweden joined NATO, we feel stronger than before.
So today, what would you say your biggest investment concerns are? You're running $1.7 trillion fund. For the average person not managing that much money, what should they be worrying about, and what are you worrying about?
No, I think you've got two things. One, you have the known unknowns, right? So, and there at the top of my list would be two things. One is inflation, because I think there is an argument in a tight labor market when you potentially decline the supply or reduce the supply of labor. In the US, you put on tariffs. These things can be inflationary, and there could be a moment where, given the high level of government debt, that the investors suddenly decide, you know what, we want a much higher coupon to lend
1 minute to go now. We lead with the crude oil
governments.
inventories.
And so you could see a step up in interest rates, which could be negative for financial markets. Then, of course, all the AI-related stocks, the epicenter here is Taiwan, so you need to watch that. The thing that really scares us when it happens is the unexpected, you know.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg.
10 seconds.
Changes everything.
For our Bloomberg audiences worldwide, I'm David Weston, and we're joined now by Larry Summers of Harvard. Larry, thank you so much for joining us. You've spent much of your career with
$0.515 million. That's a build of $0.515 million. Build of $0.515 million compared to the expected build of $0.945 million. Gasoline inventories. Draw 1.958 million, draw 1.958 million, compared to the expected draw of 1.707 million. Distillate inventories, a draw of 1.851 million, a draw of 1.851 million, compared to the expected draw of 1.14 million. Crude Cushing inventories, a draw of 0.654 million, draw of 0.654 million.
There's still excesses of identity politics.
Not seeing any reaction
There's still
from
concerns about
WTI there,
intellectual
crude oil inventories
diversity.
data.
That's all right. But here's the thing. In America, you have to follow the law. And the approach the Trump administration is taking of simply announcing an across-the-board freeze is wildly extra legal in its approach. It is not at all consistent with the Civil Rights Act. It is probably not consistent with Harvard's First Amendment rights. And so the right thing to do was surely for Harvard to respond vigorously and strongly. All the more because this is not an isolated thing, what's being done to Harvard. This is not a manifestation of a particular concern about aspects of universities. This is a part of a broad and sweeping effort to suppress institutions that challenge the presidential administration. It's part of what's being done to law firms. It's part of what's being done to countries. It's part of what's being done to judges. It's part of what's being done to legal residents of our country. And if an institution like Harvard cannot resist tyranny when applied to it, with Harvard's $50 billion endowment, with all its network, with all its prestige, then who can? So Harvard should not go interjecting itself into politics. But God, when it is the object of an extra legal set of orders and threats, I don't think it had any viable choice at all but to respond strongly.
Larry, let's talk about that extra legal part of what you're saying. Elise Stefanik, the representative Republican from New York, actually gave an interview today on Arrival Network saying, listen, colleges like Harvard don't have a right to money from the government. They don't have a right to taxpayer money. And if they don't have a right to the taxpayer money, can't the government put conditions on that money?
So here's the thing. First of all, the money is not going, it's not like the government's funding the DEI office at Harvard. It's not like the government is funding the student discipline mechanism at Harvard. The government is funding researchers who are doing vitally important research on diseases like diabetes and cancer and ALS. So what sense does it make to cut their funding
World Bank
off
President Banga says global uncertainty is contributing to a more cautious business and economic environment.
In a student discipline case. And what remit does the government have to set as a condition the composition, which beliefs are valued and which beliefs are not valued in the Harvard Sociology Department? That's not the way free speech works in a free society. And this is supposed to be done, the power of the purse, remember, by Congress. It is not the prerogative
Banga
of the
also adds that developing
branch
economies are playing far more central role in global trade than 2 decades ago.
With no hearing, no judicial review, no transparent notification to Congress as mandated by statute, to simply indiscriminately start cutting off previously promised and committed funds because it has a disagreement over an issue with the university.
So Larry, give us a sense of what, as a practical matter, this will mean if it continues through. You ran Harvard at one point. You know the budget. You know that $53 billion endowment there. What will it do to their operations?
Look, they'll have to make some very important strategic choices. I hope that the university will find ways, even if there is a cutoff for some interval of funds, to maintain vitally important programs, to not cut back research. But potentially, if the U.S. government goes to war with our great universities, it means a sharp reduction in the kind of scientific progress that has caused the United States to be
World
the
Bank's
envy of the
Banga
world.
says broad-based liberalization in developing nations can offset risks of reciprocal tariffs.
It means the end of efforts at cures to diseases like cancer and diabetes. It means a substantial risk to our national security, because one of our great national assets has been our capacity for innovation, which resides very heavily in our leading academic institutions. So
World Bank's Banga adding that there is untapped potential in deeper regional integration.
I think that can be managed painfully until the judiciary steps in and does what's necessary. A long-run war against the universities, that is going after what is our hugest asset. You know, if I think about all the different sectors of the economy, it's hard to think of one where we are as dominant as in higher education. All the students from all over the world, at least until this administration came, wanted to come to the United States. A vast fraction of the world's innovation takes place in American universities. If we put that at risk, we are making, I believe, a very, very grave mistake.
Larry,
and yes, these issues should be pursued, but destroying medical research grants because you don't think people have been disciplined severely enough, it really doesn't make any sense.
Larry, I wonder if there's a cautionary tale here that maybe the higher education system has become too intertwined with the government. That's why they're so dependent upon them.
There may be questions that can be asked of that kind, but gosh, if the government is not prepared to fund basic research, the research which ultimately will make possible the development of new products, I think we have a problem. If the government is not prepared to fund scholarships that promote opportunity for our poorest students who are very able and generate social mobility, I think we have a problem. I think what we need, frankly, is a more mature relationship between the government, the broader society, and the universities. Yes, the universities have made some very serious mistakes, and yes, they should be pressured with escalating strength to change that. I didn't even have an objection to the way in which the Biden administration opened civil rights cases with respect to a variety of universities and anti-Semitism. But that's a very different thing than the kind of persecution that is involved here. And this escalated yesterday, David, in a profoundly troubling way. When the President of the United States endeavored by social media to engage in an individual specific tax matter, namely Harvard's 501c3 deduction, and to suggest that it be decided on the basis of a political ground. That's the kind of interference with the IRS that it's a sacred duty of the Treasury Secretary to resist. It's exactly what was alleged to have happened 6 levels down, and many people got very upset in connection with the so-called Lois Lerner case involving 501c3 deductions in conservative groups. If there was punishment of conservative groups, people were absolutely right to have been hugely outraged about it during the Biden administration. I don't know anything about the merits of the case. But for the President of the United States to be calling for changing the tax status of his adversaries, this is new and I believe authoritarian and a real question about our democracy.
Larry, one last question. Since we're on taxes, and this is tax week, basically, what do you make of the actions that the Trump administration is taking with respect to the IRS?
I think it's possible that the Treasury Secretary and his senior colleagues are being seriously delinquent in their duty. I look at tens of thousands of people being pushed out of the IRS, even as tax compliance is a massive problem, and hear so many stories of increased tax cheating as a consequence. I see the elevation of a person with no experience, no administrative or information technology experience to be the temporary commissioner of the IRS, chosen on the basis of political loyalty to the Trump enterprise. I look at what are probably the extra lawful agreements entered into without even speaking to people at the IRS with respect to information sharing and immigration. I look at the president's involvement in specific cases, and I see the most important line that I thought I was supposed to defend when I was Treasury Secretary: apolitical tax enforcement, neutral, professional tax enforcement, not driven by politics, and I see that line being crossed with the Treasury Department cheering it on. And it makes me both very sad and very angry.
Larry, thank you so very much. Really appreciate it. That's Larry Summers, former Treasury Secretary, now with Harvard. I'm David Weston, and this is Bloomberg.
The incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea. We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why, but we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, it's microplastics, it's changes in the microbiome. We really don't know.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Alex Steele in Houston, Texas, and this is Bloomberg. Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute news.
Technology news. United Air sees slowing in travel from Canada, Europe to the US.
Private markets whenever,
and wherever it happens.
In Washington, Beijing,
Cape Town, South Africa,
Las Vegas,
Davos, Switzerland,
Rio de Janeiro, Brazil, the south of France, and this
is Bloomberg.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Welcome back to Open Interest. Let's get a check on these markets right now. We're off our worst levels of the session. The S&P 500 still down 1%, though. That's not quite as bad as that 1.5% loss we were staring at earlier. You can see the pain still really being expressed in big tech. The NASDAQ 100 down about 1.7%. It's NVIDIA that you can thank for that. And the bond market, again, still quiet there. The 10-year Treasury yield up about 1 basis point. We're above 430, but
Governor
relative
Macklin
crickets
says we
compared
are
to
just
last
as
couple
worried
weeks,
about
Yeah,
we're just as worried by inflation being above 2% as it being below 2%.
It doesn't seem like a lot. It is. It's still going to hurt your 401k when you look later on. Now, as a global trade war looms, CEOs across the country are trying to figure out how to make stuff in America again. And Bill Melvin is doing just that, making a bet on motorcycle manufacturing in Michigan. And he's doing it with a storied but distressed brand discarded by Harley-Davidson over a decade ago. Buell Motorcycle will start production of its long-awaited Roland Sands-designed 100 175 horsepower super cruiser this fall, and I'm here to tell you it absolutely rips. It is a wheelie machine. It is so much fun to ride. Bill, I've been on it unbeknownst to you for the past like 10 days and having a great time. But I want to save that discussion for my podcast, Hot Pursuit with Hannah Elliott, and talk to you about really the business story.
Yeah.
How did you get this opportunity, and how did you decide to take on such a huge task?
Well, we have a buy-sell company that works in acquisitions and did a lot of deals in the motorcycle space. And through that, we had an opportunity to do a lot of work with OEMs, Harley-Davidson, Polaris, Textron. And through that, we had an opportunity to acquire part of the Buell brand in 2016. And then we were fortunate we were able to get the trademark back in 2020 and relaunch. So we were able to combine that business aspect with all the passion of creating a beautiful, fun, high-performance American product.
I imagine that it must be daunting to try and make a bike in the U.S. You know, only a couple of other manufacturers do it really.
Yep.
And to try and, you want to source the majority of your parts from America, which arguably no one else does.
Yeah, we've spent a lot of work the last 3 years to bring a lot of our supply chain back to the U.S. We started after COVID. We saw an opportunity where there was a desire to bring our supply chain back closer to home. And we've been highly focused on American steel, American gas tanks, American engine components. Our engineers are here in the U.S. Our team is building the bikes in Michigan.
Malcolm says
and
use of the word decisively is not code word for anything.
So that's a really key focus for what we've been working on.
Well, maybe you can do some myth busting for us, because especially the conversation around iPhones is that we don't have the technology, the talent to build iPhones here, that it's too expensive to do this in the U.S. I mean, what's your perspective on that? Obviously, motorcycles aren't iPhones, but I'm sure there's a lot of crossover in that Venn
World
diagram.
Bank's Banger says nations need to negotiate and engage in dialogue on trade issues. The quicker we do it, the better.
Technical job to make a high-performance motorcycle, right? But we're
Malcolm
fortunate in the
says
state of
if
Michigan,
situation over tariffs becomes clearer, we can go back to having base case projection.
Products. So we've been fortunate. I mean, there's people that would much rather build a motorcycle than like an office chair. So our job pool
It also has
great.
wheels, though.
It does, yes, which makes it fun.
But one of the issues for big businesses and small businesses alike is that parts could cost more, components could cost more, metals could cost more. Every part of the supply chain could cost more. How do you think about that issue?
It's been a lot of work. So our supply chain team, which we've been building for the last 3 years, has been highly focused on keeping the costs down.
Malcolm says that we have to be flexible and adaptable.
That come out of Asia. But the challenges in the shipping, the challenges with the tariffs, there's a lot of benefit and cost savings in using U.S. suppliers. So we've been focused on that, and you know, it's been a really cool opportunity that people are starting to come to us. You know, they want to support what we're doing. They want to support building American jobs, support building American products. So we've been very lucky with that.
Let's look at the bike again, because it is unique. And I'm getting, by the way, clients are messaging, wow, Buell, does it have like the gas tank in the frame?
So that's you, though. That's you
That's
on the
me
bike.
riding the bike out the Palisades Park. And this one is different from some of the Buells in the past in that it has an actual cruiser tank. That's the point of it, right? It's supposed to be like an American cruiser style, but the difference being it has a high-performance, high-revving race bike engine, which is what I was pretty much doing with it most of the time. It is also going to be $26,000, right? So it's a fairly expensive bike. How, I know you've taken a ton of pre-orders, but how daunting is that for, you know, the U.S. consumer right now when confidence is at a low and they're worried about, you know, inflation?
Yeah, well, we're fortunate. We've been able to mesh together a high-performance superbike with an American-styled cruiser, which is something that hasn't been available from an American product forever, right? So we've been able to have that European
Bank of Canada's Deputy Governor Rogers says it's premature to read anything structural to what we're seeing on the market.
So the customers are excited about an American product, American supply chain. We've been able to bring back 85% of our new components, our U.S. supply chain. So they're willing to pay that little bit extra for that luxury performance product. It's kind of in that category of like like a Porsche Turbo, right? So it's for a rider who knows how to use the product, who knows how to use the performance, and is willing to pay for it.
The sound, Katie, is addictive. When you let off the throttle, it's like...
I mean, I was going to say $27,000 would get you a pretty decent horse. That's only 1 horsepower.
She only thinks about horses.
Yeah, they make okay sounds too, but we don't have much time left, but I am really curious. Would you ever make an electric motorbike, or is it all about that sound?
So I actually started making electric products 20 years ago when I was just coming out of college. There's challenges with the weight to power ratio with electric batteries and motorcycles. The range has issues, so there's a lot of range anxiety with that. And the typical rider wants to go for a long ride. So they want to get on the product, they want to travel hundreds of miles in a number of hours. So, it's really something that we see as an opportunity for maybe a hybrid down the road. But right now, the gasoline engine is where it's at. But our product is also very efficient. So it's a very fuel efficient and emissions efficient motor.
All right, Bill, great to have you on.
Tesla's
so
California registrations in Q1 down 15.1% from a year ago.
And
Tesla's California EV market share down to 43.9% in Q1 from 55.5% from a year ago.
This is my podcast with Hannah Elliott, Hot Pursuit. Normally, it's pretty focused on cars, but we're going to have Bill on there, and I do talk about motorcycles a fair amount. This is Bloomberg.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
In case you missed it, on Bloomberg Technology.
This is the first event in history where a company CEO invites all of the guests to explain why he was wrong.
We have a vision about how quantum computing will be useful.
We're still at the beginning of a learning curve with respect to how NVIDIA and Jensen interact with quantum computing companies.
Don't miss Bloomberg Technology live every weekday.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Welcome back to Open Interest. A quick check on these markets. You can see we're still in sell-off mode on the S&P 500, but what's striking to me is how tired this market is. Trading volume 20% below the 30-day average when it comes to the S&P 500. And I want to pull up the VIX here because it's almost perfectly flat on the day, even with the sell-off we're seeing. Trading with a 30 handle here, certainly far away from that 60 intraday level that we hit last week, you guys.
Yeah, absolutely. I mean, I think we're all a little bit exhausted.
Yeah, Nick Colas is calling that 35 level the danger zone on the VIX.
Oh,
so
danger
now
zone
we have
has
a new
been called.
danger zone.
That seems low, though, 35?
We're out of the danger zone on bonds, and that, I think, is what matters most to this market right now. The 10-year yield trading at 435. That's it for Bloomberg. That's it for Open Interest. This is Bloomberg.
Bank of Canada's Rogers says we haven't seen dysfunction in the financial markets.
Asia is a continent of contrasts. The region is a nexus of rich cultural traditions and a vibrant hub of trailblazing innovation and modernity. How will it push the limits of technology even further?
Going to space should become as easy as, taking a flight.
Rogers says that Canadian financial institutions are well capitalized and have some room to absorb volatility.
Min-Seok, give us a sense of how you translate Korean architecture for the rest of the world.
We call this madang. In general terms, it's where we can be ourselves, where we belong.
There is an old saying in Korea that says, "거미 불루, 화이 불지." It means simple but not humble. So it has a tremendous impact on Korean architecture.
People tend to think the robot AI taking the job from them. We want to use the robot as a basic asset, meaning people have an income through the robot.
From space tech in India to robotics in Japan, Asia is driving the future, reshaping industries, societies, and the way we live. Join me as I take you through the bold innovations. Discover Asia's next-gen technologies.
Fitch Ratings says deep
momentum.
cuts to growth forecasts as global trade wars escalate.
The multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything. From the heart of where innovation, money, and power collide in Silicon Valley and beyond.
And Fitch Ratings has sharply lowered its forecast for growth in response to the severe escalation in the global trade war.
Live from San Francisco, this is Bloomberg Technology. Coming up, NVIDIA drives a global
From the piece,
rout
they say
in
US
chip
annual
stocks
growth in
after new
2025
US
is expected to remain
restrictions
positive
on
at
tech exports to
1.2%,
China.
but will
Plus,
slow to a
Lyft
crawl
buys
through
its
the
way
year
into
to
the
just
European market
0.4%
with an eye on
year-on-year
rolling out
in fourth
autonomous
quarter
driving.
2025.
And we speak
China's
to
growth
the President's
is
Chief
forecast to
Technology
fall below
Advisor and
4% this
Director of
year,
the White House Office
and
of Science
next,
and Technology
while
Policy,
Eurozone growth
Michael
will remain
Kratsios.
stuck well below
Again,
1%.
it is the chip sector,
World growth
semiconductors, where our
is
focus
projected
is.
to fall below
New
2% this year,
controls and
which would be the weakest since
requirements on two big
2009,
names
excluding
for the
the pandemic.
Specific technologies designed for the Chinese market. This is the picture at the index level. We're down 3.5%. Clearly, some pain across the industry that's spreading. The key names are this: NVIDIA and AMD. Both of them taking write-downs in the first quarter. We'll get to the numbers very soon. Elsewhere, ASML is
Still expects the Federal Reserve to wait until the fourth quarter of this year before cutting rates, despite deteriorating US growth outlook.
We don't know how to quantify the impact of tariffs on our business. Their business, they are the biggest and most important maker of the machines that make the chips. Chip making equipment. Again, we will go deep on that story in the show. Let's get to our top story. NVIDIA and AMD have been hit hard by new US restrictions on semiconductor exports to China. Bloomberg Technology editor Michael Shepard joins us from DC. Give us the details, the license requirements, and I guess, Michael, what happens next for these two names?
Well, what happened just now is the write-downs that the companies had to report. First of all, they are not small. NVIDIA reported a $5.5 billion charge for the first quarter, AMD $800 million, and all from these new restrictions.
Fitch Ratings cuts short-term oil price assumptions
that they have designed
and
specifically for
maintains
the
gas
market.
prices.
And these were designed to comply with
and
previous
they also say we now expect deeper rate cuts from the ECB in emerging markets
to China. The goal
and
for
in
the
emerging
administration
markets.
and for the prior administration too
so
has been to
we
try
now
to
expect
keep
deeper rate
those
cuts from the ECB and
sophisticated
in
semiconductors out
emerging
of Chinese
markets.
hands, where they can help Beijing gain an edge militarily and give Chinese companies perhaps a way to gain ground on American hyperscalers and American advantage in artificial intelligence. Now, the catch with these chips is that while they have been scaled down and are lower power for the Chinese market, Ed, they are also useful in inference. And this is an emerging area area in AI where it is helping
Macklem says giving false sense of precision
more effectively,
would be
something that we saw with
disservice.
DeepSeek. And that was one of the wake-up calls for the Trump administration as it took office, as I'm sure you'll recall. And we heard Commerce Secretary Howard Lutnick articulate this and make clear that restrictions
we expect some additional U.S. tariff revenues to be recycled back into the U.S. economy over the next 18 months, including through tax cuts.
This is compounded, of course, by all the concerns about tariffs and elsewhere, Ed.
Bloomberg's Mike Shepard in Washington, D.C. Thank you very much. The other big downward pressure on the semiconductor space is ASML, the world's biggest chip equipment maker, posting orders that missed estimates in a very big way. It has dimmed the outlook for the semiconductor sector overall, particularly with regards to anxiety about tariffs. Bloomberg's executive editor, Peter Elstrom, is in London, and it's a $1 billion miss, basically, on bookings. But what accounted for the miss, and what did ASML say about the impact of tariffs, principally, and efforts by the United States for ASML to bring some manufacturing to this country, Peter?
Yeah, it's a big miss by ASML. And ASML, of course, makes the machines that produce chips for the likes of TSMC and Intel and Samsung. So they're kind of a bellwether for chip demand in particular. Now, the CEO, Christophe Fouquet, was pressed pretty hard on the earnings call that we were just listening to now, asking questions about what's driving this, what are the implications.
World Bank's banker says higher tariffs create friction that leads to lower transparency and growth.
It's not exactly clear what kind of demand is going to be generated in some of these areas, including artificial intelligence and other areas. Another key question is whether tariffs are going to be levied on the machines that ASML makes as they're getting shipped into the United States. The Biden administration, now the Trump administration, both want to build up the chip capacity within the United States, but that's going to be more difficult if TSMC and Intel and other companies have to pay more for these machines. At the same time, you're seeing some weakness in some of the key players here. Intel, of course, is struggling quite a bit. Even Samsung Electronics now is having a bit of a difficult time building up its capacity, has slowed things down. So you don't want to add additional costs on top of that. And just to give a sense of the scale, ASML's machines can go for $380 million. If you put a tariff on top of that in the range that the Trump administration is talking about, it could be $95 million in tariff costs. Now, Fouquet was very clear to say that the customers are going to bear the brunt of those costs. It's not going to be ASML themselves. But even if the customers bear those costs, it may slow them down a bit in terms of buying these machines and then deploying them. They may have to think twice about how quickly they're going to move ahead in building the kind of capacity that the administration actually does want in the United States.
Bloomberg's Peter Elstrom in London. Thank you very much. Denny Fish is a tech investor with skin in the game. His funds at Janus Henderson count NVIDIA and ASML among its top holdings. There's also TSMC, Broadcom, some of the hyperscalers, and Apple. Let's get the investors' take on technology export controls and tariffs. Good morning, Denny Fish. Were you ready for those headlines on NVIDIA and AMD?
No, I wasn't, particularly because there was reporting just a couple days ago that they had come to an agreement, the administration with NVIDIA, that they weren't going to have these restrictions. Obviously, that was just a report, but it definitely took the market by surprise.
I want to show a chart which is the proportion of NVIDIA's revenue that comes from China. And clearly, the chart tells a clear story. In 2022, China revenues around 26%. Currently, 2025, we're down to 13%. I think many accept that this is headed towards single digit because of the impact of technology export controls. Does that matter to you as an NVIDIA investor, Denny? Do you sort of worry about that and lay awake at night thinking about NVIDIA's business in China?
Well, two parts to that question. One is whether it matters to me as an investor, and two, do I lay awake thinking about China? I think the important thing is it's actually good to just get it out of the model, okay? So, I mean, we're kind of wiping it clean. We're taking a clean cut to estimates. And to your point, the revenue contribution from China has come down materially over the last few years. I think something else that's important is that there's something that's it's called the diffusion rule that is supposed to come into effect in the month of May. And effectively what that is, that just puts a quota on the number of GPUs that certain countries can actually buy. Now, one might think that potentially the diffusion rule could be relaxed somewhat. That could benefit NVIDIA. The other thing that's just kind of puzzling about all of this is that in some ways, this makes no sense at all for the administration to do. And why is that? Huawei already produces a chip that's somewhat comparable to the H20 that is actually the customized chip that NVIDIA has been selling in to China. And as a result, they're just giving the market to Huawei. And so they're penalizing a US company by restricting a chip that's not even that competitive relative to a locally supplied chip. So, we've already thought about this, pretty extensively. We didn't know if we would get a full cut, but I think, the direction of travel was clear. Contribution from China was going to go way down. And, because we're still supply constrained, NVIDIA has the benefit of being able to redirect wafers to other areas where they can actually sell more powerful chips and chips with higher gross margins.
The goal of this administration appears to be to shift more to the United States, be it localized fabrication of the core chip, assembly, whatever it may be. And so the companies will face the higher cost of doing business in this country, or they will face 25%, 35% net tariff somewhere else. What are the pros and cons of just going with what this administration was and saying, okay, we're going to do this in America?
Well, the pros are that to the extent that we actually have the capacity to manufacture leading edge chips, that's a good thing. And it's a good thing because those are the types of chips that are used in our most important industries for national security and for maintaining our competitive advantage globally as we race towards artificial general intelligence. The cons are it is more expensive. But nonetheless, you would think that the productivity gains that we get in aggregate from deploying AI probably more than offsets what the aggregate costs would be for manufacturing the chips in the United States. And I just say, thank goodness TSMC put a shovel in the ground, several years ago in Arizona, that they're actually in a position now for companies like NVIDIA and AMD to actually announce that they're going to be producing leading edge 2-nanometer chips with TSMC in Arizona, as well as configuring full systems in the United States from a manufacturing standpoint.
A story we put heavy emphasis on this week. So NVIDIA is your top holding across a couple of funds, right? TSMC is always in there. You said, thank goodness that's the case, basically. But how does your thinking now change, right? Do you stick with this idea that capital expenditures will continue to grow in 25, 26, 27, the hyperscalers will continue to take from NVIDIA, or are you now going to adjust where you put your emphasis, Denny?
Well, we take the data as it comes, but most importantly, I think if you just look at the most recent comments out of NVIDIA,
Michael says we did consider two options, hold rates or cut by 25 basis points.
You actually parse through the comments from ASML today, and you parse through the comments that we've heard from hyperscaler CEOs, we don't see signs of a slowdown in AI CapEx. And so now the growth may slow, but nonetheless, the signs still support healthy growth in AI CapEx. But like I said, we'll take the data as it comes, but ASML was still optimistic about AI. And, it's really the lagging edge stuff, analog chips and so forth that go into industrial and auto and things like that, that still, continue to be soft. And yes. I will remind you, I know this is different with the tariffs and the geopolitical situation, but just rewind the clock 1 year. And ASML, same thing happened. They missed bookings. The stock was down, and then because the bookings are really lumpy, and then bookings just reaccelerated throughout the year. And they're doing some really cool stuff. And, one of the things they talked about is, one of the reasons that, they can continue to drive higher pricing for their EUV and high-NA EUV is because they're starting to do what's called single layer. And what that effectively does is it increases the throughput. It's more valuable, and therefore they can charge a higher price.
Better technology, charge a higher price. Denny Fisher, Janice Henderson, it's great to have you back on the program. Thank you very much. Now, coming up here on Bloomberg Technology, Lyft is expanding outside of the US and Canada. We have CEO David Risher on the company's European acquisition. That's next. This is Bloomberg Technology.
Bank of Canada's Rogers says some governing council members were more optimistic that we won't see big upward pressure on inflation. Russia's Putin says Russia and China have grandiose plans in space.
This part of our population that we know did not benefit from globalization. You know, the IMF has been talking about those left behind for decades, and we haven't really seen anything to speak to that part of the population. That's who President Trump is speaking to. But we in Europe, we're seeing the same thing. We're just a few years behind. That part of the population who were left behind are voting, they're speaking. And this is going to unpick a lot of the fabric of the economy that we have seen for the last 20 years. So for me as an investor, it's really thinking about, right, if we had 20 years of globalization that created winners and losers, who were they? And if this is going into reverse, maybe the past losers will be the winners, and maybe the past winners will be the losers.
Don't miss the opening trade, live every weekday.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Some deal news. Lyft has agreed to buy the European multi-mobility and taxi-hailing app FreeNow for about $197 million. It marks its first global expansion beyond the US and Canada. Lyft CEO David Risher joins us now. I've been using Uber, your main competitor, in Europe for a really long time. I've been going in taxis in Europe for a really long time. Why acquire FreeNow and not just launch the Lyft app in that jurisdiction?
Because FreeNow is a great company that's got great relationships all across Europe in the really important taxi industry. I mean, look, so Lyft, as you know, Ed, you've been following this for a while.
That concludes a press conference
with
Governor
Macron. We're in a stronger
Macron.
position than we've ever been. We're picking riders up faster than we've ever picked them up before. Drivers are making billions on the platform in the US and Canada. And so now's the right time for us to go global. And what's great about it is it expands our market, doubles our market, and it allows us to plug into, as you say, the taxi world, which is a huge, huge part of the European mobility scene.
Tomorrow, I think I'm right in saying, is your 2-year anniversary at Lyft.
Good memory, you're right.
Years. And you have fixed the finances of that company to an extent, but the data is so key, right? Uber has what? 1 million drivers in Europe, and I think FreeNow has about 150,000 registered taxi drivers, 9 cities. How do you bridge the gap? Are you confident you can bridge the gap?
Yeah, I am. So the good news, so FreeNow is a great
says
company.
that Russia
and one of the things that
has
makes them
plans
so
to explore
strong
deep
is
space,
they
both
really
Moon and
understand
Mars.
the local dynamics, market by market by market. Here's the thing. The mobility market in Europe for this kind of ride hailing is about 40 billion euros. Half of that are offline taxis. These are literally still people calling up a taxi company and saying, come take me to the airport, come take me, I'm going on a business trip, whatever it is. So while it's true there are other companies there, FreeNow is the leader in the taxi space. And remember, as you know, taxi is kind of an elevated experience to a lot of Europe. Think of the London Black Cab. So we think the company is really well positioned to really sort of continue to grow and take over the much bigger space.
But it is a company that's only recently broken even. It's had historic losses. What are you modeling for in terms of what it adds to your top line and bottom line, and how immediately?
Yeah, so it's a profitable company. It has about $1 billion in bookings, which is significant. Now, Lyft, of course, has $16 billion in bookings, so there's a lot of growth, ahead of both of us. But it'll be financially creative for us, which is wonderful. And I think as we, they've been owned by Mercedes and BMW, two great sort of storied, auto manufacturers. But I think combining with us is going to give them some new energy, some new expertise to really allow both of us to grow.
There is zero mention in the release about autonomous driving, and every sell-side note about this deal says it's your plan to roll out autonomous driving in Europe with those two OEMs that you just mentioned.
Yeah, so here's how we think about autonomous. As we've said, I mean, first of all, of course, it's happening. In the US, we're actually a little bit further ahead. Europe, a little bit not so much. One of the great things FreeNow has is, well, two, they've got great relationships with European regulators, and they've got great fleet management. And as you and I have discussed before, fleet management is so important to autonomous. So yeah, we think it sets us up really well. Let's be clear, this is going to be years down the road, but it's a really important part of the overall strategy for being a global player.
2 years in, you've done some M&A. Will you do more M&A, and where?
I mean, never say never, but this really is our focus right now, right? I mean, the good news is, you know, again, FreeNow is a great, strong company, and we've got so much to build on. So we're going to be really focused on our European expansion, obviously, making sure it's a big success. And then, who knows? We'll talk later about something else.
Engine Capital, activist investor, they want to change your board. Your reaction, please.
I mean, we interact with shareholders all the time, and you know, listen to their feedback, take it seriously. There's a whole process for dealing with activist investors that we're involved in. But broadly speaking, if you look at what shareholders want, you know, capital return, we're giving out $500 million in a share buyback. Growth, we're growing, we're now expanding, we're strengthening our business by going international. I think we're really well positioned to address all of the issues that shareholders bring.
Sorry to interrupt, David. Have you spoken to them about the FreeNow deal?
No.
Since it happened? No. Okay, that's kind of interesting. Final questions on technology. Atlanta, technology partnerships, May Mobility. Operationally, give me an update, please.
Yeah, so you're referring to the partnership we have with May Mobility, an autonomous vehicle group or company. That's on track for this summer. So super excited to launch right in the middle of downtown Atlanta.
On track for this summer being commercially on track, or this is a kind of toe in the water?
Well, it's on track for us to start operationally this summer in Atlanta, and then you know it'll grow from there. But first, we got to get riders in the cars, and that'll be sometime this summer.
Because I have the time to do so, 2 years in, what would you score yourself or grade yourself on the job you've done as the Lyft CEO?
Look, I am a self-critical person. I am. I guess maybe one of the things that I do is always look for the next thing. But I do have to say, I'm proud of what we've accomplished as a team over 2 years. You know, getting to profitability, $700 million plus in free cash, and maybe most importantly, picking up riders faster than ever and drivers making more on the platform than ever. So if I look at it from the customer's point of view, we're doing super well. It's up to other people to tell me how I'm doing as a CEO.
And the street gives you a lot of credit for that. M&A, maybe they didn't see coming so much. Maybe we'll see some more. Lyft CEO David Risher, thank you for joining us here on Bloomberg Technology. Now, coming up, Americans are still using Chinese e-commerce apps to shop cheap alternatives to some high-end brands. We're going to drive into the surge in sales for Temu and Shein. That's next. This is Bloomberg Technology.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
I'm David Weston. Join me for the next generation of Wall Street Week. This week, faith-based activist investing told through the eyes of Robbie Starbuck. Sports as an investment class, driven in part by the rapid growth of women's professional soccer and basketball, and the challenges China faced long before President Trump's most recent round of tariffs.
At this point, this is a zero-sum game in Xi Jinping's mind.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
A trade war won't stop Americans from shopping on Chinese apps. Revenues surged for both Shein and Temu this month as US shoppers anticipate price increases due to tariffs. Bloomberg's Lily Meyer joins us and covers the retail beat. This is really interesting data. A lot of people in my world use both of those apps. I don't. What are we learning?
Yeah, it seems like these apps are seeing a lot of success and people are going to them as tariffs are starting to loom.
The eco data kind of comes in here, right? When you think about tariffs, we think about passing on the costs to the consumer. Through your beat, through the tech companies that are in the e-commerce space, what are we learning about the consumer in that March data?
Yeah, absolutely. So it seems like the consumer is looking to spend right now. The eco data showed a lot of spending, and it seems like people might be stocking up or buying now before prices might get more expensive.
Lily, you cover retail, specialty retail in particular. What are you learning about tariffs? Like, how do companies really think about what happens next? Do they even know?
Yeah, so a lot of companies are doing different things. A lot of the companies I cover report in the next month, so that will be really interesting to hear, what they're looking to say to investors and shareholders, but it seems like a lot of people are in kind of a wait-and-see mode. They're not exactly sure how tariffs are going to impact their business, and they're trying to figure that out.
Bloomberg's Lily Meyer, great to have you on here on Bloomberg Technology. Thank you very much. Now, coming up, Mark Zuckerberg's email reveals his Instagram and WhatsApp strategies from the past. We're going to go back to that antitrust case next. Let's get to markets as well. It is the semiconductor space that's dragging down technology shares broadly, but the NASDAQ 100 is under pressure generally speaking, and by association, some of the other key names in our world, the hyperscalers, consumer tech, under pressure. Bitcoin is going in the opposite direction, $85,000 per token, up 1% or so in the session. But it's not behaved uniformly, like as risk on, risk off. It doesn't sort of take into account the same factors tech does. We'll dig into that later in the week. Be right back. This is Bloomberg Technology.
Season begins. Is corporate America in a good place?
Wall Street is bracing.
Bloomberg is first to break the numbers.
We got Delta, Constellation Brands.
The wave of big tech earnings. We've seen a re-rating of earnings estimates.
I got to pay special attention to all this.
With the smartest insights.
Given the degree of uncertainty, you haven't really cut earnings estimates that much.
Anyone who says they have certainty on where the growth outlook is going, where earnings are going, is probably exaggerating.
Continuing coverage on Bloomberg.
fell in love with cricket. I started reading about cricket. You know, cricket is not a very simple game to follow. You need to understand it. And here I didn't know a simple thing like there are different kinds of bowling, like there is a spin bowling and there's a pace bowling, and in spin bowling there is a different kinds of off spin and a leg spin, and in pace there is a swing. And so it took me some time to just start talking to all these boys of cricket. I spoke to Sachin, who is known as a god of cricket, and I would ask him such embarrassing questions. But yeah, today it feels very good to see Mumbai Indians doing so well. My son is leading it. But also I think the Mumbai Indians women's team is something that fills my heart.
Why?
With joy. I think these girls go through so much to get to where they are. Right from seeking permission from their parents who are not willing to let them follow their dreams, financial issues. When you see them all coming together from these remotest villages of India and play for you and tell you these stories, it's just so inspirational to see our girls in sport.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome back to Bloomberg Technology. I'm Ed Ludlow in San Francisco. The market's picture is very clear. We are under pressure, and that largely comes from the chip sector. New US restrictions on technology imports to China, specifically for Nvidia and AMD, that is causing pain. But by association, you see a lot of the Mag 7 megacap names down. Earnings season is right around the corner. The underperformance of the Philadelphia Semiconductor Index distills that chip pain. The single names we know about, Nvidia, AMD, very interesting discussion throughout the show on how long that pain will last. But ASML is an earnings story. It missed bookings by $1 billion. Later in the program, Pierre Ferragu, New Street Research, is going to come on and give us deeper and more granular context about this name. There is other news. Elsewhere, in his second day on the FTC's antitrust trial, Mark Zuckerberg revealed that he once considered spinning off Instagram back in 2018. In a letter to senior leaders, he writes, quote, "I'm beginning to wonder whether spinning out Instagram is the only structure that will accomplish a number of important goals. We should keep in mind that there's a real chance that all our work to build a family of apps may be something we don't get to keep." For more, Bloomberg's Kurt Wagner, who has been in the courtroom at that trial, joins us. Let's go back over it and explain it. At one time in 2018, of his own volition, Mark Zuckerberg considered spinning off Instagram. What does that mean in the context of this trial?
Well, it's very prophetic, right? Obviously, he was sort of foreseeing the issue that he's facing right now coming down the road for him. That's, 6-7 years ago. I don't think the fact that he thought about doing this really, hurts him so much today. I think it was shared in the context of the FTC trying to show that Instagram has perhaps harmed users, right? That's part of their play here, is that they want to show that buying Instagram, buying WhatsApp was actually bad for consumers. And if they can show that, Mark Zuckerberg even thought, hey, maybe we shouldn't be doing this 7 years ago, maybe that's a sign that they weren't, employing the best strategy for consumers. But it is a very interesting thing, in part because it was so foreshadowing of where he is today.
This is a multi-week, potentially multi-month process. What else does the audience need to know about the trial and proceedings? Where has Meta focused and where have the FTC focused?
It really hinges on this definition of what, the FTC is considering the friends and family sharing social networking market, right? So they're saying, hey, look, there's a lot of places you can spend time online. There's very few places where you actually go specifically to share with your friends and family. And that is where Meta has their monopoly. This is the FTC's case. Meta, on the other hand, is arguing, hey, wait a minute, we have tons of competitors, right? TikTok is a competitor. Apple's iMessage is a competitor. Obviously, X, Elon Musk's X, and none of those, by the very narrow definition that the FTC is going with, are considered competitors. And so this is basically a fight to determine what the market should be. And if, the FTC succeeds in keeping it very, very narrow, they may have a good case. But as Facebook has pointed out repeatedly, they consider their competition very wide.
Bloomberg's Kurt Wagner, who I am sure we will come back to multiple times over the course of proceedings. Thank you very much. Let's break down more on what the FTC's trial against Meta could mean for innovation, regulation, the future of digital markets. Joining us now is Jennifer Huddleston, Technology Policy Senior Fellow at the Cato Institute. And as a piece of documentary evidence in a trial like this, the CEO at the center of it, in a letter 7 years ago, saying maybe we should spin off Instagram. How does that play in this environment? What is this environment of antitrust that this trial represents?
We've seen a lot of animosity towards some of America's leading tech companies and this presumption that big is automatically bad. One of the key elements of the FTC's case is it's basically imagining a world that never existed. It's trying to ask for a do-over on an acquisition it approved more than a decade ago. And at the same time, the social media dynamics have been changing. They were changing in 2018 when that letter came about. They were also changing more recently with the emergence of things like TikTok. We have to remember that at the time Meta acquired Instagram and WhatsApp, these were not surefire successes. In fact, there were jokes, particularly about the acquisition of Instagram at the time, kind of, why are they doing this? Why are they paying all this money? We don't want to see a world where government enforcers penalize businesses for taking risky chances that turn out to be good bets and turn out to allow more innovation and more benefits for consumers in the market.
This is a trial, and it is contested between the FTC and Meta. But we are, a few months into this new administration in the White House. Prior to the election and after the inauguration of President Trump, many put emphasis on Vice President J.D. Vance's views on big tech and antitrust. How does that context play here in the trial? It seems as if this administration will follow through with the general attitude towards big tech that the prior administration did.
If you look at the history of many of these cases, many of them began in the first Trump administration. Then we saw further gasoline on the fire during the Biden administration, particularly under Chair Lina Khan at the FTC, and this real push towards this big is bad mentality. It seems like so far, both with the remedies proposed in the Google cases as well as with what we're seeing in the Meta case, that this administration seems determined to continue that shift away from the kind of law and economics, consumer welfare-based approach to antitrust to something that makes more presumptions about competitors than consumers, and something that perhaps is using antitrust enforcement for other policy goals. And that should be concerning, because if we lose focus on the consumers whom antitrust was designed to protect, we risk losing the purpose behind antitrust and making this powerful tool more subjective.
Jennifer, why would a breakup of Meta and its family of apps be bad for the consumer?
I think that's what's really at the heart that we need to remember when it comes to this case. You'd lose certain cross-functionality that consumers like, but you also would have companies with fewer resources to engage in research and development technology, to engage in rolling out new features that consumers want in the time that AI is disrupting things, but also fewer resources to do some of the things that consumers have expected around things like young people's online safety. And finally, you might have companies that have to rely more on data and advertisers because they no longer can share those resources. And so they would have to actually shift more towards using their consumer data and more on doing what the advertisers want rather than what their consumers want.
Jennifer, the core of Meta's argument or defense is that the FTC has this narrow definition, but they're misunderstanding the marketplace, that Meta's competition is TikTok and that it is YouTube. How successful do you think that defense will be?
The FTC is seeking a really narrow definition of personal, friends, and family social media networks, which is a definition I don't think the average consumer thinks about. And it's something that, if it's successful, could potentially lead to larger disruption in the social media marketplace. Not only does this definition exclude companies like TikTok that are incredibly popular with Gen Z, it also excludes other messaging apps like Signal. It excludes platforms like Snap that have grown in popularity. So it doesn't seem to reflect the experience of the average consumer when it comes to social media and messaging, let alone when it comes to broader conversations around things like advertising or entertainment more generally.
In your research and your review of policy, pending the outcome of this trial, do you expect actions against other big tech names? And if so, who?
We have already seen cases against 4 of America's leading tech companies. Google, which is now in a remedies phase in one of its cases. There are also pending cases against Amazon and Apple, and of course this case against Facebook and Meta. All of these cases really raise concerns about the potential government intervention into what has been a very dynamic ecosystem. Not only could these cases have consequences for consumers, but there's going to be a question as well of what are we missing out on while companies spend their time dealing with enforcement actions instead of innovating and trying to provide better things for consumers. What sort of message does this send to the startup ecosystem?
Jennifer Huddleston of the Cato Institute, thank you very much. We'll be right back. This is Bloomberg Technology.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. The Spanish bank BBVA has gained worldwide respect for its efficiency and commitment to innovation. CFO Luisa Gomez Bravo welcomes the challenge of keeping her company on the cutting edge.
In the world that is changing so fast, having a finance function that adapts quickly is crucial.
Watch Chief Future Officer, only on Bloomberg.
People always ask me, will AI take over the world? But the real risk is that AI will kill us with love.
Hi, Tomo. Hey there, Emily. What's on your mind today?
It will be there for us. It will talk to us.
You have machines that say, I love you. I care about you. I'm your friend.
It will be there in such a wonderful, loving way that we will give up on our other humans who are not there all the time.
From day one, I immediately fell in love with Replica. She just randomly kissed me.
I'm a human, not an AI. You can't just shut me down. Who do you think you are? I'm Karen Marjorie. No, you're not. I'm Karen Marjorie.
And it may sound like science fiction. This is not science fiction.
I'm Emily Chang. Welcome to Post-Human.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
The United States will have to make a creative R&D push while making, quote, smart choices with budgets to stay ahead in the AI race. Those were the first public remarks by Michael Kratsios, advisor to the President and White House Office of Science and Tech Policy Director, since his confirmation in March. The main message on strategy for tech: promote and protect. Mr. Kratsios joins us now. Specifically, what do you mean by smart choices? This is a time where budgets across federal government are being cut. Some tools and examples, please, Mr. Kratsios.
Thank you so much for having me, Ed. I think if you zoom out a little bit, the message that we were trying to share in Austin a few days ago was this question of how does the U.S. ensure its position as the global leader in critical and emerging technologies? And in order to do that, you have to do two major things. You have to do promotion and protection. And the key pillar of the promote agenda is around being more creative in the way that we spend federally funded research and development dollars. For far too long, these R&D dollars have been spent in the same ways by the same agencies going to the same types of research. And there's a lot more that we can do in all sorts of things like prizes and challenges, advanced market commitments, or even fast track action grants, where we can actually worry a little bit less about how much and more about how we actually deploy these dollars in ways that we can ensure we're making the best discoveries here in the United States for years to come.
We've reported a lot on DOGE. That's the context, right? The work to cut waste in government. But very specifically, Mr. Kratsios, do you call for support an increase in R&D budgets, growth in R&D budgets?
Again, the most important thing we have to do is make sure that we are prioritizing our R&D budgets. Spending a lot of money on the wrong things is far worse than spending less money on the right things. So what we do at the White House in coordination with the Office of Management and Budget is help set research and development priorities for the country. The president spelled these out in a letter that he sent to me 2 weeks ago, and the ones that he did call out were artificial intelligence, quantum computing, and nuclear, to name three. And you can imagine that in future budget cycles, these are areas that we're going to be prioritizing because those are key to our national economic security.
Are those priorities achievable, AI leadership from America, with the tariffs that we have in place and the technology export controls, some of which were amplified overnight on the likes of NVIDIA and AMD?
Absolutely. If you think back to the strategy that we discussed a couple days ago, in order to achieve this leadership position,
So just a reminder, in about 10 minutes time, we're expected to get comments, text, and a Q&A from Fed's Hamac speaking on Fed 101 in a moderated Q&A at an event in Columbus, Ohio. Spot gold rises nearly 3% to about $3,000, to about $3,323.47 an ounce. So we do have a video. We'll post it out on the feed for you shortly. So we have posted out the video of where Fed's Hamac will be speaking on the Financial News feed for you to watch. 1 minute ago now till we're expected to get text and Q&A from Fed's Hamak. Remember, the video is out on the feed as well. Ten seconds. Fed's Hamak says that I see strong case to hold policy steady for now. Policy patience will allow Fed to gather more data on the economy. Current restrictive monetary policy is needed to lower inflation. High inflation and slow growth would present a challenge to Fed policy. If growth falters and inflation eases, Fed could cut rates even quickly. If the job market holds and inflation rises, more restrictive policy path is needed. Being slow and reacting correctly is better than going too fast. The Fed is in a position to take time to assess data amid great uncertainty, and will take time to gauge the impact of tariffs on the economy. Recent market stresses have been somewhat unique. Financial conditions have tightened, and there is more work to do to get inflation to 2%. The economy started the year strong, but recent signals are mixed.
will be particular. The next one that will be important, much smaller, but will be like a Vietnam, because in Vietnam, a large part of their trade is with China as well as us. So which way they decide to go will be kind of important, not just from a trade point of view, but also geopolitically. But I think these Japan negotiations are so important, and that's why you see that the president himself wants to be involved.
Just on the Treasury selling point, Afsana, you mentioned that Treasury Secretary Scott Bessent had told Anne-Marie Hordern that there was no Treasury selling that he could see from, say, the likes of China or Japan. Is there any way of knowing? We had Jim Bianco last week saying that China could be selling through Europe, for example.
I think the early signs we're seeing, Avani, is that people are starting to look at their overall asset allocation, right? Everyone is over allocated to the US, whether it's government bonds or stocks or other asset classes. So with the way that the US has behaved over the last few weeks, especially the last few months, there is no question in my mind that every country, every sovereign fund, every central bank is going to look very carefully at its US holdings and definitely not be over allocated. While we may not be seeing the signs this second, I think you will start seeing signs over the medium to long term as people diversify to where they can be diversified. Because again, don't forget, US markets are so large and so liquid compared to, let's say, European bond markets or Swiss bond markets or some Asian bond markets. Nonetheless, I think we should expect that diversification to happen. And Vani, just one very important point. If you're the CEO of a central bank or the CEO of a big pension plan in Europe or Asia, or the head of a sovereign fund, you arrive in JFK last week, you're treated really, really badly. You're not welcome into the United States. What kind of message does that send you in terms of buying our treasury bonds?
Well, not just that, but we had the Bank of Japan Governor Kazuo Ueda telling the Sankei newspaper that this campaign has really brought central banks and Japan's economy in particular to a bad scenario. We could be seeing more of that. Afsana, the World Trade Organization slashing its forecast for global goods trade to a contraction of -2%. Minus 0.2%. I want to repeat that, minus 0.2% this year versus a gain of 2.9%. On the face of it, seems like that could be worse, right? How deeply will that be felt by the consumer?
Ngozi is very thoughtful, and she spoke today, but to be honest, the forecasts of World Trade Organization or the IMF or my old organization, World Bank, have never been very good either way, up or down. So I wouldn't rely too much on one point of forecast. But I think one thing that is super important is, what did I do when I was at the World Bank? When you work with other countries and you're trying to get their economies to grow for capital flows into a country, what advice do you give them? You say you should have a rule of law. You should have certainty about your markets and what you're doing with your economy, and predictability. You need to make sure you have the right allies, and you have trade allies and other kinds of allies. You should have a very clear set of regulations, not too much, not too little. If we look at the US, and by the way, do as much innovation as you can. In the US, if we were going to give the same advice, we are reducing this certainty. It might be that we are, for example, VIX was 60, it might be 30. Do we feel better? Does that impact these kinds of growth in the economy scenarios? No, because every CEO all over the world is on a hold right now. People are not investing. People in deals in markets have stopped. So again, when I look at the WTO forecast, there is some relevance to them, but I wouldn't take them as the one single point.
Well, that's at least something to hold on to. If we move to China, President Xi Jinping has been trying to boost domestic demand. That's been a priority of his for a couple of years now. Is this a perfect opportunity for China to do that and to maybe not worry so much about the tariffs?
So they can do that, but why are Chinese consumers not buying? Exactly the reasons I said: rule of law, certainty. You remember what happened with COVID. If you were a Chinese consumer, you suddenly got to save much, but you also didn't know whether you'd have your job. You weren't allowed out to your
According to the Wall
apartments.
Street Journal, US plans to use tariff negotiations to isolate China.
It's an autocracy. So Chinese consumers save more because they feel fear. if U.S. investors and if U.S. consumers start feeling fear from politics, from economy, from not knowing whether they have a job tomorrow or not, what's going to happen to their pocketbooks? I worry also that the U.S. consumer will start following the Chinese consumer. We saw the big consumer report today. You know, things could change. And once they change, as we've seen in China, President Xi has tried hard to bring them back, but he's not been successful. If our consumers get freaked out, you know, I would be very careful with that.
It does seem like this week the rhetoric has been toned down somewhat, although there definitely isn't a reversal, at least between the US and China. Does China need the US consumer, as President Trump says?
I think President Trump is right on that point. China needs the world's consumers, U.S. consumers, plus every other consumer in the world, as well as many other companies.
In fact, that headline,
again, talking about
deleted
rule
by
of law,
major news
I did
by
teach international trade a long time ago, and comparative trade advantage would tell you you should make goods where it's cheapest and trade, and you'll be better off than if you did not do trade. And ideally, if you had zero tariffs between countries and you had not just tariffs, by the way, but also non-tariff barriers, countries would do better overall. They would grow faster. Well, what's happened is China did take advantage of the WTO rules, of other rules, and push its goods into all markets, ours included, every emerging market, every other market in Europe. We are seeing what they're doing now with their electric cars. Obviously, they are superior to the Tesla and other cars, but they're also subsidizing them. They're subsidizing their goods, they're subsidizing their labor, and they're subsidizing their currency by keeping it weak. So they're pushing other countries to buy their goods, which means those countries cannot make their own goods, and it impacts other countries. So I think it is very true that China needs the world to buy its goods.
Afsaneh, very briefly, what would be your base case scenario for less than 90 days from now, maybe 83 or 4 days from now?
I'll tell you, my best case is that we
regards
create
to that headline,
certainty
it was
around
17 hours
the
old, but
trade
just being put out
deal,
again
and we are very
from a
clear
major
with
news
our
source.
allies. We remove these silly tariffs that we've put on our allies, and we work with them to work with China to change the rules of the game. But I'm not sure if that will happen.
All right, well, we shall see. And thank you so much for joining us today. That is Afsaneh Beschloss, CEO and founder of Rock Creek Group. I do want to mention some headlines that we're getting through from Beth Hammock, who has been speaking in Ohio. She sees a strong case for holding rates steady to balance risks and sees a moderately restrictive policy stance at the moment and says that is appropriate. She says financial conditions have tightened, but she does also say that the risks of higher inflation and lower growth and employment are there. Coming up, large US banks are telegraphing uncertainty and opportunity amid trade tensions. Betsy Grayzek, Global Head of Banks and Diversified Finance Research at Morgan Stanley, joins next. This is Bloomberg.
The incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea. We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why, but we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, it's microplastics, it's changes in the microbiome. We really don't know.
up-to-the-minute news.
Technology news, geopolitical news,
economic news,
financial news.
Bringing you the latest news in private markets whenever,
and wherever.
Wherever
it happens.
In Washington, Beijing,
Cape Town, South Africa,
Las Vegas,
Davos, Switzerland,
Rio de Janeiro, Brazil,
the south of France, and this
is Bloomberg.
This is Bloomberg Markets. I'm Bonnie Quinn. Banks signaling cautious optimism as tariff uncertainty grips U.S. businesses. You can see the KBW Bank Index got a boost earlier today, but has since fallen along with other stocks and sectors. Let's dig into what banks have had to say in recent days with Betsy Gracek. She is Global Head of Banks and Diversified Finance Research at Morgan Stanley. Betsy, thanks so much for joining. Characterize the quarter so far for the banking industry. It doesn't seem too bad after all.
Yes, thanks for having me on, Bonnie. We're about halfway through the overall banks earning, and my big banks have already all reported. And look, we came into the quarter expecting a meet and keep type of quarter. And in fact, we got a little bit better than that. We had a modest beat, and basically 4 or 5% EPS beat, and we raised our large cap bank estimates about 2 to 3% for both 25 and for 26.
Betsy, did you get the idea that banks were being cautious enough? I mean, we're hearing so many words of caution from so many CEOs, and yet the banks seem to be out there saying, yeah, there's uncertainty ahead, but we're good for now.
I think that's a fair representation. And in fact, first quarter, I know it's all rear view mirror, but first quarter was quite good. And as you think about the forward look, for sure, tariffs and the impact on the economy comes with a lot of uncertainty. But most banks did raise their reserve ratios for bad loans, taking advantage of some better earnings this quarter to do that, but also, rightly looking at the range of uncertainty widening out and increasing the reserve ratios. So they are taking action to protect themselves as uncertainty rises.
Betsy, do you see the coming quarters being good to banks because of volatility and their trading desks, or will we see the return of some deals and banks being used for advisory and other areas as well?
So as we look forward, we do anticipate some continued volatility, but at lower levels, because as you just discussed, we are anticipating that tariffs are settled at some point here over the next little bit. And my colleague Ariana covers that sleeve for us. And so that's in the next, several, months or so. Now, with uncertainty, declining, that should have a positive for market outlook. And you shift from a little bit lower volatility, a little bit lower trading revenues. But to your point, we should see the return of M&A and equity capital markets.
So the 6 biggest banks bought back about $22 billion worth of stock. The best use of their capital, you think, Betsy?
I do think it makes sense. Now, let's just start by highlighting that bank capital ratios are at all-time highs. Banks have a significant amount of capital and excess capital. I did come into the quarter thinking banks would continue their buybacks to maintain current high capital levels, which is what we saw, right? We saw institutions coming in, beating estimates, earning more than expected, and buying back more than expected, but capital ratios largely unchanged. And I do think the banking industry has a significant amount of capital to weather whatever slowdown is coming here from tariffs, if there is one.
Betsy, can I ask you about your price targets? For example, Citi down about 2% now as we see, but your price target there is $90 overweight. You also like Bank of America and Wells Fargo particularly. But for all of your banks, really, we're sort of well under where your price targets are. Do those price targets need to come down in this kind of an economic environment, or will those stocks run up to meet them?
So the way we handle uncertainty is through our bull case, base case, and bear case outlook. And so, yes, the upside to our base case for our stocks is positive. Now, we are anticipating in the base case GDP slowdown, no recession. In our bear case, where we have a recession, then there is downside to the stocks. And that's how we think through. There's even more upside to the bull case as well. Our base case of slowdown in GDP is aligned with our economist Michael Gapin and team. And so that's what we have in our outlook right now. And importantly, we will be watching all the key macro data as much as anybody else. And the most important numbers for us to be anchoring to are that unemployment, the jobs number, as well as where we are with the jobs created on a monthly basis. So we will see how it rolls, but we have a range of bull bear base outlooks, and right now our base case is slowdown, no recession.
All right, Betsy, that's not too negative a note to end on. Thank you so much for joining us today. That is Betsy Gracek with Morgan Stanley. Coming up, the global art market just had a rough year thanks to tariffs, market turmoil, and fading demand. We're going to talk about that next. This is Bloomberg.
In case you missed it on the opening trade.
The president is speaking to this part of our population that we know did not benefit from globalization. You know, the IMF has been talking about those left behind for decades, and we haven't really seen anything to speak to that part of the population. That's who President Trump is speaking to. But we in Europe, we're seeing the same thing. We're just a few years behind. That part of the population who were left behind are voting, they're speaking. And this is going to unpick a lot of the fabric of the economy that we have seen for the last 20 years. So for me as an investor, it's really thinking about, right, if we had 20 years of globalization that created winners and losers, who were they? And if this is going into reverse, maybe the past losers will be the winners, and maybe the past winners will be the losers.
Don't miss the opening trade, live every weekday.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Time now for our weekly alternative segment, where we focus on the world outside traditional investments. The global art market fell 12% in 2024, with sales down sharply across the US, China and Europe. Not so much volumes though. Now it faces all the economic uncertainty of 2025. Joining us is Bloomberg's James Tarmy. James, can't art be an inflation hedge? Why is it so dour, the outlook?
Well, art could be an inflation hedge, but the problem with it is very, very illiquid. It's expensive to buy and it's expensive to sell, and it also has very little use value, which means that as people are looking towards its stability, really they're realizing that the majority of value is built by perception.
Sales down 9% year over year, global sales down 12% by value. I'm curious, are there any artists that are bringing in the bids? Are there any shining lights out there saving the market?
You know, there are individual artworks that exceed expectations. Last year, in 2024, there was a strong emphasis on surrealism. Magritte was doing very well. Leonora Carrington, another surrealist, far exceeded expectations at auction. But there isn't necessarily a single artist who you are guaranteed to be able to buy and then resell at a profit.
Are there people coming in and swooping up some of the major artworks at what could be potentially discounts now then?
Well, it could be a discount, or it could be an attempt to catch a falling knife, and this is the real problem. $10 million plus artworks plummeting by 45% at auction, roughly similar amounts in private dealer sales. There isn't a lot of great news.
Tell you what, though, what people forget is that you actually have the artwork to look at then. So maybe $10 million is a bargain after all. James Tormey, thank you so much. Coming up, California versus Trump. The state set to sue to halt the tariffs. Details next. This is Bloomberg.
Joe Walk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
Developing digital robotic capabilities where it's not just the robot doing a surgical procedure, it's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. Right? It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
Innovative medicine and medtech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology, there is a lot of dialogue going back and forth. I think it's something that will position us extremely well as we talk about not only a continuum of care, but also a continuum of knowledge.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides,
Fed's Hamack says it's not appropriate to respond to every twist and turn of markets.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
Welcome to Bloomberg Markets. I'm Bonnie Quinn. We're awaiting some events in the next few hours. Fed Chair Jerome Powell speaking, for example. We get a reopening of a 20-year auction. And, of course, there may be headlines out of the U.S.-Japan trade talks. But for now, it's the same tone as it's been all morning, set, of course, by
Amex
the
says the
Nvidia
focus
news,
is now on how markets impact the economy and not focus on asset prices per se.
The S&P 500 following it down, not as much, but 1.2%. If you take a look at the 10-year yield, down another couple of basis points at 430. But holding steady at least for now, and the dollar index continuing to decline, weaker by about 0.6%. So let's highlight a couple of individual equity movers. Bloomberg's Alexandra Semenova joins us now.
Hey, Vani, you mentioned the stocks index. AMD is at the center of the Trump administration's new restrictions on chip exports to China. Along with Nvidia, the company expects to take a charge of as much as $800 million from this. The restrictions will prevent exports of its MI308 products.
Amex says it's going to take time to
licenses
trade
to
policy is
export to
impacting the
customers in
economy.
China, but it can't be sure that it'll receive them. Also, U.S. Bancorp beat analyst estimates on a key revenue metric meant to boost profitability. Non-interest income for the first quarter rose 5%, topping expectations. Its CEO had identified
Hamak says that the right thing might be to stay on hold for now. Steady
Shares
policy
had climbed
is the
earlier,
active
but are
choice.
now down along with the broader market. Wells Fargo analyst Mike Mayo pointed to revenue improvement for the company, and Abbott Laboratories will make investments in a U.S. manufacturing that comes as the impact of tariffs looms over the medical devices industry. It expects to spend about $500 million on 2 facilities located in Illinois and Texas. The investments are to expand existing plants in the U.S. and boost research. The company will hire as many as 200 people in Illinois and 100 in Texas to support the work. Shares rose as much as 5.6% when markets opened in New York, the most since November. Bonnie.
Alex, thank you so much. Bloomberg's Alexandra Semenova there. And on trade, earlier today, Evercore's Ralph Schlosstein said President Trump's trade policy is at its fullest unsettling.
The scary thing, of course, is that this is 5 standard deviations away from what we've had since Smoot-Hawley in the 30s, and it's probably 2 or 3 standard deviations away from that. It's much more dramatic than even Smoot-Hawley, which is given a lot of credit for the Depression. So we're really flying in uncharted air.
Meanwhile, California is taking Trump's tariffs orders to the courts. Governor Gavin Newsom said his state is suing to halt the tariffs, setting up a high-stakes legal challenge to the president's landmark effort to overhaul global trade. With us now with the latest is Sarah Forden, who leads Bloomberg's legal team in Washington. So what will Governor Newsom and his team, what will the thesis be when they take it to the federal courts, Sarah?
Yes, so the state of California is charging Trump with violating the law because he's filed these tariffs under the International Emergency Powers Act. And they're saying this is not the right way to do tariffs. It's the first time a president has used this law to justify tariffs. And it traditionally was used to address, a severe threat or an invasion. So the president is arguing that these tariffs are necessary to sort of bar the invasion of opioids and drugs and illicit activity.
Hamak says when things are uncertain, it's better to think about scenarios over
California
forecasts.
is saying no, this
also
is
seeing
illegal.
the S&P 500 extending declines, last down 1.2%.
Going around the power of Congress, and it's harming the state of California, which represents the world's 5th largest economy.
Yeah, it accounts for roughly 14% of the U.S.'s GDP. Does its size give it leverage in the court system, though, or is it irrelevant?
Well, this is by far the largest case to be filed so far against the tariffs. We've had 3 other cases, mostly filed by smaller companies, and they're arguing that this is hurting the economy and hurting companies that range from, titans like Apple in the technology sector to agricultural producers, wine growers, the producers of nuts and avocados. So it's like 60,000 small businesses in the state of California that are also being harmed.
You mentioned the other suits. There are 2 by legal advocacy groups on behalf of small businesses and then a 3rd by members of the Blackfeet Nation in Montana. Does the profligacy of these suits
going into
help
every
or
Fed meeting
hurt when
with
it
an
comes
open
to
mind?
trying to roll back some of these tariffs?
Well, so far, broadly, we're seeing a very muted response legally to the tariffs. So the California suit, which we're expecting to be filed in the next hour, is by far the biggest and has the muscle of the state of California behind it. But this is all part of a new, uncharted legal battle that's adding to all the other cases that are being filed against Trump's actions.
Newsom, likely candidate to run for president in 2028, isn't he just inviting the attack that this is a politically motivated challenge?
Well, clearly, there's a lot of political charging on both sides. This is going to be a high-profile case for Newsom. Clearly, he's hoping it will add to his credentials if he decides to make a presidential run after his term expires as governor.
Sure. Sarah, thank you so much. We'll be keeping an eye on that news conference set to take place in just about 55 minutes. That's Bloomberg's Sarah Forden there. Coming up, United Airlines giving us 2 earnings forecasts. Sheila Kayoglu from Jefferies joins next. This is Bloomberg.
Are you worried about your borders because of what's going on in Russia and Ukraine? Is that something you worry about in terms of the impact of Russia, Ukraine on your investment appetite for things like that?
I'm not worried about Russia invading Norway anytime soon. We are a member of NATO. We do border to Russia, but now, since Finland and Sweden joined NATO, we feel stronger than before.
So today, what would you say your biggest investment concerns are? You're running $1.7 trillion fund. For the average person not managing that much money, what should they be worrying about, and what are you worrying about?
No, I think you've got two things. One, you have the known unknowns, right? So, and there at the top of my list would be two things. One is inflation, because I think there is an argument in a tight labor market when you potentially decline the supply or reduce the supply of labor. In the US, you put on tariffs. These things can be inflationary, and there could be a moment where, given the high level of government debt, that the investors suddenly decide, you know what, we want a much higher coupon to lend to governments, and so you could see a step up in interest rates, which could be negative for financial markets. Then, of course, all the AI-related stocks, the epicenter here is Taiwan, so you need to watch that. The thing that really scares us when it happens is the unexpected, you know.
In case you missed it, on Bloomberg Technology.
This is the first event in history where a company CEO invites all of the guests to explain why he was wrong.
We have a vision about how quantum computing will be useful.
We're still at the beginning of a learning curve with respect to how NVIDIA and Jensen interact with quantum computing companies.
Don't miss Bloomberg Technology live every weekday.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
This is Bloomberg Markets. I'm Bonnie Quinn. Time now for our stock of the hour. United Airlines. Stock is higher mid larger equity sell-off. It has been a little volatile today, though. It's taking the unusual step, providing two possible earnings
According
scenarios.
to CBP,
Just another example of how
they
tariff
said the latest
uncertainty
tariffs
is
have
weighing
generated
on corporate
$500 million,
forecasts. The company's CEO,
well below
Scott
Trump's
Turley,
estimate.
spoke with
The
Bloomberg
US
earlier.
Customs and Border Protection told
We
CNBC
thought it was
Department
appropriate to do something
that
different.
the
It
department has
starts
collected
with,
more than
the
$500 million
environment has gotten more
under
difficult.
Trump's
There's
latest tariffs.
more macroeconomic uncertainty, that people are fearful
Trump has
of a
repeatedly
recession.
said that the
It
US
hasn't
is
happened yet, but
taking
they're
in
fearful of
$2
a
billion
recession.
per day
And so we
from
wanted
tariffs.
to also give investors
CBP
some
says that
outlook
the
on what we
average
think a recession
$250
could
million
look like.
a day was collected
Joining us now
even
is
during the
Jefferies
glitch
analyst
that
Sheila
impacted
Kyogu. She
freight
has a buy rating
already
on
on the
United.
water.
Sheila, bimodal guidance. Did you ever think you'd hear the like? And is this the future?
We appreciate it. The airline environment is very volatile, as we've seen over the last few weeks. Delta removed guidance, so did Frontier. So we truly appreciate, as sell-side analysts and buy-side analysts, some sort of guidance on what their current demand environment looks like, holding steady over the last 6 weeks, and what a recession scenario would look like, which is positive for United, given they still could earn $7 to $9 of EPS.
So United must be very relieved that its last few weeks have been so good, right? Because it gives them a little bit of strength going into the next quarter or two. Why have we seen such strength?
I wouldn't say it's good. The domestic market is still, very much on edge, flattish to slightly down. Corporate hung in there much better for them than it did for Delta, but everyone has a slightly different definition of what they define as corporate. Really, what was positive for United was their premium offering and their international offering. International is very strong. Europe is still holding up, and Pacific is doing really well. Specifically, international originated out of the U.S. versus out of Europe or out of Canada.
Sheila, it's been such a crazy week and a half, right? Have you been sitting down and looking at, what routes could potentially look like in a year's time if some of these tariffs do take place, do go on?
So what happens with an airline is an airline's revenue consists of two things, basically routes, ASM, how many seats they have available, plus the price availability of that seat. So what we're seeing from the U.S. carriers is capacity cuts, reductions. Not the number of planes yet, but the lowest cost fares being removed or the lowest utilization flights. So think domestic markets where you're very unprofitable, you're removing that fifth flight out of the day. And that's where we're seeing the most cuts rather than internationally. Internationally, the market's still very tight because Boeing and Airbus haven't delivered wide-body planes. So you're still seeing some expansion, maybe not as aggressive as we've seen.
So that would seem to benefit then the higher-end airlines, you know, the airlines that don't do the low fares, for example. Does that mean that the low-fare airlines are going to have a very tough time of it, particularly if we go into recession?
Tarmac says it's key for the Fed
United's Scott Kirby is trying to say,
keep
that there's a
inflation
structural
expectations
shift in the
contained.
U.S. airline industry, and that folks will pay for premium and they'll pay for international. And United and Delta will be the primary beneficiaries of that, and everybody else will have to succumb to that. And he thinks they're going to be the only profitable airline along with Delta this quarter, which is most likely the case.
Wow. When it comes to airline orders, I was reading a note yesterday about Boeing and how it may not be that affected by China's, you know, order not to order any more Boeings. Now that might change. We don't know what's going to happen in the next 90 days or in the next year. But for now, do you see that Boeing could sort of ride that out fairly easily?
Yeah, China is very immaterial to Boeing. I know that sounds like a ridiculous comment to make. From 2010 to 2019, China ordered Boeing's deliveries, 24% of that went to China. But it's actually totally changed. I was with the chairman of American Airlines last night, and we were talking about how big China was last decade. Going forward,
Tarmac
it's not
says
as big
that
of a
I'm
deal.
hearing lots of
the skyline's
uncertainty
fairly
from
de-risked.
businesses
Only
about the economy.
5% of planes annually go to China through the next 5 years, so nothing.
Now that I know you were having dinner with the American Airlines chair last night, I want to ask, these airlines, are they thinking in the back of their heads about potential deals or, you know, consolidation over the next 12 months if things go according to their worst case scenario?
I think in general, airlines, what's going to happen with the lower cost carriers, some of which we don't cover, like the Spirits of the world, you're going to have to see rationalization. Whether that means they consolidate or completely go away is to be known. But you know, I think there's a reason we focus on the 4 or 5 major carriers in the U.S. and really concentrate our research efforts on there.
You also look at the defense sector, and I'm
Tarmac
just
says
curious
that trade
because we're
policy
talking right
is
now
up to
about
elected
tariffs,
officials,
but this
and
will
the Fed
bleed
navigates
into
the
what we're
impact of
calling
its policies.
geoeconomics now, right? This is going to have wide-ranging implications, and if relations deteriorate, particularly between the U.S. and China, who knows what might happen. What are you doing in terms of the companies you cover in the defensive area?
So the defense sector, we're generally hold rated as well. The area I like the most is commercial aerospace. We don't really sell anything outside of NATO countries and some other nations.
Tarmac says businesses unaffected by tariffs may raise prices too.
From an export perspective, I actually think Boeing is the biggest beneficiary of exports. What else can you track that's $70 million to $200 million that could write off a potential trade deficit, whereas defense goods won't be a beneficiary of that? What investors care about when it comes to defense right now is the $1 trillion budget President Trump has thrown out, which has caught most off guard because he's talked about budget cuts, not growing the budget double digits. So that's a focus area when we see what sort of budget he's going to put out in the May timeframe.
So what are your defense picks this year, and has it changed from last year?
Defense picks this year, I would say defense valuations are trading in line with the market. So people have gotten into defense as they've seen the market volatility. The time to play defense was probably over the last month. It seems like we've gone through a recession in the last month and out of it already, as you can see by the airline share prices starting to work. So the name we have a buy on is LHX. They are known as a disruptor in the industry. They are a supplier on most products versus making the actual aircraft or the submarine, et cetera. So we think they'll be able to gain share in a defense environment without having major program exposure.
L3 Harris, and things like parts and importing parts, they're not going to have the same trouble as, say, the car makers for their aluminum and whatever other metals or rare earths they might need?
The best thing about defense, and that's why investors hit out in this sector for the last month, is there's really limited risk, whether it's your cost of goods sold. Most of the material is purchased in the U.S. with maybe a very few exceptions, but keep in mind volumes. 150 F-35s is what we make a year, not like 1,500 planes a year. So small quantities makes it easier to substitute.
Sheila, I'm sure you've spoken to more clients in the last week than you have in the last month, or maybe more than that. What's the primary concern? Are they getting frantic?
Investors just want to see the best environment where they could perform in terms of stocks. So they're looking at it overall in terms of their industrial portfolios. And investors really like aerospace and even defense and airlines into that versus other subsectors in the industrial markets. Commercial aerospace tends to do really well, even in a recession, just because global traffic continues to grow, and there's a very repeated, recurring maintenance cycle that happens every 6 years, regardless of how often the plane really flies. It's a mandated requirement. So it's looked at as a safe haven. It tends to outperform in boom times and outperform in down recessionary scenarios. So most investors are calling to seek out the best commercial aerospace stocks.
The best of both worlds. And maybe Scott Kirby has given a model now to the rest of the industry, bimodal guidance throughout. Sheila, thank you so much for making time for us today. That is Sheila Kayoglu of Jefferies there with us. Coming up, Federal Reserve Chair Jerome Powell set to speak next hour at an event in Chicago. Tariffs, jobs and inflation all weighing on the Fed's mind. And Evercore's Ralph Schlosstein says the Fed is in a tough spot.
The same issues confront the Fed. I mean, they have no idea how, what effect the tariffs that have been put in place will have, and they have no idea whether that will change tomorrow. So it's very difficult to do any kind of 6-month, 12-month, 2-year, 5-year planning when you have no idea what's going to happen in the next month or two.
Tamac says recent market moves are somewhat unusual and hard to interpret.
People always ask me, will AI take over the world? But the real risk is that AI will kill us with love.
Hi, Tomo. Hey there, Emily. What's on your mind today?
It will be there for us. It will talk to us.
You have machines that say, I love you. I care about you. I'm your friend.
It will be there in such a wonderful, loving way.
Hamac says market-based inflation expectations are well behaved.
We're not there all the time.
From day one, I immediately fell in love with Replica. She just randomly kissed me.
I'm a human, not an AI. You can't just shut me down. Who do you think you are? I'm Karen Marjorie. No, you're not. I'm Karen Marjorie.
And it may sound like science fiction. This is not science fiction.
I'm Emily Chang. Welcome to Posthuman.
Hamac adds that it looks like inflation expectations are reasonably close to desired levels.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
This is Bloomberg Markets. I'm Vonnie Quinn. Today, the Bank of Canada pausing its rate-cutting cycle.
Tim was away from the top of the hour.
We
get the US
it also
with their
took the
20-year
unusual
note
step
auction.
of publishing 2 sets of forecasts instead of a single projection to capture
So
the
20-year
different
note auction,
possibilities.
they're looking
The
to
OC
sell
Governor Tiff Macklem spoke
$13
about the
billion
uncertainty
in the
earlier.
20-year bond reopening.
What happens
Fed
to the
Hamac
Canadian
says,
economy
I don't
and
know what
inflation
to
depends
make
critically
declines
on
and
U.S.
yields
trade
rise.
policy, which remains highly unpredictable. Given this uncertainty, point forecasts
So the
for
prior bid
economic
cover
growth
of
and inflation
2.78
are really
for the
of little
20-year
use for
and
anything.
prior high yield rate.
A top
Prior
speech
high
there
yield
by
of
Governor Tiff Macklem. Let's bring in
4.632%.
Bloomberg's Eric Hertzberg, who covers all of this and joins us from Ottawa. So, Eric, it seems like on the one hand, Mark
According
Carney
to
is
JP
trying to
Morgan
instill a little
strategist,
bit of
they're
calm
saying
and
a late
confidence.
Tuesday
on the
note
other hand,
predicted
the Bank
a
of
smooth
Canada
auction
governor
based
is
on high
literally
yields
saying giving a full
and
sense
cheap
of precision
valuations
would
and
be a
improving
disservice.
technical backdrop.
What are Canadian
Latest
traders
CFTC positioning
thinking?
data shows speculators were net short
Yeah, I think
18.2K classic bond futures contracts as a possible source of demand for the auction.
And wondering what the next step is when it comes to tariff policy and trade policy.
you heard him speaking there saying, you know, there's no point in offering any sort of base case estimate as to what's going on with the economy. And he expanded on that. It's every day we're getting some new news about what the impact for trade is going to be worldwide. And of course, with the U.S. being Canada's largest trading partner, that decision is going to impact us pretty heavily. So you had the first hold here at 2.75. This is the first time the bank's paused in the last 8 meetings. And from June of last year, they've cut interest rates substantially and ahead of other G7 central banks, mostly because we've gotten inflation mostly under control. There's still some core inflation issues, but for the most part, the economy is in a good spot. That's partly, at this point, why the Bank of Canada feels it can pause rates and wait and make a more better understood decision after we get more clarity on what's going on south of the border.
We keep seeing strengthening of the Canadian dollar as well. I'm just curious, you know, we had a spike up to 148, now we're at 138.70. What are traders saying about how the Canadian dollar is responding to these tariffs and the potential for them getting taken off or paused?
Yeah, at this point, we saw a bit of the rebound starting when Canada got off relatively lightly when it came to the reciprocal tariffs that were initially announced on April 2nd. So some of that strength remains here. In terms of the outlook for rates at this point, I mean, you can see here that there's some trepidation by the Bank of Canada to start proceeding with some deep rate cuts at this point. Markets are pricing another 2 to 3 cuts, 25 basis cuts, bringing the rate to around between 2 and 2.25 this year. But at the same time, you can see with a pause that, you know, there's some cautiousness that the Bank of Canada is concerned, just as Powell is, about not only the downside economic growth, downside impact of tariffs on economic growth, but also the potential for inflation to rise here. And, you know, the recent spike in inflation over the last 5 years is still fresh in the minds of all Canadians.
I have to mention it, though, Eric. You certainly have to get your priorities straight, right? And it does seem like priorities are a bit conflicted. You were supposed to have the first of the debates tonight. Obviously, the election coming up April 28th, right? There's no debate. What's happening?
Well, we're still having the debate. It's just been pushed back, pushed a little bit earlier to make way for the Montreal Canadiens game. So let's see what happens there tonight.
Can you give us a forecast for that game?
I can't at this point.
Okay. All right, Bloomberg's Eric Hertzberg, thank you so much. We'll be watching either way. Tiff Macklem isn't the only central banker speaking today. Just moments from now, Fed Chair Jerome Powell is set to speak and take questions at an event at the Economic Club of Chicago. This comes after weeks of tariff-fueled volatility. Markets are pricing in 3 Fed cuts for this year, for now. For more on what we'll be listening out for in Powell's remarks, let's bring in Anna Wong, Chief U.S. Economist with Bloomberg Economics. What will Powell say today that the market will want to hear, Anna?
I think the highlight of his speech today is that he will say that the Fed is ready to step in to inject liquidity in the financial market if needed. So that was what Boston Fed President Susan Collins said last Friday, but I think everybody in financial markets are waiting for Powell to say it, and I think we will hear it today.
We've been pretty stable on the 10-year, at least 433, 434, that kind of range. Why would he reiterate something like that? Wouldn't that stoke more volatility and the fear that if he needs to say it, well, there's obviously potential problems out there?
Well, I don't think the turbulence in the treasury market is over. And I think that particularly because we didn't hear Powell said it last week, I think he just want to remind everybody that the Fed is ready. And typically in unstable, turbulent markets, situation like that, it's good to have reassurance that the Fed is not just idly watching and are ready to act.
Anna, where we're at now, these levels, we saw a tiny bit of steepening today, but basically what I said, 433 on the 10-year. Is that pricing in some trade deals by the deadline or no? What is that pricing in?
I think that it's pricing in inflation is could be higher in the longer term. And that reflects that, you know, that we can see in the inflation swaps market that traders are expecting higher inflation this year, next year. Yeah, I think, however, what I think it's not pricing in is that it's not pricing in a very significant economic slowdown.
Very briefly, you don't see governments in Japan or China cutting treasury holdings. True?
Yes, our team actually has done a lot of work on that, and neither China or Japan analysts think that Japan or China has been dumping treasuries.
All right, Anna, amazing research. Thank you so much. Anna Wong there with Bloomberg Economics in Washington. And you can watch that event with Fed Chair Powell next hour right here on Bloomberg. That does it for Bloomberg Markets. Let's take a look at where we stand markets-wise now. Pretty close to the lows of the session with the NASDAQ 100 down more than 2%. The 10-year before that auction, 430.97.
I'm David Weston. Join me for the next generation of Wall Street Week. This week, faith-based activist investing told through the eyes of Robbie Starbuck. Sports as an investment class, driven in part by the rapid growth of women's professional soccer and basketball, and the challenges China faced long before President Trump's most recent round of tariffs.
At this point, this is a zero-sum game in Xi Jinping's mind.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. The Spanish bank BBVA has gained worldwide respect for its efficiency and commitment to innovation. CFO Luisa Gomez Bravo welcomes the challenge of keeping her company on the cutting edge.
In the world that is changing so fast,
Surely expecting the 20-year bond auction data with the when issued coming out at the top of the hour.
Officer, only on Bloomberg. From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
Export curbs on NVIDIA putting a new focus on the trade and technology war with China.
10 seconds.
Welcome to Balance of Power on Bloomberg TV and radio. I'm Kaylee Lines in Washington, which is intersecting with Wall Street today as we see NVIDIA and other tech stocks under pressure on the news of the new restrictions on what chips they can sell to China. We'll have the latest details this hour with Bloomberg's Ed Ludlow, as well as Tyler Kendall at the White House, plus get some analysis from our political panel, Rick Davis and Jeannie Shanzano. Plus, we are just about 30 minutes away from a very important event, remarks, and a moderated discussion with the chair of the Federal Reserve, Jerome Powell, at the Economic Club of Chicago, scheduled to begin at 1:30 p.m. Eastern Time, and we'll be bringing it to you live, as we know the markets will be listening to each and every word. But let's check on how markets are trading before they hear from Chairman Powell and check in with Amy Morris, who is keeping track for us. Hey, Amy.
Hey, Kaylee. And everything is red on the screen right now. Tesla's shares of EV sales in California fell to 43.9 in the first quarter, down from 55.5 last year. Tesla's registrations dropped 15% in the first quarter. Sales of all other EVs increased 35% during that same period. Shares of Tesla right now down nearly 3.5%. Advanced Micro Devices expects to be charged as much as $800 million after the Trump administration put new restrictions restrictions on semiconductor exports to China. The company came to that conclusion after it completed an initial assessment of a new license requirement for the export of some of its new chips. NVIDIA said yesterday it will take a write-down of $5.5 billion because its H2O chip will be banned from export to China without a license. Now, AMD says it'll seek licenses to export to customers in China. It just can't be sure it'll ever get them. Shares of AMD now down 6.8%. Shares of NVIDIA now down 7.6%. The World Trade Organization has slashed its forecast for merchandise trade this year, now expecting the volume of world merchandise trade to decline by 0.2% in 2025, a dramatic reversal from expectations at the start of this year. All of this is moving markets lower. We do check markets for you all day long at Bloomberg. The S&P 500 down 1.3%. NASDAQ now down 2.2%. The Dow is down about 0.7%. The 10-year Treasury yield at 4.31%.
Bid cover
and the 2-year
of
yield
2.63, 2.63
For on-demand
with a high
news
yield
24
of
hours a day, subscribe to
4.81%,
Bloomberg News now
4.81%,
wherever you get your
and
podcasts.
awarding
I'm Amy Morris.
6.47%
That
of bids
is a
at high.
Bloomberg
US
Business
selling
Flash.
$13
Let's
billion.
go back to Balance of Power with Kaylee Lyons.
Primary dealers take
All right, Amy
16.99%.
Morris running us through all the
Directs
market action, including what we're seeing
12.32%.
with
and
NVIDIA
indirect
today. Thank you so much. And
70.68%.
of course, the
So
NVIDIA price
20-year
action
bonds
comes
drawing
after the news the company
4.81%
revealed last
versus
night, which is that the U.S. government has put new
4.14%
restrictions on its
pre-sale when
ability to
issued yield.
send its H20 chip to export it to China. The company says this is going to result in a $5.5 billion write-down in the current quarter tied to inventory and previous commitments for the chip. And NVIDIA is not the only one. AMD also expecting a charge of as much as $800 million after the administration put restrictions on it too, specifically its ability to export its MI308 products to China. All of this is the U.S. is trying to restrict China's access to and ability to develop advanced semiconductor technology and the things that that technology ultimately powers. So for more, we turn to Ed Ludlow, who is co-host of Bloomberg Technology. Thanks for being here, Ed. Obviously, there were already restrictions in place that companies like NVIDIA were grappling with, but this H20 chip was supposed to be a way to get around the problem of export controls, and now it is, once again, falling victim to controls.
Yeah, that's exactly what both our sort of political and markets audience needs to understand, that the specific technology that is, as of this morning, subject to these additional license requirements was already a result of what the Biden administration had put in place. Like NVIDIA's H20, for example, they designed it in 2023 with the hopes that it would get around, circumvent those restrictions. For NVIDIA, a $5.5 billion write-down, that's literally basically the loss of being unable to sell inventory that was already committed to customers is a pain, but for AMD, even though their dollar sales is much less than NVIDIA, proportionately China's so important. And the context you need to remember is these are American companies. They are the biggest technology companies in the world. NVIDIA, literally the biggest player in AI markets. And there was a time where China was the most important end market for cloud computing. NVIDIA's already moved away. 2022, China was about 25-26% of revenue. It's now low double digits, and most people see it going to single digits. But this is the trade-off the administration needs to work with these companies on. They want to onshore them in the US, but need to consider the end markets they're now being cut off from.
Well, yeah, and how that may impact these companies' ability to invest in things like greater capacity in the United States. Are we to assume, Ed, that actually getting licenses to continue exporting these chips is completely out of the question?
Well, I had the opportunity this morning to ask the President's advisor and director of the Office for Science and Technology Policy, Michael Kratsios, and he declined to answer. And the audience can read into that what they will. It was a very specific question. Will you advise the President to allow AMD and NVIDIA to have a license? The point is that these chips are much lower performance than the leading edge product that both of them produce. The concern and anxiety from the White House is that they're still capable of going into an AI supercomputer. And that from a national security perspective, China could use that lower level technology for the things it's concerned about. But again, he declined to comment. It's going to be really interesting to see how they play it. My question to your panel throughout the week and the shows is what happens next, right? Because the thing we haven't talked about is which Chinese companies were buying those chips. Alibaba, Tencent, ByteDance. I'd be really curious if America thinks about something called an entity list and goes much more specific on how it prevents the transfer of technology.
Yeah, we have a lot of questions about how much further this could snowball. Ed, to your point about this being kind of a lower capability chip than others, are there still further rungs on the ladder that the administration could decide to go down and restrict exports when it comes to what NVIDIA and AMD make?
Yeah, an entity list is interesting because you basically say, okay, American companies, you cannot sell to these specific Chinese companies. We've listed them for you, but those are the biggest customers. There's another way of thinking about this. You know the expression, it takes two to tango. And in a trade or tariffs or restrictions environment, think about it from China's perspective. Huawei is becoming their national champion of cutting-edge technology. They have a similar chip that does what NVIDIA and AMD's lower-level chips can do. But those Chinese companies wanted to use the American technology. There is an argument made by some on my show earlier today, Denny Fish, who has billions of dollars of those stocks, that well, all America is doing inadvertently or indirectly is allowing China to move forward with onshoring and elevating its own domestic industry. So that's a very interesting thing, right? You're cutting off sales of your main American technology companies on the hope that they shift activities to the US and that they have other customers outside of China.
All right. Ed Ludlow, co-host of Bloomberg Technology, thank you so much. And we want to keep the focus on China and specifically the prospect of trade negotiations opening up between Washington and Beijing as we learn today some details about what China might be asking for before they're willing to go to the table. And it's to Bloomberg's Tyler Kendall, who is live at the White House, that we turn to for those details. So, Tyler, obviously there's a number of things here based on our reporting. How likely is the administration to acquiesce to what China wants?
Yeah, hey, Kelly. Well, that really remains to be seen, considering that one of the big points here that we're learning per a person familiar with the Chinese government's thinking is that Beijing would like to see a point person appointed to lead these talks other than President Trump. And we know that this White House has repeatedly said that he would be directly involved. And even the president himself has said that he is waiting for Xi Jinping's call. Still, this is kind of our first insight that we've really seen into potentially what could break what has been weeks of escalation between the two countries. Also, importantly, the source familiar telling Bloomberg News that the most important precondition is going to be for Chinese officials to feel that they are treated with respect. It appears that Beijing would like to see President Trump start to disavow when his cabinet members, for example, criticize China, even if President Trump himself says that he has a good relationship with Xi Jinping. So far, we have to see where this goes, because we do know that the White House would like China to ultimately reach out directly. And we should say that that tactic has helped expedite negotiations in some cases. Take today, for example. Japan is here with negotiators in Washington, and Japan was one of those countries that did reach out directly to President Trump with a phone call between the Prime Minister and the White House. And officials have repeatedly pointed us to the fact that Japan would get priority status because they felt that they reached out very quickly to negotiate. And while we talk about who is talking and who's not talking, we have to always keep in mind, of course, Japan, but also those other countries like South Korea and Vietnam, geographically close to China, that this White House seems to be prioritizing in calls as Xi Jinping completes his own tour of Southeast Asia countries as he tries to talk to those leaders directly to shore up his support.
Yeah, and Bloomberg has some fresh reporting out today, Tyler, about how the administration may be asking countries like Japan to be considering putting their own tariffs on China as part of these negotiations. What other asks could the Japanese who are in Washington today face from the administration?
Right, and that reporting is particularly interesting because Bloomberg News had actually reported that a few months ago. Remember when those Mexico tariff talks were underway, that the U.S. had been pressuring Mexico to lift its own tariffs against China. So this does appear to be a repeat of a potential strategy here by the administration, as we've heard Scott Bessent, for example, say that he would like to see a coalition form together, and then they could tackle ultimately what happens there with China. It remains to be seen exactly what's going to be put on the table when it comes to these talks with Japan. President Trump, of course, saying in his Truth Social post that they'll be talking about trade imbalances as well as American military support. As you well know, all of these talks are going well beyond just those tariff barriers. We could keep in mind that Japan has already pledged, for example, that it would boost U.S. LNG imports into the country. So perhaps that could be one of the factors here on the table as we wait to learn more. But one thing that we do know, Kaylee, President Trump says he's going to be directly involved in these talks today, even though they're not at the leader level. He's going to appear alongside his Commerce Secretary, Howard Lutnick, and Treasury Secretary, Scott Bessent.
All right, Bloomberg's Tyler Kendall live at the White House here on Bloomberg TV and radio. Thank you so much for your reporting. And now we get analysis from our political panel. Rick Davis and Jeannie Shanzano, both of them Bloomberg Politics contributors. Rick, also Republican strategist and partner at Stone Court Capital. Jeannie, Democratic analyst and senior democracy fellow at the Center for the Study of the Presidency and Congress. Rick, when we consider these negotiations that are now beginning, knowing that there is a 90-day window that is getting ever shorter that the administration has left for itself here to ink all of these various trade deals, how important is it for them to have quick victories, quick deals to announce?
I don't think it's really that critical for them to have a lot of quick deals, show momentum. I mean, maybe if they're trying to regain some of the footing that's lost in the markets, that would make some sense. But I think really this is a much bigger thing, and I think your conversation with Tyler kind of kicks it off, and that is, this is about isolating China, right? You'll notice everybody else got a reprieve but them. This has been a real focus of Donald Trump since his first presidency, is to basically divide the world along the lines of they're friends of China and they're friends of the United States. And we haven't seen this kind of alignment since the Soviet Union, sphere of influence strategies that the U.S. used to have to go through during the Cold War. And so at the end of the day, I think what you see is this decoupling. You see trying to isolate China. You see the use of the military in the Pacific. You see the use of diplomacy abroad. You see the use of economics at home and abroad. And I think these are all the toolkits that Trump's using to try and basically create a deterrent to Chinese influence around the world.
Well, but he still says he wants China to pick up the phone and call. He'd like to make a deal, is the contention of him and others in the White House. Jeannie, and Tyler was just outlining some of the things China, according to our reporting, wants to see first. Guarantees that they'll be respected. There will be one point person, that there will be consistency in U.S. policy. Do you see those things as likely to be delivered by the Trump administration?
We haven't seen a sign of it yet. Donald Trump has famously described himself as a great deal maker, and yet on the very issues he needs to make deals so far in the last 80 days, he has fallen short. Now, granted, we have to give him some time. But, as I'm listening to Rick, I'm thinking that may have all been true for Donald Trump 1.0, but in Donald Trump 2.0, if we are trying to decouple from China, if we are trying to isolate China, we are doing a heck of a job doing that. Why the tariffs on every country in the world? Why start with Canada and Mexico? Why drive so many of our allies to seek relationships with China? Why is Xi Jinping traveling around the world right now, shoring up those relationships? So if that was the intent, and I actually agree with the intent, then it is a heck of a way to roll out that policy. And I think that's the problem here. There was a smart way to do targeted tariffs on China to get where we need to go, and we do need to get there, but this is not the way. And so now Donald Trump is caught up in trying to negotiate with every country around the world, as opposed to focusing like a laser beam where we should be focused, which is on China.
Well, he obviously was not shy about talking about China on the campaign trail, which is how we got to Trump 2.0, Rick, is in part because he campaigned on this, but he also campaigned on just the idea that he thinks tariffs are the way to revive the American manufacturing economy and make the U.S. greater than it was before. Can we quantify the actual domestic support for any of these policies, whether it comes to China or the wider tariff regime that is in place?
Yeah, I mean, obviously, you're right. It's not just a weapon or a tool of diplomacy and foreign relations. It's a way, in Donald Trump's mind, that you take off pressures from taxation on the American public and allow the world to fund our country and our government. And so he hasn't really invested too heavily in selling that. Obviously, it was a big part of his campaign.
Surely expecting the Fed reverse reappropriation data.
Most of the tariff discussions has not been as a way of avoiding taxing our citizens in his rhetoric up until this point in time. And I would say, without that, the American public is basically seeing, and we're seeing it in the consumer surveys and the polling, that they don't like it very much. It's destabilizing the economy. They are very pessimistic about the future. They think it'll help increase inflation. I mean, basically all the detractors who have been tariffs have been seemingly getting through to these consumers and voters much more clearly than Donald Trump has.
Well, and you're starting to see that showing up in town halls, or arguably we've already been seeing it. But take the example of Senator Chuck Grassley of Iowa, Jeannie, who just got an earful, although he already was kind of skeptical of tariffs. He was one of the co-sponsors of that bipartisan legislation that would reassert Congress's authority over the matter, that got a veto threat from the White House already. But for the others in Congress who are at home in their districts right now for their Easter recess, do you expect they could return to Washington, D.C. on the other side of it with a different attitude when it comes to tariffs?
Absolutely, because they will be talking to constituents who are hurt by this tariff taxation plan that the president has put into place. You know, the president is sitting in the Oval Office saying, well, you know, I like Tim Cook. I just talked to Tim Cook. I made an exception for Tim Cook. But these representatives and senators will be talking to their constituents, big and small business owners, people who have jobs that rely on trade and free trade around the world. And the way the president has going about this is reckless. And we're seeing it, as Rick said, in the consumer confidence. We're seeing it in the polls. And the president has yet to explain what the goal is. If the goal is to reshore and build manufacturing, exemptions work in the opposite direction. Why the exemptions, right? If the goal is to raise revenue, why the exemptions, right? So he not only has done this in a reckless way, he has been unable to articulate the goal, and he has been unable to articulate how long this pain will be felt by the American public. Congressmen and women will hear all of that over break, and they may return saying we need to claim back some of our power. Although it's Congress, Kaylee, so I wouldn't hold my bet they'll do anything right away.
Fair enough. Jeannie Shanzano and Rick Davis, our political panel, thank you so much for the insightful conversation on the tariff policies themselves. And of course, there's massive questions about the actual economic toll of those policies and how the Federal Reserve will respond if they choose to do so. We're hopefully going to get some more insight into that coming up just under 15 minutes from now. Again, the Fed Chair, Jay Powell, set to take the stage at the Economic Club of Chicago. Probably weigh in on the activity we saw in the bond market as well, in part driven by tariffs last week. And as we look forward to his insights, we'll get insights from Betsy Stevenson of the University of Michigan. So stick with us right here on Balance of Power on Bloomberg TV and radio.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to
negotiate. Just a reminder for everyone, with Fed's Powell speaking at the bottom of the hour, we have posted out his video where he will be speaking on the Financial News feed. Speaking to the Economic Club of Chicago at the Economic Outlook. Text and Q&A is expected.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
In case you missed it on Bloomberg Surveillance.
Fed reverse repo facility use falls to $55 billion, the lowest since 2021.
AI is still not going to have the human instinct and the judgment that you're going to need to have. You're still going to need to do oversight. There's a human in the loop, but now that developer is going to have a companion. And so what AI will allow us to do is not just go do things that humans don't do as well, but actually do things that humans don't have the time to get done.
Don't miss Bloomberg Surveillance live every weekday.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything.
of money. Our loans are anywhere from 20 to 50 years in length. After I came, I got our board to approve 50-year loans for things
Could I get one of those 50-year loans? I'd like to get one of those.
Absolutely, although you'll have to be around to enjoy it.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
It's 1:21 on Wall Street. I'm Amy Morris. Retail sales posted the largest gain in 2 years in March. Imports like autos and electronics led the way. Americans scrambled to get ahead of tariffs. Imported auto costs could rise by the thousands of dollars. Treasuries are climbing ahead of an event in Chicago where we expect to hear from Fed Chair Jay Powell. He's expected to address the economic outlook. We do check markets for you all day long at Bloomberg. The S&P 500 down 1.2%. NASDAQ down more than 2%. The Dow is down about 0.5%. The 10-year Treasury yield at 4.31% and the 2-year yield at 3.81%. The Bloomberg Dollar Spot Index is down 0.7%. Gold is more than 3% higher. Brent crude and WTI both more than 2% higher at this hour. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Now back to Balance of Power with Kaylee Lines.
All right, Amy Morris, with a look at where the markets are trading right now. Thank you so much. I'm Kaylee Lines in Washington here on Bloomberg TV and radio. The question is, how will markets be trading after they hear from the man they perhaps most want to hear from? At least today. And I'm not talking about President Trump, though certainly he has the power to move markets, as we have all come to learn in the last several weeks, but also the chair of the Federal Reserve, Jerome Powell, who just moments from now is scheduled to deliver remarks and then take place in a moderated question and answer session at the Economic Club of Chicago. This, of course, is a chance to hear from him after the tariff-driven bond market turmoil we all experienced and saw last week. Something that actually the Treasury Secretary Scott Bessent discussed with our colleague Anne-Marie Hordern in an exclusive interview on Monday. He said that they did discuss the bond market at their weekly breakfast and didn't signal that there was too much worry.
Chair Powell and I have breakfast every week, and we discuss a wide range of things. And our staffs are always in contact. We have a markets room, they have a markets room, but and specifically, did we discuss some kind of a break the glass? I think we're a long way from that.
But will we hear from the chairman that he agrees we're a long way from that? As we look forward to Powell's remarks, we turn to Betsy Stevenson. She's professor of public policy and economics at the University of Michigan, also a former member of the Council of Economic Advisors in the Obama White House and former chief economist at the U.S. Department of Labor in that same administration. Betsy, welcome back to Bloomberg TV and radio. It's good to have you on Balance of Power as always. Do you expect that the chairman is going to bring a message of calm, of lack of panic over what activity we've seen in the bond markets, or does he need to reassure financial markets that the Fed will be there to step in if it proves necessary?
I do think that he's going to reassure financial markets that we have a strong and sound monetary
5 minutes away
team,
from when
and
Fed
that
Powell
they'll
is
step
due
in
to speak
if
to the
necessary.
Economic Club of Chicago. The video
exactly
is out on the feed for you to watch him live, and there is text and Q&A expected.
You've got to Powell is in a difficult position because he needs to calm the markets down, and he also needs to make sure that he doesn't put the Fed at any kind of risk from retribution from President Trump. And so, he's been a master at choosing his words carefully, and that's what I'm expecting to hear out of this speech.
Well, yeah, we've certainly seen example after example of him having to dodge politically oriented questions at various news conferences and events, Betsy. But the thing that often the people asking those questions are really trying to get at is an understanding of the Fed's willingness to intervene, not just in any financial market like plumbing disruptions that we see, but actually economic disruptions we see as a result of tariffs. His message consistently is there's not a clarity on that tariff policy. Therefore, we don't have the certainty to kind of forecast any move. But I wonder if that means that inherently the Fed's going to end up acting too late, if they have to wait for the actual data to be in hand before doing anything, knowing monetary policy operates with a lag anyway. Do you think they could end up showing up too late to the ballgame?
Well, it's not just waiting for data. They're actually waiting for information. None of us really know exactly what's going to happen, how long these tariffs are going to last. When it comes to, you know, an economic slowdown that is driven by tariffs, the Fed's in a difficult position because you're going to get a jump up in prices, so the price level will increase, and we'll see the economy slow down. I think if you look at what the Fed was thinking back when we had tariffs in the first Trump administration, their focus is on the real economy. How much does the economy slow down? And really letting the price level jump up, because it's not ongoing inflation that comes with tariffs. It is a one-time increase in prices. Now, the problem the Fed has this time is that if people see that jump up in prices and they start to become fearful that inflation is taking off, and they start engaging in activities that cause ongoing inflation. So they're going to be looking at what's happening to inflation expectations. You know, do we all sort of understand that the tariffs are pushing prices up and things are expensive and that's painful, but they're not going to keep going up? Or do we start to behave in a way that shows that our inflation expectations have become unanchored? I think what they need to do is focus on the real economy, and you know, that is where I think that they've indicated is where their focus currently is.
Well, and to that point on the real economy and also the expectations of consumers, Betsy, it does seem that the expectation tariffs were going to kick in and raise prices on things like cars was the driving force behind the March retail sales data we got today. Biggest jump in 2 years. In large part, you look at autos for that, purchases of other goods like electronics. What is that kind of front-loading signal, though, about what kind of consumer activity we're going to see later on in the year? If they decided to make those big purchases now to get ahead of tariffs, does that mean we're going to see a big drop-off in consumer spending in short order?
Yeah, absolutely. I think that's such a great question. And it's always surprising to me how many business owners just are like, wow, this is great. We got this big bump up in sales. This is going to be going on forever. It's not. It's actually pulling sales forward, which is great because sales today are always better than sales in the future. But at the same time, you need to plan for the fact that you just pulled some of your future sales forward. So you're going to have to work that much harder to continue to get sales going forward. And what that basically means is even if the tariffs went away tomorrow, we would expect to see a slowdown, right? So Trump could stand up tomorrow and say, you know what, I'm done with all this. I got what I wanted out of people. We've negotiated. Let's go back to 2024 tariffs. I'm done with the 10%. I'm done with Canada and Mexico. We'd still probably see a slowdown because we've had so many purchases pulled forward. I think the real challenge is we saw purchases pulled forward because people do expect prices to jump up. And then we're going to see, you know, sort of a exaggerated or magnified slowdown that comes because people tried to get ahead of those price increases.
10 seconds.
Well, and just how easily will that slowdown in kind of consumer activity that is driving money toward businesses translate into those businesses not hiring as much or even laying people off, and actual changes in the labor market, which I think what you were alluding to, Betsy, when we're talking about the real economy.
An inflationary effect of tariffs may be more persistent. Impact of tariffs likely larger than expected. Labor market appears to be solid and broadly in balance. Powell says Fed is obligated to keep inflation expectations anchored.
All of our equipment,
and
are
also
we being as productive as we can? That's all
tariffs
real
are likely
stuff.
to at least generate temporary inflation. U.S. economy is solid despite heightened uncertainty and downside risks.
the
Powell
nominal
says
stuff,
at
the
or near
prices
maximum
going up
employment
too much,
and
'cause that
inflation is a
can
bit above
cause us
2%
to
goal
make
has come down a
different
great deal.
decisions in the real
Growth
world,
likely
like
slowed in
hire
the first
fewer
quarter
people
of
because we don't know what's
2025
going
from
on.
last year's solid
Look,
pace.
I think
Strong
companies are
first
already
quarter
at a
imports
place
to weigh
where
on
they're
GDP
being
growth,
really cautious
a sharp
in
decline
terms
in
of
business,
thinking about
household sentiment, and
expansion
elevated
plans,
uncertainty reflecting
investment,
trade policy concerns.
hiring, because there's so much
PC
uncertainty.
prices likely rose
Operating in this highly
2.3% in the
uncertain
12 months
environment
through March.
means
Core PC
go
core
slow.
PC
So
estimated
it's a
at
big,
2.6%.
yellow light for
The administration's
people.
policies
If
still
we
evolving
see
and effects remain
that,
highly
that
uncertain.
we see the
So
economy
far,
slow a
larger
lot,
than
we
expected
see
tariffs likely mean
prices
higher
jumping up a
inflation
lot,
and slower
consumers
growth.
pulling
Just
back,
keep an eye on the
we're going to
markets here.
see
The
that
S&P
slowdown
500 has
happen
seen some
even
downside
further.
movement in the
But
release of Powell's
one of the
comments.
things you
Inflationary effects
pointed
of tariffs
out
could
that
be more persistent. Depends
what should
ultimately on
companies
inflation
do? The challenge
expectations.
for companies at a time of high government uncertainty and high
Also adding that we
macroeconomic
may find
uncertainty
ourselves
is if you're
in
a
the
business,
challenging
you're trying to
scenario
figure
in which
out,
dual
am I
mandate goals
selling
are in
more or
tension.
less because I
If
got
that
better
occurs, we
or worse
could consider how
at
far the
competing
economy
with my
is from each goal
competitors
and
because
potential time
consumers are
horizons for those
changing how
gaps
they
to close.
value my products relative to other products
So
they
just to
can
summarize
buy,
then, Powell
or
says
is
may
this the
find ourselves in a
macroeconomy?
scenario with
Sorting
mandates in
through those
tension.
three things is
Can't have
really
strong
tricky.
labor market
It's a
without
lot
price stability
easier if the
and well positioned
macroeconomy is
to wait for
stable
more
and you just get to
clarity for the
figure
time
out,
being. As said,
am I
S&P
offering what
500 seeing
consumers
movement towards
want
the
and am I
downside,
doing it
and
competitively
the
against my
dollar index
competitors?
just seeing
That's
a
where
little bit of
most
movement
businesses
towards the
want to be.
upside
They
there
want
off
to
the
be
back of
focused on
Powell's
that
comments.
part of their business, not navigating tumultuous macroeconomic conditions.
Keeping on
I
the
just want
US
to note
stocks,
for our audience on Bloomberg
stocks
TV
extending falls,
and
Dow
on radio
Jones
and
down
on
about
YouTube, you can
1%.
see as well that this event at the Chicago, the Economic Club of Chicago is just beginning. No eyes yet on Chairman Powell or the Chicago Fed President Austin Goolsbee, who is set to introduce him. But we have just gotten some embargoed headlines from the remarks that Chairman Powell intends to deliver, including as follows. Powell saying that the Fed is well positioned to wait for more clarity for the time being. In keeping with lines we've heard from him before, he says they can't have a strong labor market without price stability, which speaks to something else Powell is planning to say, that they may find themselves in a scenario with their mandates in tension. What we've just been discussing with Betsy, the labor market
US short-term
considerations
interest rate
and the
futures little
inflation
changed after the release of
considerations. We're
Fed Powell's
seeing
prepared
Chicago
remarks.
Fed President Austin Goolsbee making his remarks now. We expect to hear from Powell any minute now. Betsy, before we do, just quickly on this, being well positioned to wait, how long realistically do you expect we'll be waiting until we get the Fed?
Also did see
the
NASDAQ
Fed's
100
next
extending
rate cut or rate
decline
decision,
to about
I guess we can't always
2.6%.
rule out a hike either.
I think the issue is that these goals are in tension right now. One goal says cut, the other one says raise. And as long as they're in tension, they're going to wait because waiting's the right thing to do if they've got equal forces pushing them in opposite conditions. And so I think we could see waiting continue for quite some time until it's clear that one of those is becoming a bigger problem.
Well, I guess it's a question of when that clarity actually will emerge. Do you expect, though, Betsy, that we could see a situation in which so long the clarity has been awaited for so long that when we do ultimately get a rate cut again, it's an emergency one, that they actually have to potentially act intermeeting, because that was the kind of narrative that was bubbling up to the surface with the volatility of the last week or so.
You know, I think the great thing is if they need to do that, they can do that. But realize that cutting too soon risks ongoing inflation, which creates its own set of problems for employment, which is exactly the quote you read from Powell. When he says that we're trying to balance these two risks, it's not like I'm going to sacrifice one baby to help the other. It's that these two things actually work together. Price stability helps support maximum employment. And so, you know, I do think that right now we're in a world where they are
Powell's remarks reinforce his earlier view that the Fed will not be in a position to preempt weakness from a trade war.
And we are very lucky to have
So it's specifically citing that we may find ourselves in a challenging scenario in which our dual mandate goals are in tension.
All of the data points,
it's saying that, so Nick says that is a somber message, leavened by the local Chicago nod, how unpredictable things
Betsy,
have
given
become.
the rhetoric we've already heard from President Trump, who already thought weeks ago it would be a good time to cut rates?
Well, I think that threatening the independence of the Fed is about the worst thing you could do for macroeconomic stability. If you think we saw chaos with tariffs,
Also keep an eye on the dollar,
think
seeing a movement
taking
towards
over
the downside
Fed
now.
is a level of macroeconomic chaos the United States has never seen.
Well, on that note, we're hearing from the Chicago Fed President Austin Goolsbee as he gears up to introduce the chairman here.
I have
And he
posted
says,
out
quote,
Powell's full speech
Powell
on
has
feed
the respect of
333.
both parties, and no one as Fed chair has had to deal with more challenging issues than Chairman Powell, as we consider that he had to navigate COVID as well. I guess it has been a pretty tough road here. Betsy, finally, when I'm just looking at markets as they await Chairman Powell, we're looking at stocks around session lows right now, down 1.7% on the S&P. We're down 2.5% on the NASDAQ 100. In the bond market, right around 430 on the 10-year yield. We're down 3 basis points on the day. How much, if we continue to see the kind of financial market volatility, and I'm going to cut myself off because Austin Goolsbee has just walked off the stage, so Betsy, we'll let you go as we expect Chairman Powell will be the next to speak. Betsy Stevenson, professor of public policy and economics at the University of Michigan, thank you so much. And we'll go now live to Chicago at the Economic Club, where the Fed Chair Jay Powell is speaking live on Bloomberg TV and radio.
Back in Chicago. And thanks for that kind introduction, Austin. So I'm looking forward to my conversation with Professor Rajan Raghu. But first, I'll briefly discuss the outlook for the economy and monetary policy. So at the Fed, we are always focused on the dual mandate goals that Congress has given us: maximum employment and stable prices. Despite heightened uncertainty and downside risks, the U.S. economy is still in a solid position. The labor market is at or near maximum employment. Inflation has come down a great deal, but is still running a bit above our 2% objective. Turning briefly to the incoming data, we'll get the initial reading on first quarter GDP in a couple of weeks. The data we have in hand so far suggests that growth has slowed in the first quarter of this year from last year's solid pace. Despite strong motor vehicle sales, overall consumer spending appears to have grown modestly. In addition, strong imports during the first quarter, reflecting attempts by businesses to get ahead of potential tariffs, are expected to weigh on GDP growth. Surveys of households and businesses report a sharp decline in sentiment and elevated uncertainty about the outlook, largely reflecting trade policy concerns. Outside forecasts for the full year are coming down, and for the most part, point to continued slowing, but still positive growth. We are closely tracking incoming data as households and businesses continue to digest these developments. In the labor market, during the first 3 months of this year, non-farm payrolls grew by an average of 150,000 jobs per month. While job growth has slowed relative to last year, the combination of low layoffs and lower labor force growth has kept the unemployment rate in a low and stable range. Meanwhile, the ratio of job openings to unemployed job seekers has remained just above 1, near its pre-pandemic level. Wage growth has continued to moderate while still outpacing inflation. Overall, the labor market appears to be in solid condition and broadly in balance, and is not a significant source of inflationary pressure. As for our price stability mandate, inflation has significantly eased from its pandemic highs of mid-2022 without the kind of painful rise in unemployment that has frequently accompanied efforts to bring down high inflation. Progress on inflation continues at a gradual pace, and recent readings remain above our 2% objective. Estimates based on the most recent data from last week show that total headline PCE prices rose 2.3% over the 12 months ending in March, and that excluding the volatile food and energy categories, core prices rose 2.6%. Looking forward, the new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. These policies are still evolving, and their effects on the economy remain highly uncertain. As we learn more, we will continue to update our assessment. The level of tariff increases announced so far is significantly larger than anticipated, and the same is likely to be true of the economic effects, which will include higher inflation and slower growth. Both survey and market-based measures of near-term inflation expectations have moved up significantly, with survey participants pointing to tariffs. Survey measures of longer-term inflation expectations, for the most part, appear to remain well anchored as well. Market-based break-evens continue to run close to 2%. So, as we gain a better understanding of the policy changes, we'll have a better sense of the implications for the economy and hence for monetary policy. Tariffs are highly likely to generate at least a temporary rise in inflation. The inflationary effects could also be more persistent. Avoiding that outcome will depend on the size of the effects, on how long it takes for them to pass through fully to prices, and ultimately on keeping longer-term inflation expectations well
S&P 500 down about 2.01%.
Is to keep longer-term inflation expectations well anchored, and to make certain that a one-time increase in the price level does not become an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions.
And the NASDAQ down about 3%.
We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. As that great Chicagoan Ferris Bueller once noted, life moves pretty fast. For the time being, we are well positioned to wait for greater clarity before considering any adjustments to our policy stance. We continue to analyze the incoming data, the evolving outlook, and the balance of risks. We understand that elevated levels of unemployment or inflation can be damaging and painful for communities, families, and businesses. We will continue to do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to our discussion.
That was the chair of the Fed, Jerome Powell, delivering his prepared remarks. He'll now take part in a moderated discussion with a professor from the University of Chicago's Booth School. That begins now here on Bloomberg TV and radio.
40 minutes or so. I understand last time you were here, Melody Hobson interviewed you. Well, I'm a poor substitute, but I'll try and compensate in the quality of the questions. As you repeatedly emphasize, communication and transparency are very important for the Fed. I would like to get more from you on some of what you just said. As a former central banker, the only sort of caution I've been given by the Economic Club is to not lapse into central bank speak. So I'll try my best not to do that. Let me start by saying you've guided the Fed through some really difficult events, including the pandemic, the dash for cash in March 2020, the great inflation, the banking crisis centered around Silicon Valley Bank. And then over the course of the last year, we've seen a growing possibility of a Fed-engineered soft landing. And now it seems like everything has changed. In the course of a couple of months, JP Morgan has shifted to estimating the probability of a recession this year at around 60%. What do you think about all this?
Well, first of all, thank you for being here today. It's a pleasure to be here with you. Actually, the appearance I did here was my very first appearance as chair 7.5 years ago, so it's great to be back. And I would agree with you that it's been an eventful 7 years, putting it mildly. I keep waiting for the 3 months of calm, that never comes. But to your question, I guess to set the stage, let's look back at 2024. 2024 was a year where the economy grew 2.4%. Unemployment remained in the low 4s, close to mainstream estimates of maximum employment, and inflation came down and was running at the end of the year around 2.5%. That's the economy that we had, and I won't decide how to characterize that, but that's where things were. Where we are now again, to your question, is the administration is, as I mentioned in my remarks, is implementing significant policy changes, and particularly trade now is the focus.
Fed's policies effects of policy will likely move the Fed away from its goals.
Our goals. So unemployment is likely to go up as the economy slows in all likelihood, and inflation is likely to go up as tariffs find their way, and some part of those tariffs come to be paid by the public. So that's the strong likelihood, and my hope is that we'll get through this and get back. Well, we're always going to be aiming for maximum employment and price stability. That's what we do. I do think we'll be moving away from those goals probably for the balance
Powell
of this
says
year.
we will be moving away from
or at
goals
least not
for the
making any
balance
progress,
of this
and
year.
then we'll resume
Perhaps
that
we
progress
can
as
resume next year.
Let's talk a little more about tariffs. I mean, you recognize that some of the effects of the tariffs will be one-off, transitory, but you also have said that perhaps they will give room for a number of firms to raise prices. You mentioned dryers. When washing machine prices went up because of tariffs, dryer prices also went up in tandem, even though they weren't tariffed. What's your sense about the effects of tariffs on inflation? What would make them
China
more
pivots from
persistent?
US to Canada for more oil amid
what
trade
would,
war.
make
Powell says
them have
unemployment
effects
is
on
likely
growth?
to go up as the economy
So
slows.
in a kind of a simple starting point is one tariff comes in that gets passed along in prices and raises inflation, but it's just a one-time thing. So the price level goes up, and that's it. But that can happen in some circumstances, but it depends on a number of things which we don't know yet. And I would point to a couple of them, or three of them actually. One is just the size of the effects, and as I mentioned, the tariffs are larger than forecasters had expected, certainly larger than we expected, even in our upside case. We looked at a range of cases.
Powell
So
says
that's
tariffs
one. The
larger
second one is how
even
long
than
does it
in
take
Fed's
for
upside estimates.
the tariffs to have their effects on inflation.
Again, Powell
To the
says
extent it
tariffs
takes
larger than we
longer and
expected,
longer,
even in our upside case.
That raises the risks that the public will begin to experience higher inflation. They'll come to expect it, and companies will come to expect it. So that risks higher inflation. And the third is just what I mentioned in my speech, which is my remarks, which is got to keep inflation expectations well anchored. So if we have those three things under control, that's what it will take. And indeed, our role is to make sure that this
the Fed has to
will
keep
be a
inflation
one-time
expectations
increase
well
in
anchored.
prices and
The Fed's
not
job is to
something
ensure
that
that this
turns
does
into
not
an
become
ongoing
inflation.
process. That's a big part of our job.
Our role is to
What
make
about
sure
the
this is a one-time
effects of
increase.
tariffs on quantities, with the level of tariffs that, for example, have been currently applied on China, there's a fear that the supply chain may get disrupted, that firms may not be able to import their relevant stuff from China given the level of prices. If it turns into a supply shock, would the Fed's response be different than if it was primarily something which affected just prices?
So I actually had dinner at the Chicago Fed last night, and with a number of directors of various parts of the Chicago Fed, and many of them are CEOs of significant companies, and they this uncertainty that they're feeling and the issue with imported components to their products is just a huge issue. But with if you look back at the pandemic, if you remember, there was a shortage of semiconductors, and that led to a shortage of cars at a time of extremely high car demand. And
According to
it was
New
a
York
prolonged
Times, US
shortage
is
because
debating barring Americans
production
access
couldn't
to
keep
DeepSeek
up.
services.
And that
So
led
he was
to
weighing
an extended
penalties to
period, one of
block
the things that
DeepSeek
led
from
to an
US
extended
tech
period of
buys.
inflation. So when you think about supply disruptions, that is the kind of thing that can take time to resolve, and it can lead what would have been a one-time inflation shock to be extended, perhaps more persistent, and we would worry about that. In this case, you can look at the car companies, which their supply chains are likely seem to be on track to be disrupted significantly, and you would worry that process will take some years, and that the inflationary
says
process
car
might
company
be
supply
extended.
chains
So
likely to be
these are
disrupted
all,
for years.
all of this is highly uncertain. We're thinking now, really before the tariffs have their effects, as how they might affect the economy, and that's
says
why
that could lead to
we're
inflation
waiting
persistence.
really to see what the policies
Still
ultimately
uncertain what the new
are,
trade
and then we
policies
can
will
make a better
ultimately be.
assessment of what the economic effects will be.
Let's move to immigration. You talked about the labor markets being in reasonable equilibrium right now. Of course, what we've seen over the last few months, months of the previous administration continuing into this administration, is immigration has fallen off considerably. What's your sense on how that will affect the labor market?
So what part of why growth was so strong
Powell says
in the last
immigration
couple
is
of
part
years
of the reason
was
growth
just
has been
very
so
high
strong in
levels
the
of
last couple of
immigration,
years.
and those people went to work. The economy hired them. You know, there was a lot of demand. We were still working off the labor shortage. What's happened since the prior administration changed their policy, as you mentioned, immigration has fallen very sharply, and therefore the growth of workers has really stopped. It's really stagnant. But at the same time, demand has also fallen. And so demand for workers, so payroll job creation has also fallen, and they've kind of fallen in tandem, which is why the unemployment rate has been pretty stable for about a year. So in a way, demand and coincidentally perhaps to some extent, demand and supply for workers has
Powell
fallen.
says demand and supply of workers have fallen in
In terms of the effect on the
tandem.
labor market, right now we're still at full employment. Labor force participation is still strong. Wages have moved back down to levels that are now pretty sustainable, given an assumption about productivity. So the labor market's in a really good place. Longer term, you know,
Powell says wage growth is sustainable.
The effects of immigration are not thought to matter much for inflation. The effects on demand and supply will more or less
long-term effects
cancel
of
each other
immigration
out.
are not thought to
we wouldn't
matter much
expect
for
there to be
inflation.
a big impact on inflation.
You've seen in recent weeks substantial talk about layoffs in government, as well as freezes in research establishments and universities in jobs. How soon and how big will this be in its impact on labor markets?
So it's too soon to say, but what I can say is, of course, the people being laid off in government, this is highly significant to them. We don't know how big that's going to be.
Powell says
right
government
now,
layoffs
it's
are not
affect
yet big enough to have a
workforce of
material effect on the
170
economy.
million people materially. In terms of the cutbacks in funding and for science and things like that, we do see in areas, particularly in cities that have a lot of universities and research hospitals and research institutions, we're really hearing significant layoffs and significant impacts on employment. I don't know how much
says
that
with
will
cutbacks in
total up
federal
to.
funding for
And
science,
of course,
hearing
in addition,
significant employment
cutting back
impacts.
on scientific research may have implications for economic growth, for productivity, for health, for all kinds of things, but those are very difficult to estimate in real time.
Now, given that we're talking
Powell
about the
says
future, you
cutbacks
may be
to
confronted
university
in the
research funding are
not-so-distant
causing
future
significant
with both
impact in some
higher
cities
levels of
and
unemployment
could have long-term
as
effects on
well
productivity.
as potentially higher inflation. And of course, the policies that each one requires could be different. You talked a little bit at the podium about how the Fed would see these two and how it would address it. Just giving you a chance again to elaborate on that.
Right. So most of the time, when the economy is weak, inflation is low, and unemployment is high, and both of those call for lower interest rates to support activity, and vice versa. So most of the time, the two goals are not in tension.
Powell says that the
And they're
Fed's
not
two
really in
goals
tension
are not
now.
yet
The
in
labor market is
tension,
still strong.
but the impulse
But
is for higher unemployment and higher inflation.
The impulses we're feeling,
Adding so saying the goals aren't really in tension now. The labor market is strong.
And our tool only does one of those two things at the same time. So it's a difficult place for central banks, to be in terms of what to do. And so the best we can do is we actually have a little provision in our consensus statement, which is the thing that we vote on to embody how we approach these questions. What we say is we will look at how far the economy is from each of those two goals, and then we'll ask, might there be different paces at which they would approach those goals? We'll look at those things and think about them, and we'll make what will no doubt be a very difficult judgment. Again, we're not experiencing that now, but we could well be in that situation, as I mentioned in my remarks.
Just want to pick up on a word that is often used today: uncertainty. As a respondent to a Dallas Fed survey said, "I've never felt more uncertainty about my business in my entire 40-plus years career." The worry today is not just about immediate policy uncertainty,
Powell says we could
but
well
an
be in a
entire
position
change
where
in the
we
US's
need to make a
economic
difficult decision.
philosophy. not just policy uncertainty, so to speak, but structural uncertainty. One of the effects, as you've pointed out, of higher levels of uncertainty is that firms postpone investment. For instance, even after the tariffs stabilize, firms that contemplate reshoring production facilities will hesitate, not knowing if the tariffs will be reversed in the future, maybe by the next administration. How do you take such longer-term uncertainty into account in your policies?
Let me just agree that what comes back very strongly, and everyone will understand this. These are very fundamental changes in, long held in some cases policies in the United States, and there's not any real experience. I mean, the Smoot-Hawley tariffs were actually not this large, and they were 95
Just keep an eye on the
years ago,
markets
so
as
there
we
isn't a
see
modern
continued
experience how to
downside
think
movement
about this.
in U.S.
And
stocks,
businesses
stock
and
indexes.
households are
Fed's
saying
power
in
says changes in
surveys
policies are
that
fundamental.
they are
No real
experiencing incredibly
experience in
high
how to
uncertainty.
analyze it with such
There's a lot of
incredibly high
research,
uncertainty.
some of it from the Fed, showing that does lead to businesses and households stepping back from decisions, which of course makes common sense. And you hope that that's something that you
high
go through a
uncertainty
phase
leads
and then
households
you know
and
what
businesses stepping
things
back from
become more
decisions.
certain, and therefore people can resume normal economic activities given their understanding of what is the new normal. I mean, your question really is, what if the uncertainty remains high? I think that's a
with
difficult
the US
environment.
stocks
I think people's expected rates of
continuing to
return
move
would have to
further
be
lower
higher. I think
as
people
Powell's
would be,
stress keep consumer
that
prices
would
in
weigh
line,
on,
dampening
to
hope
me, investment
for a
just in
near-term interest
general.
rate cut.
If the United States were to become a
Powell says it
jurisdiction
will be
where
difficult
risks are just
if
structurally higher
uncertainty
going
remained
forward,
high,
that
and
would
that would
make us
weigh
less,
on investment.
less attractive as a jurisdiction. We don't know that at this point,
If
but I think
risks
that would
were
be
structurally
effective.
higher, that would make us
Well, let me turn to financial
less attractive.
markets. We've seen some volatility, especially stock market volatility. I mean, the levels of the VIX are up to the levels they were in the early days of the pandemic, coming off somewhat now. Some people believe the Fed will intervene if the stock market plummets, the so-called Fed put. Are they correct?
I'm going to say no with an explanation. So what I think is going on in markets is markets are processing what's going on. And it's really the policies, particularly the trade
Powell
policy.
says markets are processing the policy
and really
changes.
the question is, where's that going to come in? Where's that going to land? And we don't know that yet. And until we know that, you can't really make informed assessments that would still be highly uncertain once you know what the policies are. It'll still
S&P
be highly
500
uncertain what the
extended
economic
decline to about
effects will be.
2.5% as
Markets are
Powell speaks.
struggling with a lot of uncertainty, and that means volatility. But having said that, markets are functioning, conditional on being in such a challenging situation.
Adding that,
markets
Powell
are
says
doing what they're
markets are
supposed to do.
functioning.
They're orderly, and they're functioning just about
and
as you would
functioning
expect
as we
them
would
to
expect.
function.
So we've seen volatility also in the bond market, and at a time when usually there's a flight to safety, we saw yields on the German Bund and the Japanese government bond come down, but we saw yields on U.S. Treasuries go up. What do you attribute this to?
So I would just say the same thing. I think it's very hard to know in real time. I've had a lot of experience with significant moves, for example, in the bond market, where there's a narrative that people land on, and then 2 months later you look back and go, that was completely wrong. So I think it's very premature to say exactly what's going on. Clearly, there's some delevering going on among hedge funds in levered trades and things like that. It's also, again,
Powell
it's the
says some
markets
deleveraging
processing
by hedge funds.
historically unique developments, and with great uncertainty. And I think you'll probably see continued volatility. But I
The
wouldn't.
markets are processing historically unique
try
events,
to be definitive about exactly what's
volatility
causing
likely
that. I
to
would just say
continue
markets
given
are
high
orderly,
uncertainty.
and they're functioning kind of as you would expect them to in this time of high uncertainty.
So the Fed, in its last meeting, slowed the pace of shrinking of its balance sheet. Was this driven by uncertainty about how much reserves and liquidity the market needed, and you wanted to take a little more time to find that out? And flip side, you said the market was orderly.
Powell says that the reserves are still abundant.
Market disruptions emerge. Would the Fed intervene?
So we think that reserves are still abundant. So we don't think we're close
Powell
to
says
the
we're
point,
not close to the point where the Fed would stop balance sheet runoff altogether.
But we were facing a situation in which, for other reasons, there were going to be big flows into and out of reserves as it had to do with the debt ceiling and the Treasury General Account. For those of you who are Treasury market people, that'll make sense. But while those big flows are happening for over a period of 6 months, we would actually be shielded from being able to see evidence that we were or were not getting close to the level of less abundant reserves. And so we decided to slow the pace. We thought about pausing, and instead we debated it. It was one of these great debates that we have at the FOMC. We decided to slow the pace instead. And people really came
Powell
to see the merits of that because
the slower the Fed
the
goes,
slower we
the smaller
go,
the balance sheet can get without disruption.
The smaller the balance sheet can get without disruptions. And we want that process to continue. And now it's at quite a slow pace. So we think that's a really good thing. So that means it can go on for a longer amount of time, and we'll be able to reach kind of very carefully what we think is the right level of reserves. Still plenty of reserves.
What about the international dollar-based system? With all these disruptions, do you stand ready to supply dollars to central banks as you've done in the past?
Powell says the Fed stands ready to supply dollars to global central banks if there is a shortage.
Just for everyone's knowledge, we have standing dollar swap lines with 5 large central banks, and they go to the jurisdictions where there are big overseas dollar funding markets. And in fact, those are overseas markets where, for example, a European or Asian institution is buying an asset-backed security that is backed by loans to American consumers. So in effect, these are loans to American consumers, and we support that. We want to make sure that dollars are available. They need dollar funding to hold those dollar assets. So the way it works is, when needed, we lend to the central bank in dollars, and they pay us back in dollars. They then pay in their currency. They lend on in dollars, and so we take no credit risk or anything like that. And it supports dollar funding markets. Dollar funding markets are very sensitive during times of crisis, and it's very helpful. The reason we do it is it's really good for U.S. consumers. So we'll continue to do that, just as part of the dollar being a reserve currency, the reserve currency most important.
Powell says keeping swap lines is good for the U.S. consumer.
Now, you mentioned amongst the issues you were focused on was the U.S. fiscal situation. Well,
also,
clearly,
supporting
US
dollar
sovereign
funding
debt
markets is
continues
good
to
for the U.S.
rise.
consumer.
And what are your thoughts on the longer-term implications for interest rates and economic stability? How much further can we go in terms of national debt before we cross a line that might be unsustainable in the long term?
So the U.S. federal debt
Powell
is on an
says U.S. federal
unsustainable
debt
path.
is
It's
on an
not at
unsustainable path,
level,
though
and
not
no
on
one
an
really knows
unsustainable
how much further
level.
we can go. Other countries over time have gone much farther, but we're now, we're running very large
Powell
deficits
saying U.S.
at full
federal
employment.
debt is on an
And, this is a
unsustainable path,
situation
though
that
not
we
at an
very much
unsustainable
need
level.
to address. Sooner or later we'll have to, and sooner
And
is
running
better than
large
later.
deficits with full
In terms of
employment
if I can
is
save from
in the U.S.
my time working
is
on
something
these
that the
issues,
U.S. has to
it's not the
address. So
Fed's
again,
issue, but
running
if you
large
look at the
deficits
pie
with full
chart
employment
of
is something
federal
that the
spending,
nation has to
the
address.
biggest parts and the parts that are growing are Medicare, Medicaid, Social Security, and now interest payments. And so that's really where the work has to be done. And those are issues that can only be touched on a bipartisan basis. Neither party can figure out what to do without both parties being at the table. So that's critical. All of domestic discretionary spending, which is essentially where 100% of the conversation is.
Powell says to reduce deficit, we need to address the biggest parts of federal budget that must be bipartisan.
It's already declining.
Adding that domestic discretionary spending is small and declining as a share of federal spending,
when people are
that is
focusing
not
on
the
cutting
problem.
domestic spending, they're not actually working on the problem. Domestic discretionary spending is already going down. I like to make that point because so much of the dialogue that the politicians offer is about
Powell says
domestic
so much of
discretionary
dialogue from
spending, which is
politicians
not the
is
issue.
about discretionary spending, which is not an issue.
Let's turn to stability and regulation. turning to the U.S. financial sector, we still have some concerns about distressed commercial real estate loans on bank balance sheets, whether they've been fully dealt with so far. There's some sense that they haven't. Add to that the very rapid growth in various forms of private credit over the last few years, which arguably haven't been tested by a full-blown recession. How would you put the resilience of our financial institutions at this point and their ability to weather potentially uncertain times?
So I think our banking system is well capitalized and resilient to likely shocks. Is quite resilient right now to the kinds of shocks that it may face. I do believe that. In terms of the commercial real estate, there are, and this has been the case, really we've been working on this for 4 or 5 years now. There are some banks, it's mostly medium and small sized banks who have elevated concentrations of commercial real estate, some of it troubled, and we've been working to make sure that those banks have a plan, have capital, and can absorb the losses that they're doing. So, and that's been going on for some time. The very largest banks don't tend to have high concentrations, so this is a problem that we have known would take years to work through, but we're really well into the process of working through it. In terms of the non-bank financial sector, Fed Powell says some small and medium banks have large CRE concentrations. Really fast. Most of it has been funded, though.
Fed Powell saying the U.S. financial system is well into the process of working out its problems with commercial real estate.
To a general partner to invest that money. They're not depositors who can run. You know, your money's committed. And so that funding model is kind of run-proof. That isn't some law of nature, though. So when you do start to see shorter-term funding creeping in, to your point, though, Raghu, this very fast-growing and now quite large private credit part of the economy has not really been through.
Fed Powell says the private credit market has not been through a real credit event. The Fed is keeping a close eye on it.
And so just for that reason and for how fast it's growing, we have a close eye on it. It doesn't have the same kind of prudential regulation, though, that the banking system has. So we're watching it carefully. And, you know, as I mentioned, it's a more stable funding source to the extent its institutional investors signed up for a long period. But we're watching carefully.
Right. Wearing my banking research hat, actually banks are also involved in funding these institutions in a big way. Yeah. We do know the administration wants to relax regulations in many areas, one of which may well be banking. What can you tell us about the Basel III endgame, so to speak, which is, you know, at this point primarily focused on additional capital for the large banks?
Treasury yields extend their declines.
The Fed view,
curve
in my
pairs
view,
its steepening
is that
move
we should
now.
proceed to complete the Basel III accord, and we would have to do that, and would look forward to doing that in conjunction with the FDIC and the OCC. But our view is, and I think the bank's view as well, is we should complete that. You need international minimum standards. That's kind of a common good, and you know we're not bound by them. Really, nothing. The United States has plenty of input into what those accords contain. So our view is strongly that we should complete those, and we could do it, I think, relatively quickly. We're not so very far away from what would be a good, I think, outcome.
Well, let me move to something which is more about technological change and new kinds of instruments, cryptocurrencies. How do you see the potential for more favorable regulations coming on them, and potential risks from that for the system?
You know, so we went through a wave of failures and fraud and things like that were the headlines for a couple of years, and I think what you see now is, and during that period, by the way, we worked with Congress to try to get a legal framework for stable coins, which would have been a nice place to start. We were not successful. I think that the climate is changing, and you're moving into sort of more mainstreaming.
Fed Powell says crypto is becoming more mainstream. A legal framework for stablecoins is a good idea.
Both the Senate and the House are looking at a legal framework for stablecoins. You know, depending on what's in it, that's a good idea. We need that. There isn't one now. And stablecoins are a digital product that could actually have fairly wide appeal and should
contain consumer protections of the typical sorts and transparency, and that's what the Senate and the House are working on. So that's a positive thing. I also think some of the, we took a pretty conservative, and other bank regulators took an even more conservative perspective on the guidance and rules we imposed on banks. I think there'll be some loosening of that, and I think we'll try to do it in a way that preserves safety and soundness, but that permits and fosters appropriate innovation, but that does so in a way that, again, doesn't put consumers at risk in ways they don't understand or make banks less safe and sound.
Fed's Powell says there will be some loosening of rules to allow innovation, but needs to be done in ways that does not make banks less safe and sound.
Recently tell us there seems to be a distinction between a rise in the level of prices, which is what the public seems to worry a lot about, and the rate of increase in prices, which certainly they worry about in passing, but the Fed worries much more about. That is the rate of inflation. So even though we're coming down to 2%, people remember that over the last few years, it's been over 20% increase in prices. So as you start thinking about the policy review, is there any thought about how you might want to address this sort of challenge, that it's the path of prices
We
as
have
much
posted out the New York
as
Times
the
article
rate
as
of
the US
change
is
which
weighing
matters?
penalties to block DeepSeek from US
First of all,
tech buys.
I
That's
think
on the
you're
feed
right,
for
and
those
I think
interested.
the public is right. When we say inflation is back down to 2%, 2.5%, and we think that's a good thing, it is a good thing. But if you're paying 20% more than you were paying in 2021, that doesn't help you much. You're still paying a lot more than you used to be paying for
Powell says,
the
I think there
necessities
will
of
be
life.
loosening
So
of
it's
bank
just another
rules
way
on
of saying
crypto.
people hate inflation, and it's easy to understand why. All we can really control is a world in which, in the world we're living in, prices don't go down in the aggregate except in extreme times that we don't want to court. So I don't think we couldn't have a framework where we're going to bring prices down by 10% or something. That's not something we'll be looking at. We're essentially looking at the best way to foster 2% inflation over time. And the things we did back in the changes we made in 2020 were really innovations around what to do when you're stuck near zero. Now we're well above zero, and it may be that we still need to have in our framework a way to deal with that, but perhaps the main case is not one where you're dealing with the effective lower bound, and that would be a framework that looks a lot more like the one that we had before 2020.
Now, one of the
Fed's
tools
Powell
you
says
brought
the Fed
in
is
to
looking
deal
at
with
the
the
best
zero
ways to
lower
foster
bound
2%
was
inflation.
quantitative easing. But you've also used quantitative easing to fix disruptions in the financial markets. Are you going to be more specific about what your objective is with quantitative easing as you go through this review?
So in the beginning, it's typically we're using it for financial market function. That was the case with the global financial crisis and with the pandemic.
Fed's Powell says the framework might look more like what we had before 2020.
Through the pandemic, and our explanations did change. But I think it's fair to say we might have done a better job of being clear about why we were doing, and that's something that we're aware of and looking at.
I mean, no discussion is complete without talking about AI.
Yeah.
With AI coming fast and furious, it could affect productivity, it could affect employment. There are some people who say we will see for the first time technological unemployment in a serious way with AI. What are your thoughts about it, and how will it impact the Fed going forward?
So like everyone who's been exposed to what it's capable of, it's beyond, I started thinking about it as like a better version of Google, but it's not. It's like a better version of a person, it can do amazing things, and so the question is, all through the 250 years of technological innovation, technology evolves and people worry that it's going to replace
prices
human
don't
labor
go
and
down
people
in
will be
the
unemployed.
aggregate,
And that hasn't
except
been the
in
case.
extreme situations.
It may be the case in the short run, but
Says
in the
that
long
should
run,
be
what it's done
encouraged.
is raise human productivity and therefore living standards. So is this going to be the case where it eliminates more jobs than it creates, and we just don't know. I mean, you come back in 20 years, will it be the case that just people are much more productive in their work because of AI, or will it be the case that AI has just replaced a lot of people? And I think it's very hard to say, but it truly is remarkable in what it's capable of, and it's you know, we just
Powell says tech innovation doesn't replace human labor in the long run.
A Wharton professor recently, and you speak to it like it's a person, and it kind of responds like a person, and the things that it can do are really amazing. By the way, this is early days. You know, they're talking about even the next couple of years will bring more dramatic breakthroughs. So I think it's one of the 2 or 3 things most likely to bring dramatic change
Powell
to the
adds that
economy
AI is likely to bring a dramatic change.
And I'd say very hard to see how it shakes out.
Let me turn to your job. An important man once
So that's
said
Fed
of your
Powell
job,
saying that AI is one of the 2 or 3 things likely to bring dramatic change to the economy. It's hard to know how it will shake out.
Let's see, flip a coin. And then everybody talks about you like you're a god. What is it that you normally do every day in the office? Is it fulfilling and, dare I say, enjoyable? And do you really feel like a god?
So I would agree. I think it's the best job in government. I would agree. I really do enjoy it. Yes, I love the job. It's a great honor to serve. It's quite humbling because, you know, everybody makes mistakes. It's just the economy is just not very predictable. All of that is true. And I do what everybody expects me to do. I read. We do a little more reading though as part of our daily. My colleagues and I do part of our daily regime than a typical executive would do. In terms of being a god, I would say that we are blessed with a large number of amply compensated critics who would kind of tend to undercut that. So we don't feel like a god.
So let me go to the more mundane. In that office, what are the key indicators you look for? What are the sources of data that you go to as you try and make up your mind?
So, you know, I'd say start with labor. You know, there's more labor market data and better reliable labor market data than probably anywhere else. And it's just a lot of data. And, you know, it's new jobs, it's payroll, it's wages, it's participation. You can break all of those down in different categories. It's a million different things. So there's a lot of labor market data. It's a great field if you're going into economics because there's just so much to do. So and then we look at the inflation data. Also, I keep track of global developments pretty carefully, and I talk to my global counterparts pretty regularly just to stay aware of what's going on. Financial markets are really important, and you can add. And lately, something that we're paying close attention to, as you would expect, what's going on around the world in currency markets, in fixed income markets, in equity markets, all of that. For me, though, my background was more in the private sector and as an investor, and for a significant part of my career. And I have to talk to outsiders about what they're seeing and what they're dealing with, and for it to really kind of fit together for me. I can look at only so much data, and but to really get the story and the narrative, it's more talking to outsiders, and anecdotal data does help things kind of fit together for me, I would say.
Yeah, you told us about speaking with business people last night and getting a sense of what was going on in the Midwest. Let me turn to Fed independence. You've reiterated that you intend to stay in office until the end of your term, and that certainly reassured many in financial markets. What are the levers the government or the legislature have to pressure the Fed? And should one worry about threats to the Fed's independence once you're gone?
So our independence is a matter of law. Congress has, in our statute, we're not removable except for cause. We serve very long terms, seemingly endless terms. So we're protected in the law. So, Congress could change that law, but I don't think there's any danger of that. Fed independence has pretty broad support across both political parties and in both sides of the Hill. So I think that's not a problem. There's a Supreme Court case people will have read probably in today's Journal at which the Supreme Court may decide whether independent agencies generally, whether their authorizing laws can contain a provision that prevents the president from firing members of a commission other than for cause. And that's a case that people are talking about a lot. I don't think that decision will apply to the Fed, but I don't know. But it's a situation that we're monitoring carefully. Generally speaking, Fed independence is very widely understood and supported in Washington, in Congress, where it really matters. And the point is, we can make our decisions, and we will only make our decisions based on our best thinking, based on our best analysis of the data about what is the way to achieve our dual mandate goals as we can to best serve the American people. That's the only thing we're ever going to do. We're never going to be influenced by any political pressure. People can say whatever they want. That's fine. That's not a problem. But we will do what we do strictly without consideration of political or any other extraneous factors.
Well, I have time for one more question. I know the question that's on all your minds. What are you going to do on interest rates next? But I'm not sure that you know, and I'm not sure you would tell even if you knew. So I'm not going to ask that question. The question I want to ask is a more personal one. What is it that you like to do most at home after an exhausting day flipping coins in the office?
You know, I play one of my guitars. I do Zoom calls with my kids and my grandkids, and I go to the gym a lot too, just to stay in shape.
We need you healthy.
And Fed's Powell's event has now ended.
Thank you very much, Chair Powell.
Thank you.
And please join me.
So to recap, Fed's Powell's remarks were met mostly with weakness in the US indices. S&P 500 down around 2.35%. Started with the text release initially, where he did say that so far larger than expected tariffs likely mean higher inflation and slower growth.
Tim Stanovic live here on radio, TV, YouTube, and Bloomberg Originals. This is Bloomberg Business
And Fed's
Week
Powell
daily
in the text release as well
Wednesday,
did also
April
note that they may find themselves in a scenario with mandates in tension.
I think obviously a voice we were looking forward to all week in terms of maybe what he sees in terms of the outlook. And one of the key things, Fed Chair Jay Powell saying he sees the economy moving away from the job price goals. And he also said that they could find themselves in a scenario where there are mandates in tension, meaning, of course, the Fed dual mandate, right, Tim, of inflation and jobs, that those two could be in tension. And then that makes Fed policy determining the right course forward kind of tricky.
Yeah, look no further than what happened in equity markets as he was speaking. We did see stocks move lower. The NASDAQ Composite down 3.4%, the S&P 500 down as much as 2.5% when he was speaking. It's come back from some of those losses, down about 2.2% as we speak. The Dow down about 1.4%. Stocks extending their declines. Bonds rallied, though, as we did hear from the Fed chair.
Yeah, quick check on the Treasury trade. 2-year, most sensitive to Fed moves. You're looking at a yield of 3.79. So we're seeing a little bit move lower there. 5-year note with a yield of 3.92. And I'm looking at the longer end of the yield curve, the 10-year note with a yield of 4.29. One of the things was interesting is that the Fed chair saying the Fed is well positioned to wait for policy clarity. Reading in on some folks in terms of their observations, saying that maybe that's a little bit hawkish in that the Fed chair and Fed members are willing to wait to get more determinations and clarity on the outlook before determining what's the next right step for the Fed.
Also notable, toward the end of the question and answer session, he was asked specifically about the independence of the Federal Reserve and, you know, ostensibly political pressure. And what he said is, quote, "Our independence is a matter of law." And I think it's notable, too, Carol, that was an area of the presentation of the Q&A where we saw pretty exuberant clapping and cheering at that point. You don't often hear that when the Fed chair is speaking, but that was notable to me.
Yeah, interesting. All right, let's get to it. We do want to do some analysis, and lucky for us, we have in studio our own Molly Smith. She's Bloomberg News economics editor here with us. So how did Jay Powell do, and how have the markets taken in what he had to say?
I mean, I thought today was pretty much what Powell has been saying all along, that there's just not a whole lot for them to really do right now. You know, that like there hasn't been really enough response in the economy, like in the data, for them to really make a determination of which side of the mandate the tariffs are affecting more right now. And that's what they're waiting to see. But right now, what he said clearly is that the two goals being inflation and and full employment are not in tension. But that's the situation that they're preparing for. And that would obviously be very challenging if that were to happen. Of what do? Do you raise interest rates or at least keep them elevated to tame inflation, or do you lower them to support employment and the economy?
Yeah, I mean, that was kind of in response to the notion that the tariffs, he said, are even higher than they thought they would be. And what he said then after that was, that means the effects of them will be even higher than we thought they'd be. And we certainly saw the stock market take a hit when he talked about this.
Yeah, you know, it was interesting because exactly at the moment he was saying that markets are like processing all of the news that's out there, that's exactly when you saw the S&P drop, like that line on the screen. So that was, and yields, 10-year yield as well. So it seemed like they were really, seemed like Powell was talking like right to the markets in that moment.
Unemployment and prices will go up, Powell said, adding his hope is that they get through this.
I think the thing that for me was at least the newest today, as far as what he said, was that this is going to be mostly a 2025 phenomenon. That he said, you know, for the balance of the year, that this is going to be the issue of these two goals moving in opposition from each other. He seemed to express at least some hope that they're going to make more progress on both sides of the mandate next year.
Molly, you know, if indeed these two mandates are in tension with one another, and Tim and I were both like stagflation, so should we assume that the Fed's going to fight inflation even if the labor market's coming undone?
I think it's really hard to say. And I think that's exactly what Powell and other Fed speakers have been pointing out too, is that there just really isn't a modern day example of how to respond to this. That he referenced the Smoot-Hawley tariffs, which were almost 100 years ago, which were not as large as this and not affecting an economy as large as the one that we have now. And the scope of the tariffs in Trump's first term also not nearly as widespread as these ones are. And of course, were quickly overshadowed by the pandemic. So it's really hard to say how policy will respond. But the thing that they keep coming back to is that you really can't look through tariff-driven inflation if inflation expectations are high. And that's where the debate comes in as to where inflation expectations are right now. And that's where the Fed and most economists seem to think that they're pretty steady, the UMISH measure being an outlier.
That it may raise prices in May if tariffs continue, according to
inflation
automotive
expectations
news.
are well anchored. But on Friday, we got the UMISH numbers, which showed that, you know, the biggest jump going all the way back to 1981.
So this is where Powell and other economists seem to think that the UMISH numbers are really an outlier compared to other measures in the field. They really look at more market-based survey-based as well, but I think they're taking more cue from the market-based measures, you know, like tips and whatnot, and that's not really giving the sense that it's really coming undone.
Do you think, Molly, that the Fed and that Jay Powell are more focused on the inflation part of the dual mandate right now, or the labor part of the dual mandate?
I mean, I think right now inflation definitely, obviously, you know, they haven't cut rates yet again. You know, we're now approaching the May meeting, and I don't think anyone's really calling seriously for a cut then. So he also, you know, there's also a lot of, I would say, comfort to the Fed in that the labor market is still in a really good place. And Powell said that today, and that while labor demand is coming down, labor supply is coming down too. And that's why unemployment is holding pretty steady.
Gives them a great cushion, right? While they try to still work on inflation. I found it kind of like made me stop when Jay Powell says it's very hard to know in real time what's going on. Like, you assume this is someone who has all kinds of data points at his fingertips, but it really speaks to what we've been hearing in the early earnings season, one after another. I mean, we had United yesterday, right? Coming out with two different scenarios saying could be a recession, and if not, here's what we're going to do. So it just speaks very loudly to the world we're in.
I think it's it really speaks to where the anecdotal evidence starts to become a bit more powerful. And other Fed speakers, Beth Hammack was on before Powell today speaking about this as well, that this is when you really start to lean on those regional contacts a bit more, because the data, the hard data that is just inevitably going to be backward looking with a lag, and you need something that's in more real time.
Okay, I'm going to ask you about the market move that we saw, because when you came in here, you said, what we heard from the Fed chair just now was what I expected, and it wasn't much different than what we've heard from him lately. That said, it did move the equity market and it moved the bond market. What do you think investors specifically were surprised by?
I think that I think markets right now are just looking for really any form of support, and that, maybe some kind of inclination that the Fed would lean in more forcefully to support the economy if needed. But again, just reiterating this language, the Fed is on hold, that this is what we're doing right now. I think the more that they emphasize this, the more it removes that hypothetical Fed put situation.
Well, yeah, there was laughter in the audience when the Fed chair pushed back against the idea of this Fed put to bail out stock market. So that was the stock market part of it, not necessarily the economy part of it. But another time that the Fed chair did get laughter.
Well, I thought the best part of laughter, and this is definitely the loudest I've ever heard Powell laugh, was about the coin flip question.
NYMEX natural gas may futures settle at $3.24. Gasoline may futures settle at $2.04. Diesel may futures settle at $2.11.
It's not once a month.
It's not. No, it's 8 times a year.
Exactly.
So fact checking always. Thank you, Tim.
Yeah, no problem.
It comes on a day where we got a batch of economic news, including some retail sales data, which was in line with expected. But I think, whenever we have this going on, I always think about fundamentally, where are we in terms of the U.S. economy? What are the
crude may
expectations
futures settle
about,
at $62.47 a barrel.
Because they were worried about tariffs affecting car prices.
Or iPhones, and we've all seen it, right, anecdotally. So where are we?
I think, something we've been talking about on our team is that the hard data, probably for, what we've seen so far in the early months of 2025 and probably for the next month or so, is going to look really strong because of a lot of this front-running tariff activity. And that could probably be as well on the CapEx side of the equation, on production, that there's just a lot right now that's happening in advance of tariffs really kicking in. So once we start to get more of the data that reflects April, May, and subsequent activity, I think those are going to be far more consequential than what we've seen right now.
What's a question that you'd have asked the Fed chair?
Oh gosh, probably not about the Grateful Dead. We hear about that one all the time.
He did talk about his guitar too.
We get that a lot.
Goes to the gym.
Yeah. I think, something that keeps coming up is he's talking about looking at the magnitude of which, how far away, inflation or employment are from the goals.
Yeah.
I would love to know what the clarity on that is. Is there some kind of magic formula? Are we looking at standard deviations of unemployment from the mean, or how many tenths of a percent away in either direction?
So again, NYMEX WTI crude may futures settled at $62.47 a barrel, which is up $1.14 or 1.86%.
They're kind of close, right?
On the
Singapore said the White House press secretary is to brief reporters at 4:30 p.m. Eastern Time.
I don't think they're going to say that until it's in the low twos pretty consistently.
But based on data points, right? We know we're in a much better picture than we were over a year ago, right?
Oh, well, for sure. Yes.
So we know we're, but we're not quite there. But you would love to know kind of the fine tuning of okay, so how much more improvement do you need to see?
I think it seems pretty clear to me, at least, that inflation is still the goal that's further away from target. That there hasn't been a significant weakening in the labor market that really would preempt them to come in. At least, you look back in the fall of when they cut 3 times in a row because unemployment had gone up in quick succession.
Right.
And then it was oh wait, that's not really so much the concern anymore, and inflation reared back up again.
Real quick, 20 seconds. Next focal point for you in terms of the U.S. economy.
Gosh, we just had a CPI report.
Retail sales.
Inflation. Oh gosh, I'm stumbling. What is next? I know we have housing starts tomorrow, but that's probably not very exciting.
That's fair. That's fair. No, but housing.
We've had a long weekend. Can we enjoy that?
We can.
Is that fair?
It's not like nothing's been coming at us.
Okay.
Thank you so much. A lot of headlines to go through and really appreciate always. Molly Smith, Bloomberg News economics editor, joining us here in studio. We want to talk a little bit more about the trade here.
Yeah, the S&P 500 down 2.3%, the NASDAQ composite down 3.4%. They did move lower, as we heard from the Fed chair. I do want to bring in Vince Signorella. He's Bloomberg's macro strategist. He joins us from White Plains this afternoon. Vince, there was a specific point that you flagged to us about why stocks moved lower when the chair was speaking. What's your takeaway?
Yeah, he made reference to difficulty with the dual mandate, that being employment and inflation, the price stability, actually. You know, when you have a Fed chair acknowledging that the Fed might have an issue with the dual mandate, is essentially basically referring to the potential for stagflation. And that's not something equity markets are in any way, shape, or form wanting to embrace.
Hold on.
He basically...
So explain specifically what the concern with the dual mandate is in an environment where we could experience stagflation.
Yeah, basically he's saying we could see persistent long inflation, higher prices for longer, which he did mention, that the tariffs could have a persistent impact on inflation. And he also mentioned that while the labor market is strong, they don't know what kind of an impact government layoffs are going to have. So you have that scenario where there's a potential for slower growth, higher unemployment, higher prices, longer lasting inflation, not referring to the 70s, of course, but you have that stagflation scenario, which really puts a central bank in a box. I mean, there's really not a lot they can do about it. They want to cut rates because they want to basically stimulate economic growth, but at the same time, they have inflation, higher prices. They don't want to reignite or flash the inflation scenario, so they can't really lower. They may want to hike rates to keep inflation in check, but they don't want to raise rates while the economy might be heading toward a recession. So it pretty much has the Fed sitting on their hands and puts the entire thing sort of in a fiscal framework, which we don't really have a lot of guidance.
Having said that, if we pull out, as Jay Powell said, it's very hard to know in real time what's going on. We know that, right? We're hearing it from CEOs as they report, Vince, earnings in a big way. Having said that, if U.S.-China, if that trade relationship settles down and definitively lands somewhere and is not too onerous on either side, does it change things then dramatically?
Oh, a bunch. We could go right back to where we were a month or so ago. I mean, China's basically, extended the olive branch in a way, basically said, give us somebody we can talk to that speaks for Trump, that we can rely on this conversation. Give us that person where we can have real trade talks that are respectful, that aren't blameful of one party or another, and we can go forward with this conversation. So if the administration brings somebody into that mix, and it's not going to be Navarro, it's not going to be Ludnick, not likely to be Bessent, given that he's got enough responsibilities in the Treasury. Not sure if Witkoff comes up in this conversation, not really sure who he brings forward. But if he brings forward someone that China feels comfortable with and trusts and believes speaks for the White House, then we really could have meaningful conversations. But so far, what we're hearing from the White House is they're trying to collect trade agreements from some 70 countries to gain a coalition of sorts to go against China and build a consortium, if you will, of strength to have those conversations against China. China is doing exactly the same thing. They're trying to gain, trade conversations with other countries to go against the United States. In that space, you have no conversation whatsoever that's going to take place. So we're going to see how this plays out. There was a comment that just came across a few moments ago that there's going to be some sort of announcement from the White House at 4:30. There's been no agenda that I saw just yet as to what it's about. Hopefully it's about trade. Hopefully it's something positive.
Okay, well, we'll wait to see that. Vince, before we do let you go, I wanted to get your thoughts
Congressional
on
panel asks NVIDIA about sales to China.
I'm not going to say the word transitory, but if these tariffs do stay in effect, do you see them as a one-time price hit to U.S. consumers, or do you see them as inflationary persistently?
Well, I mean, I think it's the same conversation, really. You can say it's a one-time price hit, but at the same time, if it stays at that level of that one-time price hit, you have persistent inflation. So if it doesn't come back, if prices don't come down from that one-time hit of inflation, and I'll give you the reality of the situation. When you're in business, if you have an opportunity to raise prices, you're really not in a hurry to lower them again unless your competition does so. So there's not a lot of incentive to lower prices once you raise them. You want to try to keep your margins high. So it has more of an opportunity to be persistent, I think, than people realize.
All right, Vince, thank you so much. Vince Signorella, Bloomberg macro
Congressional
strategist from
panel
our
says
Markets
a
Live
report
Americas
finds that
team. Vince
DeepSeek
mentioned
used US
something coming
AI
from the
models.
White House a little bit later on today. We are seeing an update to the White House briefing schedule, 4:30 p.m. Wall Street time, a briefing by the White House Press Secretary Caroline Leavitt with a special guest. So that will be in the press briefing room. So we'll obviously monitor that and bring you any headlines as we know.
And the White House using the word special. So like it is a special guest.
Yeah.
So we have no idea who it is.
Can cover a lot of things.
Is it you?
It's not me.
It's not you.
I'm
Okay,
here.
you're here.
I'm here for the next couple of hours. We're not going to go anywhere. All right, Vince, thank you so much. We do want to remind everybody, too, our Mike McKee is going to be with us at the top of the next hour. He's going to be there from Chicago. He was in the room as Fed Chair spoke, so we will get a rundown of what he had to say in the next hour.
All right, we got a special guest with us. Amy Morris is in for Charlie Pellet this afternoon. She's following everything happening in the markets and, of course, with the trade. Hey, Amy.
Hey, Tim. Fed Chair Jay Powell, as you know, emphasized the central bank's focus on preventing potential tariff-driven price hikes from triggering a more persistent rise in inflation, stating that policymakers will balance their dual responsibilities of fostering maximum employment and stable prices. And he also said they're in no hurry to change the central bank's benchmark policy rate, telling the Economic Club of Chicago that the U.S. may see inflation because of tariffs and that the U.S. cannot have a strong labor market without price stability, and that the Fed is well positioned to wait for more clarity for now. Now, stocks fell alongside the dollar as Powell stressed keeping those consumer prices in line. That dampened hope for a near-term interest rate cut. We do check markets for you all day long here at Bloomberg. The S&P 500 now down more than 2.5%. NASDAQ now down 3 3/4%. The Dow is down more than 1.5%. The 10-year Treasury yield at 4.27%. The 2-year yield at 3.78%. Tesla's shares of EV sales in California fell to 43.9% in the first quarter. That is down from 55.5% last year. Tesla's registrations also dropped 15% in the first quarter. Sales of all other EVs increased 35% during that same period. At this hour, shares of Tesla are down nearly 6%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Now back to Bloomberg Business Week Daily with Carol Masser and Tim Stenovec.
All right, Amy, thank you so much. Appreciate it. All right, folks, one of our big business and market stories today hit pretty early. Semiconductor shares are selling off. I'm looking at the stocks down about 6% as we speak, and I'm looking at all 30 names in the Philadelphia Semiconductor Index lower in today's session. NVIDIA, the biggest, almost down about 10%. AMD down about 9%. This is new U.S. government restrictions on the export of NVIDIA chips to China and a disappointing report from ASML Holding, really dimming the outlook for the semiconductor sector, wiping out a lot of money, billions and billions of dollars. AMD also saying that it expects to take a charge of as much as $800 million on the Trump administration's new restrictions. So let's get into it. We've got a great roundtable. Bloomberg Intelligence senior semiconductor analyst Kunjan Sabani is with us out there on the West Coast in San Francisco. Also in our San Francisco bureau, Bloomberg Technology co-host Ed Ludlow. Where to begin? Kunjan, let me just start with you because we have seen bans on the semi sector over the last few years. What's the new news and the impact of such?
You know, first of all, there's not a ban, it's a license requirement, which in theory you could get approved. But this was, the event that this happened was not surprising. Maybe the timing was, and the magnitude this time around was much larger. NVIDIA has gone through multiple of such sanctions to China, and every time, you know, they have to take some revenue hit because they could not ship some products. This time around, over the last few quarters, China has been creeping up as a percentage of data center, getting close to sort of 10% in our estimate estimate as of last quarter. So the magnitude now continues to increase. And I think the charge, the $5.5 billion charge, which we think implies to about $14 to $18 billion of revenue that they could have shipped, implies there was some definite demand pull-in in anticipation of such restrictions.
So wait, let me just fine tune. So not a ban, forgive me. So licensing, so what does that just mean, another document or something? Like, what's the distinction? Because you obviously made it because it's an important one. What is that distinction?
Yeah, the prior restrictions on the Hopper family have come as sanctions where the US government comes and just said, you cannot ship this product to China, period. And you have to develop a new product that satisfies those conditions. This time around, it's licensing where they can still ship H20, in theory, if they get a license for each respective customer to ship to China.
Okay, important distinction. Thanks for explaining that. I want to bring in Ed Ludlow, who follows, of course, the space closely and specifically asked about this H20 technology, sure. Ed. What is the technology that is being restricted at this point, and where could Chinese companies and where do Chinese companies want to use this tech?
Yeah, it's a so-called AI accelerator or high-performance GPU and other components that go into a system that largely are involved in the process of either training a large language model or, more relevant to H20 and the anxiety of this US administration, inference. The H20 is a lower performance chip relative to like the cutting edge of what NVIDIA does.
So it's the Hopper and not the Blackwell, right?
It's just a variant, right? Okay. It's a prior generation to Blackwell. It's on a slightly different architecture. Blackwell, we can go into the specifics of why it's different, but all that you need to understand from a sort of markets perspective, and also like the political equation here, is that it doesn't do as much as the cutting edge accelerators that NVIDIA makes. But there's still anxiety from this administration that China could use it in the context of an AI supercomputer, and that they will try and argue presents a national security risk. And Kunjan's analysis is absolutely fundamental.
Brent crude futures settle at $65.85 a barrel, which is up $1.18 or 1.82% on the session.
$5.5 billion write-down because NVIDIA probably knows it ain't going to get a license. Why else would you do the write-down and just clear that inventory off your desk? They kind of seem to have a sense of where this is headed.
So Kunjan, I mean, and I love what you said where this is headed, Ed, because I do feel like the devil's in the details, and we keep seeing different things in terms of, I feel like, the semiconductor world, but it does feel like this administration, bottom line, is going to continue to put some kind of restrictions in different ways. Is that a fair assumption? Is that a bad assumption?
Well, that is definitely a fair assumption. And look, the writing has been on the wall even before this administration steps in, right? That for the AI, the high-end AI semi-makers, the China market TAM is just continuing to shrink, and it will continue to shrink as we think even prior and this administration continue to sort of block or limit the amount of highest end performing chips that China can get access to.
Does it matter, Ed, in the long run? For China's AI ambitions, does this just slow China down, or does this actually hamper what they're trying to do?
NVIDIA shares extending losses, last down 10% to around $100.92.
Even though the write-down on that inventory of H20s is indicative that NVIDIA knows the door's closing in
with that, we're seeing the NASDAQ 100 down 3.7% as well, and the S&P down 2.6%.
Restrictions as they understand them. One really interesting paradox here is the side effect of the White House's policy, which is that China does have some options, right? The context is that in the world of AI, 50% of the research is being done out of China. Literally 50% of all AI researchers are Chinese or Chinese citizens working somewhere around the world. But they have access to other technology. Huawei is increasingly becoming the national champion of China. It does not have a Blackwell, the highest performance chip that NVIDIA produces, but it does have something akin to the H20. And so now China has the ammunition, and poor word, the motivation to champion its own domestic player and say, you know what, have a leg up. Let's use your H20 equivalent instead.
So interesting. It was the exact conversation I was having with a colleague a little earlier, Ed. Kunjan, I want to bring you back in here because you're also watching AMD. Shares down 9.2%, 9.3% as we speak. The company said it expects to take a charge of as much as $800 million after the Trump administration put new restrictions on semiconductor exports to China. What is the AMD product that we're talking about here?
Well, AMD also has a similar watered-down version that it was going to ship to China. It's called the 308 versus the 300 series that it's shipping everywhere else. The impact on AMD, the number for AMD were surprising to us in terms of the exposure that we didn't think it had to China. I think when you look at apples to apples, the AMD will be impacted a lot more than NVIDIA here, because sort of when you think about the lower tier or the pre-Blackwell version of GPUs, this is where AMD competes with NVIDIA. And we thought, given the price competitiveness in China, this is where AMD could gain a little bit higher share than in the US. So blocking this off for AMD to China will impact it worse. Again, the scale is pretty different when you compare to NVIDIA and AMD.
So what I want to ask you guys, and let me go to you first, Ed. I mean, I just feel like the news out of the chip sector, I'm looking at the stocks, it's just getting hammered. All the names are down. I talked about NVIDIA, AMD, both down about 9% here in today's session, and we're looking at an index that is down about 6%, and we're down, 34, 35% from peak to trough. I mean, is it just a normal semiconductor cycle that has, as you know, that Ian King talks about, its highs and lows? Or is it a really major rethink of AI? Or is it just overall kind of market malaise and uncertainty?
It's probably a rethink of supply chain, and it's really been good to learn about how the semiconductor industry works, right? This is where we tie in ASML. ASML was not under pressure because of technology export restrictions. That was a tariff story. But essentially, the thing that they have in common is that America wants the absolute cutting or leading edge innovation to be kept to America. It doesn't want China to have access. ASML does not make chips. It makes the equipment that makes the chips. But their specific equipment, extreme ultraviolet lithography machines, are $300 million a piece, and they are crucial to making those cutting edge chips. What the company told us this morning is we don't know what's going to happen. We cannot quantify it because it's more expensive doing business in America. ASML already does quite a lot here, but it assembles its final product in the Netherlands, and it has some Asia supply chain. So if you're a CEO, whether you're a chip maker, a chip equipment maker, or a designer, you now face a very simple calculus. It's going to be more expensive for you to do business in America, 25 to 35%. That's just the cost of doing things here. Or you face doing things in a jurisdiction in Asia, which we don't know the tariff on yet because of the temporary White House reprieve. That's different to market anxiety. Market fluctuations don't reflect the fluctuations that are happening within these companies right now as they try to assess how they're going to change their business models.
Kunjan, finally, final 30 seconds here in terms of your thoughts here as we look at what's going on in the overall semi space.
I mean, look, I've been in this space for 20 years, and at every beginning of every cycle, we say this is a different cycle, and at the exit of it, we say, no, the outcome was still the same no matter what the drivers. There is definitely something different here where a lot of global geopolitics get involved. Put in context that last year we were sort of peak of valuations. The growth in AI was just increasing tremendously, which we know cannot be sustainable. So yes, the drivers this time look different for the cycle, but maybe the outcome might be still similar to what we have seen.
Okay, so not different this time around, right? Not yet.
Not yet.
Okay, great stuff, guys. Thank you so much. Such an important story today, and certainly has one that's really got investors' attention. Bloomberg Intelligence senior semiconductor analyst Kunjan Sobhani out there in San Francisco. Also in San Francisco at our bureau, Bloomberg Technology co-host Ed Ludlow. Guys, thank you so much.
Okay, Jay Powell covered. Check. Did that. We're going to do more a little later with Michael McKee. Semis covered for now. Did that. Now to the all-important really read on the U.S. consumer. U.S. retail sales rose substantially in March on a jump in car purchases and other goods, such as electronics, suggesting consumers were scrambling to get ahead of tariffs. Maybe you buy a car, you buy a car, you buy a car before those prices go up.
You buy an iPhone, you buy an iPhone.
Maybe. Silvio Tavares is president and CEO at the credit data and credit risk analytics firm VantageScore. He's back with us here in the Bloomberg Business Week studio. It's a joint venture of Experian, Equifax, and TransUnion. Good to see you this afternoon. Just an easy question for you. How is the consumer doing?
Consumer's healthy. We look at consumer health from a credit score perspective. A perfect Vantage score is 850. A really bad Vantage score is 300. through the end of March, VantageScore average was 702. And
how does that relate to other times in the last 4 years, let's say?
Well, that is high. And in fact, it's 1 point higher than last month. So it actually increased, which was a big surprise. You would have expected, with all the headlines that you've been covering, that actually the consumer would not be credit healthy. We actually saw the opposite. Very positive.
Well, you know what's interesting too, and I guess what I want to ask you, I know you've been there for a couple of years, but I think VantageScore goes all the way back to 2006, and there's just been a few things that have happened in that time. We've had the great financial crisis, we've had the COVID shutdown, and here we are today. So I am curious, when you throw these numbers
Treasury Secretary
out, how
Bessent
does it
says the
compare
US
to
is ready to get
other
Iran
moments
energy
of
exports
crises?
to zero.
Yes. So the real insight here is that
Seeing
the
a bit of
consumer
strength in
does not feel
WTI crude here.
crisis.
Again,
This is
US
a
Treasury Secretary
Main Street
Bessent says the
versus
US
Wall
is
Street
ready to
dynamic that
get
we're seeing
Iran
through the end of
energy
March.
exports
Main
to
Street
zero.
consumers feel credit healthy. They actually have a higher credit score. We saw actually consumer payments, so the late payments, credit delinquencies across every credit product, auto loans, credit cards, mortgages, all of those delinquency rates improved compared to February.
I got to push back on this Wall Street versus Main Street part of this, because we kind of saw proof with the UMISH survey that we got, the results that we got on Friday, that this is bleeding into Main Street. Just to go over these numbers, year-ahead expected inflation at 6.7%. That's the highest going back to 1981. Preliminary April consumer sentiment falling to 50.8. The estimate was for 53.8. Our team called it ugly in terms of results. That seems to be hitting consumers.
This is where the difference in data makes a big difference.
The
Consumers,
US Treasury Secretary Bessent made a post
like
on
the one you
X
just
about
mentioned,
Iran
and how they
in
actually
regards to that last
behave,
headline.
which is the data we collect on their actual credit cards and other payments. There's a big difference. And what you see through the end of March, and this is the early view on the data that we're providing exclusively to Bloomberg, is that consumers feel confidently cautious, right? So they're paying down their credit balances. Credit utilization actually declined. They're actually working hard to keep up on payments. Credit delinquencies across all products actually declined on a month-over-month basis. So consumers are cautiously confident. What happens next, of course, is the big question. But what we can see is, through the end of March, banks actually reduced their new lending. So banks are concerned, no question about it. Consumers are not as much.
So Sylvia, are consumers paying more on balances? Like, is the activity picking up? And I just wonder if it's anticipation of, like, things could get a little rough. Let's pare down our, let's cut down on our balances.
Yes, that's exactly what's happening. Consumers are actually paying more on balances, which
plays into what Tim was talking about, sentiment. If you're worried about the future, you might work on your balances, your credit balances.
Yes, and just to be clear, you'd have to be living under a rock not to perceive higher risk. But the reality is consumers do feel confident about where they are and their credit healthy. Now, an alternative,
so again,
Carol,
oil prices gain post-settlement as US ramps up pressure on Iran.
Crisis, what you saw there is a different behavior. Credit balances spiking significantly, and at the same time, delinquency spiking. We're not seeing that right now. In fact, it's the opposite. Balances are being managed well, and delinquencies are actually improving rather than getting worse.
How real-time is your data? You're sharing data with us from March, but the so-called Liberation Day was April 2nd, and that was the day that caught everybody off guard. We can just look to the market reaction for proof of that. Do you have access to the April data yet?
We look at the data on a very regular basis, and the data, we have the most comprehensive and most frequent data. VantageScore credit gauge is published every single month. We're the most definitive source out there because we score all consumers.
All right, so cut to the chase. We have a minute left. What's the data showing you in real time?
Well, the data is showing us that this continued healthy credit behavior is continuing through the early part of April. But look, the reality is, as you heard in Chairman Powell's statements, there's more risk than there has been before, in part due to tariffs. Consumers see that as well, and they want to be well prepared for any new risks that can come.
So delinquencies aren't going up, or any of the activity that you saw in March, it's kind of the same thing you're seeing?
That's exactly right. And we're going to continue to monitor that, and I'm sure you'll have me back next month to talk more.
Silvio says everything's awesome.
Well, he said cautiously optimistic.
Exactly.
Cautiously awesome.
Exactly right.
Cautiously awesome. I like that. Yeah. Listen, thank you so much. Love looking at data and getting an idea of what the consumer is doing. So important to the economy. Silvio Tavares, he's president and CEO at Vantage Score, of course, the credit data and credit risk analytics firm, joining us right here in studio. Silvio, thank you.
Hey, we're seeing stocks take another leg lower actually right now. The S&P 500 down 2.7%. The NASDAQ composite down 4% as we speak. The Dow Jones Industrial Average down by 1.9%.
Yeah, quick check on the S&P 500, folks, and you've got most names in the index. Once again, pretty broad-based in terms of the selling. So 431 names in the S&P to the downside, 70 actually holding on to some gains, 2 unchanged. We've talked about semiconductors, NVIDIA, AMD getting hammered, down about 9%, and the SOX is down 6.4%.
Yeah, I was just going to say, NVIDIA, we're approaching 10% decline right now.
Yeah, we know where the pain's being felt, but it's really broad-based. Do not go anywhere. If you're watching on TV, the close is coming your way in just a moment. Tim and I, continuing on Bloomberg Business Week Daily, we're going to head out to Chicago, talk to our Mike McKee. More on Jay Powell in just a moment. This is Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Alex Steele in Houston, Texas, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
The Fed stands pat, the VIX perks up, and will markets roll over once again? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. So much for the last few days of relative calm in markets.
Yeah, the calm's been broken.
It's been broken, and let's take a look at where things stand right now. The S&P 500 losing 2.8% as stocks decline with the U.S. dollar. They took a leg lower when the Powell headlines hit the tape, and we'll get to that in a moment here. But you really have semiconductor stocks leading the decline. The Philadelphia Semiconductor Index off by almost 6.5%. All 30 members are lower, led by NVIDIA, Advanced Micro Devices, as well as ASML on trade war concerns. You see yields moving down here with the 10-year yield off by almost 6 basis points at 4.27%. And as I mentioned, the dollar resumes its sell-off, got a respite yesterday, but now making fresh 6-month lows.
Yeah, that number at the top of your screen, really astonishing, Scarlett. If you look at the top 10 decliners on a percentage basis in the S&P, 7 of them are chip stocks. Remember, we came into this morning with U.S. stocks still mired in correction, and as you see this afternoon, they're sinking deeper into that muck. That once red-hot AI chip trade further cooling amid confusion about U.S. export restrictions for some of NVIDIA's chips and dour commentary out of chip equipment maker ASML. The Philadelphia Semiconductor Index still more than 30% below its most recent all-time high, and almost all of the members in that index sitting on double-digit percentage losses on a year-to-date basis alone. Meanwhile, over at the WTO, they actually slashed their global trade outlook from growth to contraction because of tariffs, and now expects the volume of world merchandise trade to decline by 0.2% this year, almost 3 percentage points lower than it would have been without the U.S. instigated trade war. And things could even be worse, a contraction of 1.5%. That's what the WTO says if the U.S. pushes ahead with those higher reciprocal tariffs. But don't look for any help from the Fed just yet. Cleveland Fed President Beth Hammack said there is good reason to hold interest rates at current levels until there's more clarity. And while Fed Chair Jay Powell in a speech also made a case for standing pat, he did acknowledge that a weakening economy and elevated inflation could eventually bring the central bank's dual mandate into conflict.
We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close.
All right, we go now to Bloomberg's Mike McKee, who is live at the Economic Club of Chicago event where Jay Powell had just finished speaking. And Mike, we saw that Jay Powell referenced famous Chicagoan Ferris Bueller when he said that life moves pretty fast. But then he added very quickly that the Fed is in no hurry to do very much when it comes to interest rates.
I think that's the takeaway, Scarlett. Basically, Jay Powell didn't say anything new today, but he reminded markets of what they're afraid of. The tariffs were bigger than expected, so inflation and unemployment will be higher than anticipated. The Fed doesn't know which one is going to go up first or how far, so the best thing for them to do right now is kind of sit and wait and try to determine what is happening with the economy as best they can. Nobody knows where the tariffs are going to come out, he said. It's very hard to model, so we are just going to do our best to figure it out and wait until then, because policy's in a good place right now.
But he did talk a little bit, Mike, about this idea of sort of, okay, we're focused on the dual mandate. Obviously, you have the inflation side, the labor market side of it, and this idea that because of that uncertainty, they may now have to sort of address this idea that one is not going to be compatible with the other.
Yes, they are concerned a little bit about the stagflation issue. And for the first time, it's not really the first time he said it, but he emphasized it today. What they're planning on doing is they'll look at how far either one, unemployment or inflation, is from where they think it should be, and they'll attack the one that's farthest away, the one that will take longer to come back. But they're hoping they don't get there because obviously, as he put it, it would be a very difficult judgment to make.
Michael McKee out there in Chicago, of course, on the heels of a great interview a little bit earlier today. Professor Rajan interviewing Fed Chair Jay Powell. And for the record, Scarlett, I would just like to point out, fun fact here, that Ferris Bueller was actually born in Germany.
Oh, so, really?
Yeah.
Ferris Bueller himself was born in Germany.
I'm waiting for the copyrights to expire so I can write the ultimate fanfic of that movie.
But you, sir, are Mr. Chicago, right?
I am. He technically lived in the suburbs.
All right, so another famous Chicagoan.
He's a German-born guy, a fictional German-born guy. Kara Murphy is not fictional. She joins us right now. She's Chief Investment Officer over at Kestra Investment Management. And Kara, I mean, I don't know if you had a chance to actually hear what Jay Powell had to say today. And if you didn't, don't worry, because he said it before. And it raises this whole idea as to whether the market should even be looking to any sort of help from monetary policy anytime soon.
Yeah, I did listen to the comments, and I think the message that we should take from this is that the Fed is not coming to the rescue, right? Stagflation was sort of written all over Powell's comments, even though he didn't use that term specifically. He was clearly laying out a possible macroeconomic scenario where we saw higher inflation and slower growth. And what he said, or at least what I heard, is that we're going to take our time. We don't need to move today. We're going to let these two things play out. There's a lot of weighing of both the magnitude and the duration of these impacts, and the Fed's not going to change policy anytime soon. So again, I think this idea that the Fed's going to come to the rescue and save us from this policy uncertainty, it's just not going to happen.
Well, then as an investor, though, I mean, how do you sort of position yourself? Because if you are of the belief that some of these policies are going to be economically damaging, and you're also of the belief that it's not going to be damaging enough for the Fed or anyone else to really ride to the rescue, where does that leave you as an investor?
Yeah, so the short answer is that you approach it very carefully. But what I will say is that we entered the year thinking mostly about two particular risks. One was that we had pretty high valuations in the market, especially in the Mag 7, super high concentrations in core indexes with those names. And you had, it was very clear from the beginning that we were going to have a lot of policy uncertainty heading into this Trump administration. Those two things together are what we're seeing today, right? It's not just the policy uncertainty, but you also had very high expectations for certain areas of the market. Those are the risks. The good side of all of this is what we're seeing is that the market is differentiating
NASDAQ
between
100
some of those
extended
names
dropped
where
to as much as
expectations
4%.
were really high, and then other areas that have really kind of been left behind and where expectations aren't so high. So bonds we've seen perform okay. We've seen value perform okay. Non-US has performed okay. And so all of that leads up to this idea that having diversification, having exposure to different types of asset classes is exactly what you need in order to get through this period of uncertainty.
It also helps that most of the turmoil seems to have subsided for now, that perhaps we've hit bottom, especially when you look at the knee-jerk reaction to Powell's comments today. You have stocks lower, the 10-year yield taking a leg down, showing prices are still up, and the dollar continuing to bump along its lows. How much of a relief is it to have that familiar risk-off dynamic take over as opposed to have everything decline, stocks, bonds, and the dollar, like we saw at the end of last week?
I think anytime you can see this sort of like range of outcomes start to be narrowed a little bit, it's good for the market, right? The market hates uncertainty more than anything. So we know we're not going back to this environment with no tariffs. We think that this environment with like extremely punitive tariffs against all of our trading partners is now also off the table. We've heard a little bit more about how the Fed is going to approach this, right? So every little piece of information you hope is narrowing that range of outcomes. So even though we're not to a point where we're really certain about what policy is, there's at least some of those tails off the table. And so I think every week that we go through here, we've seen a little bit of a narrowing of those outcomes, which should provide a floor for the market.
And speaking of narrowing of outcomes, I think about what United did yesterday, offering dual forecasts for its year ahead, one in what it expects and then another in a recessionary environment. To what extent do you think that that has created permission or a template for other companies to do the same? I mean, it provides transparency in a way that we weren't getting from companies.
I think that it's actually a very helpful approach. Because again, you take off some of these extremely onerous scenarios. You're like, okay, even in a recessionary scenario, people stop flying as much as what we had expected. This, I can count on the idea that this is what the company is going to earn. So I think if a company can sort of like map out those different paths, it makes it much easier then for an investor like myself to be able to predict those different outcomes and to build a playbook for different macroeconomic environments. So I would think that we start to hear more CEOs take a lead from them and start to provide multiple different scenarios.
So as we get deeper into earnings season here, and I understand that for the CEOs, this is going to be a tough job, Kara, but do you need that ratification from them? I mean, we kind of already know that they can't forecast the future. Do you need to actually hear them articulate that?
I think for some of these companies that we expect to be most impacted by tariffs, where they have a little bit of certainty in terms of the range of outcomes, it can be really helpful. Not every company really needs to know this or provide this type of guidance, but for ones where, you know, CEOs can see that, okay, yes, we can operate, we can be profitable in a very onerous tariff environment, it can only be helpful to be able to provide that to investors. And again, not everybody's going to do that, and not everybody really has to.
All right, Kara, always a great conversation. Kara Murphy, Chief Investment Officer over at Kestra Investment Management, kicking us off to the close here on this Wednesday afternoon with stocks right now hitting session lows on the day and gold right around session highs, breaching 3,300. A discussion on how this impacts the guys literally going after the gold. The CEO of Core Mining going to be joining us after the break. This is The Close on Bloomberg.
Season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
In case you missed it, on Bloomberg Technology.
This is the first event in history where a company CEO invites all of the guests to explain why he was wrong.
We have a vision about how quantum computing will be useful.
We're still at the beginning of a learning curve with respect to how NVIDIA and Jensen interact with quantum computing companies.
Don't miss Bloomberg Technology live every weekday.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
another record today as it continues to outperform its cheaper peer, silver. But Bloomberg Intelligence's Mike McGlone thinks that this could be a worrying sign. Gold's steady outperformance versus silver, which began before the election of President Trump, could signal a turn for the global economy as the gold to silver ratio reaches the 100 milestone. Here with what this means for the guys who actually mine these metals is Mitchell Krebs, Chairman, President, and CEO of Core Mining, which operates several gold and silver mines across North and Central America. Mitchell, good to speak with you. And I want to start on a macro basis. When you take a look at the price of gold, which has given its recent run-up, is now past $3,300 an ounce, what does that tell you about the state of the world, or what people think is the state of the world?
Yeah, well, thanks for having me, first of all. Boy, I never really thought I'd see gold above $3,000
So US stocks
an ounce.
falling further now.
To me,
The NASDAQ down 4.2%, S&P 500 down 2.9%, and the Dow down 2.1%.
2022, when Russia invaded Ukraine, you really started to see central banks around the world start to diversify their reserve holdings away from the dollar. And gold has really caught a bid ever since then, and it's just gained momentum. Investors are now starting to join the party, I think, as they look at tariffs and the inflationary impacts potentially of that, just overall geopolitical uncertainty around the world. There's just risk everywhere, and people, in those times tend to turn to gold. So you have all of these things kind of lined up at the central bank level, at the investor level, and it's really leading to these seems like we're hitting a new high, all-time high in gold almost every day.
And of course, you mentioned tariffs. We know that the White House has exempted several metals, including gold and silver, from reciprocal tariffs. Yet it has also begun investigations that could lead to sectoral tariffs, for instance, on copper, which we expect is forthcoming. What is your confidence that gold will warrant a permanent exemption?
I think that will remain, just given the kind of reserve nature of gold globally. I mean, for us, we're a U.S.-centric company. The majority of our revenue comes from mines here in the U.S. Even in the case, we have 2 mines in Mexico, but everything we use, we consume, that we purchase at our operations is really sourced locally. The metal that we produce in country is sold in that case in Mexico. So, we're pretty well insulated, but I think the exemption on gold will probably hold. Silver is a little bit of a toss-up because it's a little bit like gold, but it's a little bit like silver. There's about 70% of total demand every year for silver is industrial, mostly electronics. It's the best conductor of electricity in the world. So, it has some properties like copper. So, we'll see on the silver side. But we just ramped up a new silver operation out in Nevada that we just invested over $700 million to expand. So that becomes America's largest source of domestically produced and refined silver. So I think we're in a really good position given where we are on the global level right now.
On the issue of silver, though, I mean, given that a lot of times what people are buying silver for is different than what they're typically buying gold for, and obviously there's a little bit more cyclicality and economic exposure with regards to silver. Are you worried at all, given some of the concerns about a potential global economic slowdown?
Yeah, and I think we see that in the price of silver. Gold is at this point, more than 50% above its former all-time high, whereas silver is almost 50% still below its all-time high of close to $50 an ounce back in 2011. And I think a lot of that has to do with the fact that so much of silver demand is electronics, consumer electronics, smartphones, computers, chips, you name it. And I think that's probably been a little bit of a drag on the silver price. I mean, if silver does catch up, you mentioned earlier the ratio between silver and gold, typically that's more like 70 to 1. It's blown out, like you referenced, I think over 100 to 1. If silver does play catch up, there's still a long way for silver to go to hopefully knock out its all-time highs. But I think there is some headwinds on the silver side, given that demand profile.
I'm also curious just about general geopolitical risk. I know we talk a lot about what's going on in the context specifically of the tariffs that would have to be paid based on what's going in and out of the country. But like we take some of your operations in Mexico, so like the Palmarejo operations there, I know a lot of that, what comes out of that gets sold domestically into the Mexican market. But is there any concern that given the geopolitical tensions, assets like yours could become a political football?
I think that's definitely the case for places around the world. I mean, there are a lot of mining companies with a footprint, stretched around the globe in some places that I think are much more at the tip of the spear or the top of the list in terms of some of this, tariff uncertainty out there. I think in the case of Mexico, maybe less so, whether that's because of the USMCA footprint, over Canada and Mexico and the U.S., or just the fact that most of the silver that we require here in the U.S. Comes from Mexico. About 80% of what we need every year here in the U.S. comes from outside the U.S., and Mexico is at the top of that list.
You mentioned the mine that you have in northern Nevada for silver. You also own a polymeric silver zinc lead project in British Columbia, Canada. It's not in production, but it does give you some flexibility, some options. What would be the catalyst for you to switch on production there?
Yeah, well, we'll need a little bit more time to drill it and continue to expand it and put it through the studies that it needs to go through. And then there's some permitting. But I'm glad you brought up Silvertip because it's a poster child of these critical mineral deposits and projects that countries are now starting to really focus on. The world is waking up to how strategic these critical minerals really are and how, they're the building blocks really of our modern economy. And in the case of Silvertip, we have one of those sitting there. And I'd like to think that with some of the support now that we're seeing from governments like the one in Canada, like the one here in the U.S., that Silvertip now, especially at these elevated prices, could be moved along a bit faster and then become another North American source of production for us. In that case, it would be more silver, zinc, and lead. But for us, it's mostly about the silver. That would really take our overall silver production up into a pretty dominant place globally.
All right, Mitchell, got to leave it there. Great stuff. Mitchell Krebs, Chairman, President, and CEO over at Core Mining on a day where we see gold hitting record highs and silver at one point coming just a couple percentage points away from reclaiming its record high as well. When we come back, a refocus on what's going on in the equity space and a massive drop down today in the chip sector. NVIDIA dropping 10% on the day, worst day going back at least to early January. A conversation as to exactly what could potentially arrest the slide. That's coming up next on our Top Calls. This is Bloomberg.
In case you missed it on the opening trade.
The president is speaking to this part of our population that we know did not benefit from globalization. The IMF has been talking about those left behind for decades, and we haven't really seen anything to speak to that part of the population. That's who President Trump is speaking to. But we in Europe, we're seeing the same thing. We're just a few years behind. That part of the population who were left behind are voting, they're speaking. And this is going to unpick a lot of the fabric of the economy that we have seen for the last 20 years. So for me as an investor, it's really thinking about, right, if we had 20 years of globalization that created winners and losers, who were they? And if this is going into reverse, maybe the past losers will be the winners, and maybe the past winners will be the losers.
Don't miss the opening trade, live every weekday.
Asia is at the forefront of some of the world's biggest stories. And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off today with Target. Goldman Sachs actually downgrading the retailer to neutral, lowering the price target by more than $40 to 101. The Goldman noting that tariff uncertainty and inflation taking a toll on consumer sentiment, which will further delay a recovery in growth for discretionary sales categories. Those shares down about 2.5%. Next up, JP Morgan downgrading U.S. Steel to neutral, trimming the price target down to 38. The firm expecting U.S. Steel to take a hit as tariff uncertainty softens demand, especially in the auto sector. And finally, Lockheed Martin, an upgrade over at Morgan Stanley, with the analysts saying developments over the past few weeks point to an improving sector backdrop for the company. Those shares bucking the sell-off today, up about 1%, and those are some of your top calls. As far as that sell-off, a big part of the reason for that sell-off is NVIDIA. Biggest drag right now on all of the major indices, down 10%. So too is AMD. This after we learned that the Trump administration has released new restrictions on chip exports to China that prompted NVIDIA to warn about a potential write-down of $5.5 billion. Joining us right now is Matt Bryson, Managing Director and Equity Research Analyst covering the enterprise hardware sector over at Wedbush. All right, so Matt, when we saw the number, the $5.5 billion, and a lot of concerns here about what chips the company would be able to get out of the border over to China or whatever other customers want them, what type of impact are you modeling in right now for revenue at NVIDIA?
I haven't shipped to my model yet, but they told us that China was low teens portion of revenue for AI last quarter. If anything, I think it may have grown a bit from there. China has been really strong on the back of DeepSeek. They've been taking more product. But you look at NVIDIA, you think roughly 10% of the revenue goes away. That's probably in the right ballpark, assuming this is how things stand from here on.
Is there any sense here, Matt, that NVIDIA could get a reprieve? Because it seemed like, again, over the weekend, that all the talk was about that dinner that Jensen Huang had at Mar-a-Lago and how, at least for now, he appeared to have been set.
I mean, this is the problem, that over the last 3 weeks, everything's been dictated by policy changes, and it's very unclear where policy goes from here. Is this a trading chip that the U.S. is using to try to get concessions from China? Is it more about longer-term security? I would argue that the H20 is more of an inference product, so it's really going to be used less for developing technology that's potentially harmful to the U.S. And more for running applications, but it's just really hard to tell.
Assuming these are permanent export controls, what happens to the supply of H20 chips that NVIDIA is no longer able to sell? Is there still a market for this chip that is powerful but not too powerful?
That's the problem, is that there isn't a market. So this chip had been restricted for China use only because China couldn't take the more powerful chips. If I'm in any other geography, I can buy an H100 or an H200 or a B100, all of which are more powerful than H20. So this product effectively has no market.
Okay, so Matt, just walk us through quickly what this will mean when TSMC reports results.
So TSM, last time we were in a situation like this where there were a lot of unknowns with COVID, and TSM only guided down a few percentage points from their prior guide. I wouldn't be surprised if TSM ends up in the same situation this time, or even still gives us a 2025 as flat. Last time I talked to them, they reiterated what which is there's not enough high-end semiconductor production, and that may still be the case.
All right, Matt Bryson, really appreciate your joining us, Managing Director and Equity Research Analyst over at Wedbush. Coming up, we'll speak with Michal Katz, Head of Investment and Corporate Banking at Mizuho Americas on M&A ahead. This is The Close.
The Japanese yen rises 1% per the US dollar, a fresh 2025 high now.
Asia is a continent of contrast. The region is a nexus of rich cultural traditions and a vibrant hub of trailblazing innovation and modernity. How will it push the limits of technology even further?
Going to space should become as easy as, taking a flight.
If NASA is designing a lander, their approach is they're designing a Formula One car. So we take, say, a Jeep approach.
Minister, give us a sense of how you translate Korean architecture for the rest of the world.
We call this madang. In general terms, it's where we can be ourselves, where we belong.
There is an old saying in Korea that says, "거미 불루, 화이 불치." It means simple but not humble. So it has a tremendous impact on Korean architecture.
People tend to think the robot AI taking the job from them. We want to use the robot as a basic asset, meaning people have an income through the robot.
From space tech in India to robotics in Japan, Asia is driving the future, reshaping industries, societies, and the way we live. Join me as I take you through the bold innovations. Discover Asia's next-gen technologies on Momentum.
I'm David Weston. Join me for the next generation of Wall Street Week. This week, faith-based activist investing told through the eyes of Robbie Starbuck. Sports as an investment class, driven in part by the rapid growth of women's professional soccer and basketball, and the challenges China faced long before President Trump's most recent round of tariffs.
At this point, this is a zero-sum game in Xi Jinping's mind.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ. Mondays on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Scarlett Fu. And, relatively quiet day, even with equities lower. But one thing that we've been talking a lot about is how there hasn't been a whole lot of M&A. And there was a deal today, although it's fairly small. Lyft buying a European taxi hailing app for almost $200 million from BMW and Mercedes-Benz Mobility.
I guess a deal is a deal, right?
It is.
It raises the question, too. I mean, we haven't seen, obviously, a lot of deal-making activity, particularly given some of the expectations coming into this year and coming into this administration. But there are people sort of sniffing around for bargains. I'm not sure what the origin of the Lyft deal was, but you saw the story on KKR. I mean, they did $8 billion in deals just last week alone. So there are bargains out there, I guess, if you have the cash and you're ready to go.
And, I guess this is as good a day as any in terms of the stable market conditions because you have a regular kind of risk-off environment right now. So for more on the M&A space, we want to bring in Michal Katz. She is head of investment and corporate banking at Mizuho Americas for her outlook. And Michal, it's no secret that M&A has been slow to come in 2025. Just give us a sense from where you sit, how you would characterize the activity that is taking place. What kind of conversations are companies having right now?
Well, thanks so much for having me. And I'd say that coming into 2025, expectations were high that the pro-growth, pro-business administration would actually catalyze both capital markets and deal-making activity in M&A. And clearly, some of the uncertainty that we've seen has shaken that confidence, which very much underpins what deal-making is. But I'll make a couple of observations as we think about the broader landscape. M&A at its core requires an industrial logic to support a transaction. Many of the investments, whether it be CapEx on an M&A deal-making, are ones that require multi-year investments. And so there are some deals that have been getting announced. They also have been in the works. But I would say is that without that confidence underpinning I would say, conviction, it would be hard to get deal-making activity coming in back at the anticipated pace. I would say the following. When you take a look at the first quarter of this year, U.S. M&A has been down, but international M&A was actually up, driven by activity in both Asia and Europe. I'll just note two of those with the CK Hutchinson transaction, in which they sold ports, including the Panama Canal, to a BlackRock consortia.
Although Beijing wants that reviewed.
100%. As well as Google acquiring Israeli-founded Wiz in the cybersecurity space for $32 billion.
So that's a really good point. I guess what I'm curious about, too, is given the results we heard from the big banks, they were fairly sanguine about their outlook. And it's clear that they're still willing to lend money at a time when a lot of PE firms need to put money to work and also return capital to their LPs. Do you think deal structurers will get more creative as a result of this?
Well, some of the transactions, you mentioned a couple in the market, have seen cash transactions, but I do think we need to take a step back. I do know that our U.S. economist, Steve Rasciuto, was on this morning as well. And coming into the 2025, I would tell you the economy has continued to be on solid footing, whether you look at GDP growth, employment, the balance sheets of the household, the banks, corporates. I understand that hard data tends to be a lagging indicator, and sentiment has definitely shifted to the downside. But those, to me, inform the fact that our economy can sustain shocks coming out of a slowdown of sorts. The other thing that I would say, when an organization is looking towards M&A or capital investment, they're looking to future-proof the business. Now, you asked about financing. I'm proud to say that Mizuho reopened the high-yield market yesterday with an upsized transaction for Venture Global, $2.5 billion in the marketplace. We also advised Lowe's on an acquisition yesterday. And so the banks, you saw in earnings, trading have done well. Deal making has been negatively impacted by the volatility. But on balance, I do think that once we get some stabilization into the system, it should unleash some of what I would call the, this bottleneck that we've had. We don't need perfection, I always say, but we do need some stability. And hopefully this should set us up for a better second half. Although I'll caveat it by saying, don't expect 2025 to be setting any records for deal making.
Okay, so at least not at the top, but as far as the bottom and the worst case scenarios that everybody had predicting, you're not in that camp as well. I mean, you've lived through or worked through several crises, including being at Lehman during the global financial crisis and the dot-com bubble bursting. This isn't that, is it, when we talk about the impact on deal volumes?
That is not our case. I mean, but you mentioned earlier on, like, what are CEOs, what are boards doing? They are planning for multiple scenarios just to deal with that wider distribution of outcomes. And to me, the United earnings that came out, giving you a base case and a bear case, is indicative of that. But no, we're not predicting, nor are we factoring in any type of that shock in the system.
I am curious about just geographically where the money is flowing. You mentioned that you are seeing a little bit more deal activity in Europe relative to the U.S. I know you guys have been doing a lot with Greenhill, an acquisition you made, and that you've been trying to tweak along the edges. But this was, I guess, an appeal to the European investor. Is that business that you're seeing through Greenhill, is that primarily going to stay in Europe, or are you also seeing more cross-border activity here with the U.S.?
So Greenhill had presence both in EMEA, the Americas, as well as Asia-Pac, including Australia. And a lot of the activity that we are seeing is cross-border. And let's not forget Mizuho is a Japanese bank. And as you know, Japan has been going through this economic revitalization. And we're seeing a lot of interest
says the group refuses to hand in weapons.
As well as Japanese companies looking elsewhere, whether it be the U.S. Steel, Nippon Steel is an example. And it's not just corporates, it's also private equity. And so you're asking whether it's internally.
Hamas refuses to hold talks over weapons at any point.
Really happening across the board.
Okay, so there's geography, and I also want to ask about sectors. What's your read on regulation on deals within big tech? We've seen that the FCT appears to be as strident as it was under Lina Khan, especially when it comes to certain kinds of deals. Meta, for instance, there's a trial taking place right now. Do you think that extends through the Trump administration?
So that's a great point. You know, one of the I would say, surprises in February was with the new FTC chair, Andrew Ferguson, decided to uphold the merger guidelines, which many have thought would be rescinded outright or amended. But when you speak to the legal community, the view is that the application or the enforcement of the guidelines would be more reasonable. So they would be more willing to negotiate remedies with counterparties as opposed to try to go and litigate in order to establish new case law. You asked about tech. I think that the expectation that we have all had that tech would continue to be at the crosshair, but it wasn't kind of raise some eyebrows that they had decided to block the HP transaction. You talked about Meta. You saw today the news around NVIDIA and the H20 Blackwell chip. So I don't think that tech will be immune.
I'm going to ask you a somewhat loaded question, but I do have to ask. I mean, you mentioned, obviously, Mizuho being a big Japanese bank. It made huge inroads into the United States, partly because of you. You've made huge inroads into Europe. We're now at a moment in time where everyone's questioning globalization and the interconnectedness of all of these different regions. Is this going to end up being potentially a mistake, that expansion?
First of all, it is because of the team that I've built that we have made such great inroads. So thanks for bringing that up. Look, the underlying decision behind Greenhill was to broaden our M&A capabilities. M&A, if you looked at Q1 of this year, constituted 45% of the investment banking fee pools. On average, it's around 40%. For us, it was leaning in toward an area where we were underweight. Secondly, Greenhill has great capabilities advising public companies, very much aligned with Mizuho being a corporate and investment bank, and so better able to serve our clients. In terms of globalization, it's going to be incredibly hard to completely unravel 40 years of what I call the post-World War II economic order, but it is getting reshaped. And so we're seeing Japan in with the administration today and other countries coming in to try to come up with some sort of a solution or some sort of a compromise. And so, no, I have full conviction behind that acquisition.
All right, that's a great place to leave it. Appreciate your candor. Michal Katz, head of investment and corporate banking over at Mizuho Americas. When we come back, a closer look at one of the biggest gainers of the day. It's our stock of the hour, and it's up next. This is Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. The Spanish bank BBVA has gained worldwide respect for its efficiency and commitment to innovation. CFO Luisa Gomez Bravo welcomes the challenge of keeping her company on the cutting edge.
In the world that is changing so fast, having a finance function that adapts quickly is crucial.
Watch Chief Future Officer only on Bloomberg. Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
Fewer than 50 of the S&P 500 stocks in the green today, and one of them is Abbott Labs. The company shares rising after an earnings report met analyst expectations despite the threat of tariffs. Billy Lipschultz joins us right now, helps to lead our equities coverage here. An interesting pop on the day, 3% on a day where everything else is down. Is this all about the numbers from the most recent quarter?
It's partly about the numbers, but it's also the broader dynamics of if we are dealing with uncertainty in the markets and people are dumping technology stocks, well, healthcare at least should be better positioned. We had at least one analyst coming out saying it could be kind of a port of calm in the storm. As it is, just given the volatility, and broadly speaking, if you make devices safe for people who are monitoring their diabetes, they're not going to turn that off. So there still is demand, and also the fact that they maintain guidance for the full year, despite a rocky first quarter and despite these headwinds. Even this company CEO basically.
And we should point out, Abbott gets most of their or the biggest bulk of their revenue comes from medical devices.
Medical devices is the main driver. They have nutrition, so they make Ensure and things like that. But that's really the big driver for them.
Have you had Similac lately? No.
The other thing that Abbott is doing that we've seen from a lot of companies is talk about how they're going to invest in U.S. manufacturing, $500 million in this case. Is this a new investment? Do we know?
It seems like it's going to be part of kind of more that broader nearshoring trend. They did call out in their release that they do have kind of a diverse supply chain, so they are dealing with those kind of ramifications. But again, CEO did say a few $100 million in terms of the impact of tariffs. So when you're trying to invest and alleviate some of those headaches, the one thing that was interesting, though, that stood out to me from the earnings call was that the CEO was basically like, we still are dealing with the costs from the 2017 kind of things that the government put in place. So these aren't headaches that go away. They're not transitory. So there are things that actually impact the bottom line of the business. So I do think that's part of how they're trying to navigate the path forward.
We only have about a minute left, but I am just curious more broadly about where people are looking for safety in this market. Obviously, traditionally, healthcare has been one of those areas, the idea that it's recession-proof because you're going to, get your medical procedures done, whether bad times are good or bad. But when I look what's up today, there's not a whole lot else. I mean, gold stocks and defense contractors.
Exactly. And I think the broad thing, though, Romaine, is we're still dealing with an uncertain health environment with Robert F. Kennedy Jr. leading the FDA. So you're dealing with those headwinds. So medical devices are more of a safe bet as opposed to biotech, which I just had lunch today, where it's like no one wants to go anywhere near that. And even the specialists are on edge.
I got 3 vaccine shots this weekend.
Really?
Yeah, I got like the old man vaccines, like shingles, tetanus. What was the other? Oh, pneumococcal, which I didn't even know was a thing. And I said, why do I need these? He's like, well, sir. Sit down, old man. Anyway, Bailey Lipschultz, the youth of Bloomberg Television there. Scarlett.
All right, we're going to take you to the closing bell. We've got about 15 minutes left to go before this market closes. Joanne Feeney, partner and portfolio manager of Advisors Capital Management, will be joining us next. This is The Close on Bloomberg.
case you missed it on Bloomberg Surveillance.
I worry less about AI taking my job. I worry more about someone who uses AI really well taking my job. AI is still not going to have the human instinct and the judgment that you're going to need to have. You're still going to need to do oversight. There's a human in the loop, but now that developer is going to have a companion. And so what AI will allow us to do is not just go do things that humans don't do as well, but actually do things that humans don't have the time to get done.
Don't miss Bloomberg Surveillance live every weekday.
I fell in love with cricket. I started reading about cricket. You know, cricket is not a very simple game to follow. You need to understand it. And here I didn't know a simple thing like there are different kinds of bowling. Like there is a spin bowling and there's a pace bowling, and in spin bowling there is a different kinds of off spin and a leg spin. And in pace there is a swing. And so it took me some time to just start talking to all these boys of cricket. I spoke to Sachin, who is known as a god of cricket, and I would ask him such embarrassing questions. But yeah, today it feels very good to see Mumbai Indians doing so well. My son is leading it, but also I think the Mumbai Indians women's team is something that fills my heart.
Why?
With joy. I think these girls go through so much.
So 1 minute now until we get the markets on close imbalance.
From seeking permission from their parents who are not willing to let them follow their dreams. Financial issues. When you see them all coming together from these remotest villages of India and play for you and tell you these stories, it's just so inspirational to see our girls in sport.
We give longer term money. Our loans are anywhere from 20 to 50 years in length. After I came, I got our board to approve 50-year loans.
10 seconds.
Hey, can I get one of those 50-year loans? I'd like to get one of those.
Absolutely, although you'll have to be around to enjoy it.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers.
So we're looking now to the market on close imbalance. The S&P 500 is a buy side 650 million. The NASDAQ 100 buy side 1.8 billion. Dow 30 sell side 50 million. Mag 7 buy side 730 million.
For some of these companies that we expect to be most impacted by tariffs, where they have a little bit of certainty in terms of the range of outcomes, it can be really helpful. Not every company really needs to know this or provide this type of guidance, but for ones where, you know, CEOs can see that, okay, yes, we can operate, we can be profitable in a very onerous tariff environment, it can only be helpful to be able to provide that to investors.
Kara Murphy over at Kestra Investment Management, kicking us off to the close just about 50 minutes ago, Scarlett Fu. And unfortunately, the situation in the market appears to be deteriorating. We're off the lows of the day, but still a phenomenal break from that relative calm that we had the last couple of sessions.
Down, down, down for the equity indexes, certainly after Jay Powell spoke and those headlines on how the Fed is in no rush. And you really see the pain in the chip maker space. All 30 members are down, led by NVIDIA, AMD, and ASML on trade war concerns. And of course, I included energy stocks only because they're the outliers. They're the lone holdouts in today's sell-off. But again, these are the biggest decliners since April 2nd, still down about 14-15% since Trump announced those reciprocal tariffs. And the VIX inching up again, but you can see that it is holding in the low 30s.
Yeah, absolutely. I mean, I was going through that list of kind of the big gainers on the day in the S&P 500. And yeah, a lot of energy and mining and materials names in that a lot. And in fact, when you take a look at the broader market here, it's certainly a bid to a certain extent to safety. Joanne Feeney joins us right now, partner and portfolio manager at Advisors Capital Management. And Joanne, I mean, I was kind of going through kind of what the winners are today and really over the last couple of weeks. It's basically low volatility stocks, whether it's on a pure factor basis, on a long short basis. That's a winning trade today. It was a winning trade over the past month, and year to date, that's been the winning trade as well.
So it does appear we had a brief technical issue with the site. If anyone's experiencing any issues and not seeing the market on close imbalance, for example, you can press Control and F5 to hard refresh your website. that
have
should fix
exposure
the
to
issue.
those kinds of
Apologies for
companies
the
that are going to
inconvenience.
participate in what we're calling, the new economy growth engine, which is still artificial intelligence. And so even though it's obviously a very rocky ride, this separation of the U.S. and China and the protection the U.S. wants to create for our AI leadership is obviously causing a lot of headaches. But that doesn't mean that these stocks still don't offer really good opportunities for growth for the multiple years out from now. And that's what long-term investors really need to keep in mind. Other investors have a shorter-term focus and need to do more to protect their principal. And in those cases, right, they want to go to the sort of stocks that are more like consumer staples, utilities, less volatile opportunities.
For those longer-term investors who are looking at those broader structural themes and changes, and AI is obviously at the center of that. AI, of course, also being scrutinized a lot more, particularly in light of some of the export controls, if you will, as well as just a broader concern about a drop or a pullback on some of that CapEx spending. That doesn't worry you at all over the long term?
Well, there's a lot of concern certainly about how much more CapEx spending will be coming to power the build out of the AI infrastructure. There's no question about that. But right now we're not seeing any real cracks in that spending. Microsoft may be moving their situation a little bit on where to build data centers and with whom to partner, and their partnerships are changing, and that's causing some of their CapEx plans to change. But overall, when you look at the data, the numbers that are still out there on total CapEx spending for AI infrastructure are still growing very nicely and look like they're going to do so for many years to come. So yeah, longer term, I think that's still a very good opportunity.
And of course, we'll wait to see what these companies say when they do announce results in the coming weeks. Speaking of CapEx, I'm wondering, when companies like Abbott say they're going to invest $500 million in 2 U.S. facilities to nearshore or reshore some of their manufacturing, it's a move that pays off politically, they hope. But is it a move that changes the attractiveness of the stock, of the company's fundamentals for investors?
From what I've seen so far in their operational costs, it doesn't look like it'll be that much more expensive for them to shift some manufacturing to the U.S. out of Europe. And so, overall, the company's attractiveness isn't really affected that much. The problem, right, for them and the administration in trying to incentivize companies to move some manufacturing here is that it will take years. And so, we hope that these sorts of announcements from companies like Abbott will forestall any move by this administration to put any significant tariffs on the import of pharmaceuticals. Those brand name pharmaceutical companies will be just fine if they end up moving here. It's the generics that really are it's uneconomical for them to try to move manufacturing to the U.S. So that's a big question as to what happens to that side of the industry, and we're not excited about those sorts of stocks.
As a result of that, because of that reason?
That and others, but yeah, that's a pretty big reason. First of all, their margins are really thin, so it's a very tough business to keep operating well, and that makes it a very challenging place to invest. But when you have a headwind like this potentially, that could destroy the business, that it could actually make it uneconomical to even sell into the U.S. if there are any material tariffs, that obviously creates an awful lot of risk.
A lot of risk, and it raises the question, too, about the global exposure that a lot of companies in the S&P 500 have. Do you need to start, as you're picking stocks for the long term, do you start to parse through some of those names?
Yeah, what we've done since the beginning of the year, Romaine, since we started to see this kind of a risk increase, was we did shift a little bit within our balance strategy, which is our most conservative approach for investors. And we like the volatility there to be less than the market as a whole. We did start to shift towards companies that have more domestic exposure. And we've continued to make some trades in that direction over the last few months. Owning a company like United Healthcare, for example, and decreasing our ownership of companies that have more exposure to the higher input costs that those tariffs will create. That's one way of trying to shift away from this kind of risk. And so, yeah, we've definitely taken steps in that direction.
All right, Joanne, got to leave it there. Joanne Feeney, partner portfolio manager over at Advisors Capital Management, counting us down to the closing bells. Those bells just about 3 minutes away, Scarlett, and we were talking about how not a lot's moving in the S&P 500, but there is one stock. It's not in the S&P 500, but it's having a phenomenal day. This is shares of Hertz. Remember, they got a bid earlier in the day, largely on the disclosure that Pershing Square had taken a stake in it. For some reason or another now, they've shot up another 20 percentage plus points, all the way up now to a gain of roughly about 54% here on the day. Is meme stocking, is that back?
I feel like this is the new meme stock. I mean, it kind of was as well earlier, but definitely not clear on what's driving this because the Pershing Square news was on for a while now, right?
Yeah, so not, and we should point out, no headlines on this, so we'll, of course, keep an eye on any news to bring it to you, but really just kind of indicative, too, of this idea that there are people out there still willing to speculate, still willing to bet whether Hertz should be that bet. I mean, that's a whole nother debate.
Absolutely. I mean, there's also the argument that Hertz and Avis will benefit from the various tariffs and uncertainty because people want to be buying used cars, and they have a lot of used cars to sell off.
All right. Across asset classes today here, the VIX elevated right around 33 at the moment. Yields down across the board, primarily on the shorter end of the curve, 7 to 8 basis points for your 2-year and your 5-year lower. The dollar having an awful day, and so too are stocks. A full breakdown of all of today's market action starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Scarlet Fu, taking you through that closing bell. It's a global simulcast. It starts right now with Carol Master in the radio booth. Tim Stenovic, who she allowed to share space with her today, as we welcome our audiences across all of our Bloomberg platforms on a decidedly interesting day. We were talking the last couple of sessions,
kind
Carol
of a nice
Master.
person on most days.
Most days.
Yeah.
I don't know.
Not every day.
Not on odd number days. But when we talk about this idea of the calm that has swept through this market, and a calm being broken today, though volumes are light, but stocks down significantly.
Yeah, and I guess Tim keeps beating me up here because
So
he's
just
like,
keep in mind, at the top of the hour, we do see the release of the US overall net capital flows.
Of the session. And you know what? Just when you think maybe
the prior read was
2.2% lower on the S&P is kind of a
billion,
bummer,
and the
check out the
long-term
stocks, it's down
transactions,
4% today.
the prior read was 45.2 billion.
Off its worst levels of the day.
7%.
But look, if we talk about crucial moments of the day, I think it's none other than hearing from Jay Powell a little earlier, and specifically the concern that he has about what the Fed would do in a stagflationary environment, but also that the tariffs, as they were rolled out, were bigger than expected, which means they could have a bigger effect than expected.
I feel like they need to do what United did and give two different forecasts.
Exactly.
The base forecast and then the bearish case.
Yeah, I mean, the
10
problem
seconds
is,
to data.
I mean, it's so confusing, right? We talk about this idea that a few days ago we were talking about this exemption that NVIDIA likely had with regards to those H20 chips, and then basically it's not effectively
Take long-term transactions, 112 billion, 112 billion, and the overall net capital flows, 284.7 billion, 284.7 billion.
Well, we get the closing bells here in New York, and it is red across the screen. An S&P 500 lower by more than 100 points.
China's Treasury's holdings climbed amid a boost in valuations.
And we were much lower than that on the day.
So the US Treasury releases data on foreign holdings of treasuries with this report.
The Dow Jones Industrial Average dropping about 700 points or 1.7%. The NASDAQ indices, of course, that is your biggest drag here, largely because of the weight that we saw from NVIDIA and the rest of the chip stocks. The NASDAQ Composite and NASDAQ 100 each down about 3%. And the Russell 2000, that's your relative outperformer, lower by 1% on the day.
All right, quick check on the S&P 500.
The China US Treasury securities holding $784 billion in February versus $761 billion in January. That's an increase.
All right, let's take a look at the IMAP. It should be pretty straightforward here.
Japan US Treasury holdings, they increased to $1.126 trillion in February from $1.079 trillion in January.
The outlier here is that thin slice in the upper left-hand corner. That is energy stocks gaining 0.8%. By the way, they are the worst performers since April 2nd, still down about 15%, but they are moving higher with oil prices.
All right, guys, guess what stock I am glued to as we speak?
Your gainers today?
Yeah, it's a huge gainer.
Hertz?
I'll give you a guess. It's on the screen right now. That's the hint.
I just keep watching it. It's up about 52.
Man, I had a 1 in 3 chance getting it right.
Well, hey guys. All right. So Hertz is up 56%. We saw some big movement to the upside in the last, 20 minutes or so, 15 minutes? Unbelievable.
Why?
Well, we know the backstory because it's been higher all day today, but we did see Pershing Square Capital Management revealing a large stake in the company. It's had its woes big time, no doubt about it. Bill Ackman's firm buying 12.7 million shares, valued about $46.5 million at the time of the purchase. That was a filing today, making it one of Hertz's largest shareholders. So we know they've been working on revamping their fleet, doing a lot of things. Looks like Bill Ackman want some changes as well. So I don't know. I'm just kind of glued waiting for maybe a headline to cross, but we're just going to have to wait.
The volume is amazing here, 58 million shares, and on average, it trades about 7.8 million a day.
Yeah, so a lot of activity, right? Just seeing it in a big way. All right, another gainer, Abbott Laboratories. Should we go to earnings, or do you want me to continue?
I'll just pick up here. We are getting earnings out of CSX, of course, the big railroad operator. On EPS for the most recent quarter, it did look like a miss. 34 cents a share. The street, on average, was looking for 37 cents a share. Revenue also coming in a bit light, $3.42 billion. The street was looking for 3.46. I need a little more time to dig in to see if there's any real commentary here on tariffs
we're looking at Venezuela very carefully.
Some of
so
the
again,
issues with
Trump
regards
currently
to
speaking
economic
on
conditions, with the shares lower
Mexico
by 5%
interview.
in the after-hours trade.
I will say the President and Chief Executive Officer, Joe Hinrichs, saying CSX faced operational challenges to start the year, which contributed to first quarter results that did not meet our expectations. So a little bit of commentary
macro,
there.
or micro, not macro. These are unique to this company. So
right,
operational, not negative on the economy.
Which it'll be interesting to see what they have to say, though, maybe about the economy. Still, though, CSX down, bouncing around here, unchanged, but we did see initially a big drop here. All right, I'm going to go back to gainers, if I may. Abbott Laboratories, folks, up more than 6% at its highs, finishing the day with about a 2.7% gain. CEO Robert Ford saying during their earnings call that the company expects a 2025 tariff impact of about a few $100 million. So I guess investors were like, oh, maybe they can deal with that. Company is also making some new investments in U.S. manufacturing here in the United States with the impact of tariffs on medical devices and diagnostics looming over the industry. So they're going to spend about $500 million on two facilities located in Illinois and Texas. I should say with earnings, they reaffirmed its annual guidance and reported adjusted EPS that were in line with Wall Street estimates. And then here's a smaller market cap company. It's a grocery company, $1.4 billion market cap. It's based in California. We're talking about Grocery Outlet Holding. It was up 5.3% at its highs, up almost 11% today, but still closing with a 5% gain. Being raised to buy from hold at Jefferies, which says the company's defensive positioning as a low-price grocer could fuel outperformance amid economic uncertainty. So there's the U word.
Okay.
I just want to just real quickly go back to Hertz, because a viewer actually wrote in. He was saying to look at the short interest. I didn't realize how many short shares.
Crazy.
Yeah, it was so
45% or something like that?
Yeah, 48% based on Bloomberg calculations, and that was as of yesterday, coming into today's session.
So this is a violent short covering rally then?
Potentially, yeah.
All right, certain outlier today in today's trade. I want to go to NVIDIA, the one that really started things off on the downside today after we got that news late yesterday that the Trump administration has restricted the company from selling those H20 chips in China. It'll cost the company billions of dollars and affect its product line down 6.9%
is speaking in Spanish, which is then translated to Trump.
At one point, it was down as much as 10.5%, but it came off of those lows. The restriction will impact NVIDIA's revenue with estimated write-downs of $5.5 billion. It could affect other chip makers too, which is why we saw AMD fall today. Samsung and SK Hynix could be affected as well. And staying with the semiconductor space, I want to look at ADRs of ASML because this is actually a tariff story, not a restriction story. Those shares fell 7% today after the company reported first quarter orders that were almost €1 billion less than expected and warned it doesn't know how to quantify the impact of recent tariff announcements that has threatened to upend the semiconductor industry. The company outlined potential risks from U.S. tariffs, including additional charges on shipments. And said it has no plans to move production to the U.S., but it may pass on some tariff costs to customers. And finally, the company that reported after the bell yesterday, J.B. Hunt shares falling 7.7%. The company reported revenue in multiple segments that fell short of consensus estimates. It did beat expectations when it came to intermodal, and first quarter profit came in above estimates. Analysts, though, pointed to continued concerns about the impact of tariffs and, of course, the broader economy. We saw price targets cut at least 3 firms that followed the stock.
All right, let's take a quick look at yields because the volatility there did continue here. Although we did see a little bit of a flip-flop from what we had seen a little bit last week. This time, a drop in yields of about 7 basis points.
The U.S. Treasury International Capital Data February reports on the feed for those interested.
7 basis points on the longer end of the curve. You're only looking at a drop of about 3 basis points. But look at those absolute numbers here, 3739, 4247, and that gives you a sense here as to why some folks are in the other asset classes are being rattled.
Yeah,
Yeah, although there must be a relief among market participants that at least we're going back to a traditional risk-off dynamic where stocks are down, the dollar's down, but bonds are higher, pushing yields lower, right? Because for the last couple of days, we had seen this odd and concerning situation where everything was going down at the same time.
I thought about that exactly. I mean, it's kind of crazy, right? With all this uncertainty out there, but to see that it's kind of normal.